Yeah, the new developments chapter and the table of contents is provided on page A1 of your book. That's the right place to start. A1, okay, as we get started with our study today. So you'll see several topics here. We're going to divide those among our teams. Jerry and I cover about half the items on the left-hand side of the page and get you up to date on the different legislative pieces that have been occurring since we last gathered in November of 2020 in this virtual setting. So glad to have you with us in this educational setting that will keep you close to home, but keep you closely connected to the tax school as well. So the first one we're going to be describing on page A2 is all of the different pieces of legislation that we've seen as a group that have occurred over this time period, not only since last November, but really the pieces that we'll be looking at today that have had a major impact on our tax preparation life dating back to even 2017 and spanning two different presidential administrations. And as we think about these different topics, they are listed on page A2, the different pieces of legislation. Also note the dates of when they were enacted, because it's really critical as we think about the topics and the impact on clients and how the rules have changed to understand when these issues began or were changed, or maybe those changes were even updated further. So the Consolidated Appropriations Act, we'll have quite a bit about that in our chapter. That was passed on December 27th, 2020, as noted on page 2 of our chapter. And Jerry, that was you might recall the wedding anniversary that Debbie and I celebrated together, our 40th wedding anniversary. That, of course, was a Zoom celebration event as we were still largely shut down by various things on December 27th. And so during our Zoom session, it was fun to watch in the background the continuing process of the CAA being provided and being changed and being updated on December 27th when the president signed it. Of course, we knew what it was several days before that. I think the Congress decided on December 22nd or 3rd, but it was made official that day. So what a wedding celebration, Jerry. The CAA come to life. So
yeah, I'll bet that really made for an exciting time. I'm just envisioning, your lovely wife who I've met before, and I'm sure this isn't the first time that tax law has interfered or been a part of events in your lives.
oh, yeah, that's probably true. Then we go to Arpa, March 11th of 2021, and you will remember this that happened on March 11th had several things that affected 2020 tax returns, some of which had already been filed, but caused many others to be piled up and waiting for more pieces. And Jerry, this is probably the latest that I've seen, March 11th, where legislation is passed that affected the prior year return. Concur with that?
Yeah, and it really made, I thought going into last filing season, and if you're with us last year, I thought reconciling the stimulus payments, which is actually Keith and Catherine are going to cover that. I thought that was going to be our biggest challenge during the filing season, and it was a big one. But some of the changes in March, which, maybe I'm reminding some of you of this, we'll discuss some of this as we go through this first chapter here today.
And then we have four others that were earlier. The CARES Act back to March 27th of 2020, the second major stimulus thing after the pandemic had began. The FCAA, December of 2020, made a few other minor adjustments to that. The Families First Coronavirus Response Act, March 18th, which was the very first piece of legislation in the pandemic. And then we have things that go all the way back to December 22nd of 2017, the Tax Cuts and Jobs Act, probably President Trump's administration's, major tax legislation piece. That was passed on a late Friday afternoon to make two connections here. The Illinois-Mizzou bragging rights game, also December 22nd of 2017. And Jerry, that set things in motion for a long time, it seemed there, all the way through 2026. And lo and behold, as we sit here today, we are halfway through many of those TCJA enactment items. And there's one more we can add to that. It's not signed by the president yet, but over the weekend, Things are just moving so fast here. HR 3684, the Infrastructure Investment and Jobs Act, approved by the House after 11:30 p.m. Friday night. The Senate had approved it in August. We now wait for the president to accept it and sign it. So this is not the law yet, but that's only one step left to go. And it doesn't have very many tax pieces in there. Primarily the employee retention credit is now going to end September 30th of 2021, not available for the fourth quarter of 2021. And some new rules on crypto asset reporting, where the brokers will have a bigger piece here on identifying and reporting transactions. We'll cover those in detail in another chapter, but those are the only two really highlights that we've seen in that $1.2 trillion package signed over the weekend. Most of that is about infrastructure activity, but we do note the fourth quarter ERC will be gone. Jerry, my final note is when are we going to file all these things? Saturday, April 16th of 2022 is Emancipation Day, which will be observed in Washington, D.C. the day before, April 15th, which means that the due date will be April 18th of 2022 to file your 2021 calendar year individual tax return, April 18th of 2022. And I think also, Jerry, the extended due date in October is Monday, October 17th. So we might need a little more time to get these rolling. That might be helpful. But really, one of the big things that will be helpful, I think, are going to be these tax pro accounts that Jerry is going to describe for us next. Jerry?
Yeah, thanks, Bob. And Gina has rolled out a poll question here. And, I alluded to a little bit of this earlier. It was a pretty, was it a pretty frustrating tax season? Was it the most frustrating tax season of your career? Or maybe, it combined to be the worst two, one A and one B. So as Gina said earlier, there's no wrong answer here. We're just interested in what you think. And it does seem like there's a lot of frustration out there. Some of my issues were changing the rules in the middle of the filing season. Actually, Bob, you talked about April 18th. That seems like some extra time. But remember last year, the original due date was moved to May 17th. So actually, I guess it's a little bit less than a month less. One other comment about those various tax laws that Bob mentioned, we will show in the left-hand margin which of these acts we're talking about as we're going through different issues here. So follow through that, and that will tell you when it came about. Sometimes there will be more than one there because it was modified or changed as we went along. But one thing that's new that hopefully may help us with a little bit of that frustration, because it's been very difficult. I'm not telling you anything new. It's very difficult to get a hold of the IRS these days. I talked to a client yesterday, and she's having trouble setting up an installment agreement. She's had a balance due every year. Wants to modify her installment agreement. She's been getting letters from the IRS. And I said, well, you would probably be better off just going online and getting that set up. And she doesn't really have computer access or computer savvy. So she is very frustrated. She wants to pay. She doesn't want, the letters are getting nastier. And of course, that isn't helping her feel any better. So we're going to try to help her out as much as we can. But one thing that might help us, we found also that it's been difficult to get power of attorneys, set up or, instituted on the CAF, the centralized authorization file down in Memphis. And, I am envisioning, I used to always fax in all the power of attorney forms, and I was envisioning a huge pile of faxes, coming up from the floor. And actually, that may not have been the case, as one of the things I read is that one of the reasons why the IRS wasn't able to process all these power of attorney forms is that none of their printers had any paper, which you'd think there would be an easy fix for that. And I'm not going to say with 100% that's, well, I'm sure, hopefully it's not the only reason why they had some issues. So with these tax pro accounts, we'll help them out. We're more interested in helping ourselves out here. But this is an online portal where you can create a virtual power of attorney. Then we can see our client's information. But here's the key point here. The taxpayer has to do some of the work to get this going. They need to create their own IRS online account. Now, some of them have already done that when they're dealing with child tax credit payments, or maybe when they were dealing with entering bank account information for direct deposit. So some of that may already be done, but if not, they will need to do that. They'll need to authorize us, and then we can get that going. Now, as you might imagine, since it's dealing with the IRS, it's probably not as simple as I'm describing it here, and that's what I've been hearing. I have not done so yet. I think Bob has, and you will see. Hopefully this will be helpful for us. But one of the questions would be, do you want all of your clients to set up these tax pro accounts? It probably isn't needed for everyone, but I know I've got some clients who are historically dealing with the IRS each year, like this lady with the wanting to get the installment agreement. It would be good to be able to go in there and see what payments have been posted, what's going on, the different tax liabilities, seeing when refunds will be issued and things like that. So they will need to go in there and do that for us. It can be done for the year 2000 all the way up to 2024. I know I have started the last few power of attorneys I've had. I've added the current year and maybe a future year, figuring that, well, if there is an IRS issue, it may spill over to the next year, especially in a CP 2000, where there might be other years involved as well. So that is a possibility out there. Hopefully it will work as smoothly as possible as we go through. There may be some additional items that they'd like to do. I'm just hoping the basic amounts end up being relatively easy to set up. There's a couple different publications which we show on your screen and also in the middle of page 3, so you can read some more information about that. I am considering putting something in my letter that I send out in January with organizers and checklists, and maybe tell it to everyone and see if they think it's necessary, have them do some of the background work to begin with. Then when they come in to have their return done or drop off their information, will already have hit the ground running. So we'll see a couple different items as we go through where it might be helpful to have these accounts. So keep that in mind. So one of the big topics we had last year, Bob was a popular guy. Well, he's always a popular guy, but probably the most questions we had in our schools last year was dealing with PPP. So this is like PPP 2.0 or 3.0. We've got some additional information how those are treated.
Thanks, Jerry. Well, we're basically going to be describing the forgiveness process. Last year, we were talking about the application and the accounting process, a bit of forgiveness last year, but we're mostly focused on getting these PPP loans forgiven, and most of that has already been accomplished by the taxpayers. If you recall, they might have received some loans in April through June, perhaps, of 2020, and then there was a new round of that happened this year that closed out. It started in March and closed in May. But we're focused now on what is the forgiveness piece. And you have to have the clients spend the money on 3 required purposes before they are eligible for forgiveness. They have to use it for authorized purposes, which would basically be payroll or rents, utilities, mortgage interest, PPE, and a few other minor things. The loan had to be used in a either 8 or 24-week covered period. And the whole idea was initially retain employees at the same level before the pandemic began. Now, at certain loan levels, that piece has been softened as a requirement. If your loans are less than $150,000, that's not a very significant requirement anymore. But the purpose we're going to be focusing on is, how did they use the funds? Well, we knew from the very beginning the real flavor of this PPP advantage was the loan forgiven amount would not have to be included as gross income. That was in the very initial statute, so we knew no taxable income from the PPP loan. What we were unclear about was, well, what about the expenses that were paid with those loans? And initially, under the old law, the IRS said, no, those are not deductible expenses because they issued a notice. Jerry, that happened just about this time last year, late November, after our schools or near the end of our schools last year, where IRS confirmed in a notice, no, you can't deduct those expenses. Well, that was reversed in the CAA. Again, December 27th is when that happened. And the CAA legislation said you can keep your deductions. No deductions will be disallowed. Your PPP loan is still not included as taxable income. You don't have to reduce any attributes by your loan being forgiven like you do in other cancellation of debt income items. You can keep your NOL, keep your solar energy credits, and you don't have to adjust your basis downward. You can still increase your basis because it's going to be treated now as a tax-exempt income on those partnership and S-Corp entity returns that allow you to boost the basis up. So the best of both worlds, you got the cash, it's non-taxable, and because it's tax-exempt defined, it still increases your basis, and we got to keep our deductions. And that was, a major change right on December 27th with only 4 days left in the year to modify our tax planning, because all of a sudden we had some deductions that we didn't expect we would have on Christmas Day. So nice post-Christmas treat here to get these deductions put into play. We also had a portal that opened up that if your loan's under $150,000, the borrowers can go directly to that portal, don't have to use their lender. And I think that's maybe more helpful to those people who use the non-typical bank down the street as their lender for the PPP amount. So if I walk that through, one final piece here, that closed in May. So if I got my loan on the last day, May the 4th, my 24-week covered period ended last week, and I have 10 months from that date to apply for forgiveness. So I'm sure we will see some PPP loans on people's books on December 31, but not very many, I wouldn't think. Most of those are going to be cleaned up, fully forgiven by the end of this calendar year, but not all. And now we get into the ERC. We change statuses just a bit to a different type of stimulus incentive package, the Employee Retention Credit. In the old law, which really came from the CARES Act, again, this was in March of 2020, it said you can take this Employee Retention Credit up to half the wages you paid from March the 13th of 20 through the end of the calendar year. You can get maximum wages of $10,000 per employee per year, and so forth. And therefore, the maximum credit is $5,000 per employee per year. Again, for 2020, $5,000 max. And the other real critical piece was, if you had a PPP loan, you could not get the employee retention credit. And because of the easier part of the PPP, the faster distribution of cash, and the easier qualifications, most people pick the PPP loan instead of the ERC. We had another requirement that the ERC employers had to exhibit one of two things: a full or partial suspension of their business or a significant decline in gross receipts. And for 2020, that significant decline was measured as a 50% drop from 2019 to 2020 to qualify for that significant decline in gross receipts. One final comment about the partial suspension of operations. There was a major notice issued on March the 1st of 2021 that describes that in more detail to see if your businesses might qualify before we would have here. I'm going to jump out of there. Gina, would you? Okay, there we go. All right, very good. We're going to look at example 1. We had just a little pop-up on my screen. We got that solved. Example 1 on page 6. This is a company who's trying to determine their eligibility for ERC in 2020. Let's just look at the table that's listed there. Their 19 versus 20 gross receipts, how much they changed, and when were they eligible. So for 2020, again, I would put in the left-hand margin on page A6, I'd write really big, 2020, because these are rules different than they are this current year. So in both the first and second quarters, their receipts had dropped more than 50%, so they were eligible. And even though the third quarter, the receipts were 80+%, they were still eligible because you're eligible for any quarter you're under 50, and you're eligible for the following quarter until you exceed 80. So they had 3 quarters worth of eligibility for their 2020 ERC. But again, capped at $5,000 per employee for the whole year. Qualified wages had a different definition depending on the size of the company. If your size of the company exceeded 100 full-time employees, not full-time equivalent, just full-time employees, then you only were able to take the ERC to the extent you paid employees for not providing services because of your shutdown or decline in gross receipts. On page A7 of our text, I draw your attention all the way down to the page on footnote 24. Here's the IRS Notice 21-49 that laid out a couple real critical definitions. One of those was full-time or full-time equivalent. And that notice clearly says you only calculate employees who are full-time employees. So I have 96 full-time employees. I have 12 people that each work half-time. So that would be 6 full-time equivalents. But for the ERC calculation, I disregard them. I still have 96, and I'm not subject to this more restrictive test. I don't have to add that 6 full-time equivalents onto my 96, which would give me 102, which would make me subject to these rules. Don't do that. Full-time equivalents are not part of our calculation. The other part of that notice that gave us some clarity was about related parties. And we'll dig a little deeper into that in our small business chapter. But the short answer is my spouse is going to be my related party unless we have no other living relatives on our planet. Even if they're not involved in our business, they can still trigger an indirect attribution and cause my spouse and other family members to be related parties and make them not eligible for employee retention credit. That's true in 2020. That's also true in 2021. That notice is something to grab and detail your study a little more. If I'm under 100 employees, then all wages paid to any employee, full-time, part-time, doesn't matter. If I'm under the 100 test, all the wages qualify for the employee retention credit. We claim this credit on Form 941 or 943 if you're an annual agriculture employer, or 944 if you're a small employer with less than $2,500 of liability. You can use this to reduce your payroll tax deposits initially. On Form 941, you can also obtain an overpayment. You can apply that to the following quarter or get a refund. Or on this new Form 7200, you can claim an advance on your refund because of the ERC and get that money paid to you much, much sooner. The CAA and the ERC, again, on December 27th, rules came about that were even better. It got extended through June the 30th, later extended longer into the year, but this legislation took us through June the 30th. And the bigger part of this legislation said, If you had a PPP, you can get an ERC also. You can get both subsidy provisions for the pandemic. The only trick is you can't use the same payroll for both your employee retention credit calculation and your PPP loan forgiveness. So right then on December 27th, I knew that we were probably going to be filing 941Xs for the first, second, third quarter of 2020 to claim the ERC. And I knew that 943 filers were going to have a big benefit that they didn't know existed prior to December 27th. This ERC kept getting better and better. The credit rate increased from 50% to 70%. It let us apply the test to each quarter such that the limit was now $10,000 of wages per employee per quarter, not for the whole year, which meant $7,000 of wages, of credit, maximum per employee per quarter instead of $5,000 per year. That 100 full-time test we just described, that got raised all the way up to 500. So as long as I had less than 500 full-time employees, all wages paid to all employees, full and part-time, qualified for the employee retention credit. Even better, it gave us an alternate quarter calculation choice, such that you might be eligible in only 2 quarters of 2021, but be eligible to get the credit in all 4 quarters. It even let us use as one alternative quarter the 4th quarter of 2020 for the 1st quarter of 2021. And in the 4th quarter of 2020, I only had to exhibit a 20% decline in gross receipts. So I can use the 4th quarter of 2020 versus the 4th quarter of 19 to qualify me for the 1st quarter of 2021. Likewise, for the 1st and 2nd quarter of 2021, I can use the 4th quarter of 20 or the 1st quarter of 21, always the immediately preceding calendar quarter. So if I qualified in the 1st quarter of 21, I'm eligible, and I could use that quarter's results to be also eligible in quarter 2. And if in quarter 3 I have a large enough decline in receipts, I'm eligible, and I could use the 3rd quarter again to qualify in the 4th quarter. So 2 quarters of calculations qualifying me for 4 quarters. All that's changing Friday night because we don't have these available for the 4th quarter any longer. So example 3 in Ramsey Landscaping, we're going through the same process about electing the alternative quarter provision, and we're saying he could be eligible for a $280,000 ERC on his $400,000 of payroll. But again, as of Friday night, his 4th quarter results will not be eligible for the ERC. And I guess, Jerry, would be time to maybe say there is some hints about the 4th quarter ERC eligibility to be brought back in the Build Back Better plan, where there will be other tax legislative pieces maybe still coming. I guess we have to wait and see if there's going to be any developments about that. Jerry?
Well, yes, and if there is something that's material, follow the tech school websites here. Either Tom will have a blog or we'll have some other information that will help you as this goes. But yeah, follow the news and see how this affects your clients going forward. There's always changes. You mentioned about the TCJA. It's 8 years, and after 4 years, it hasn't been made obsolete yet. So, that's about as permanent as things get in the tax world.
Yeah, 8 years ago seems like that was flying by before we get to here. And here's what really is started in March 11th, but changed Friday night. The ARPA extension put it available for all 4 quarters of 2021. We have these more favorable rules about the 20% reduction is all that needs to happen, not the 50%. We introduced this new definition, a recovery startup business. And even though ARPA and our text says, hey, it's good for 4 quarters, What happened Friday night eliminates the fourth quarter. Now, what I also read, from Friday night, they did not touch this part, the recovery startup businesses, which is a very limited application. But when it applies, Jerry, my goodness, it's a touchdown home run. The recovery startup businesses began their businesses after February 15th, which means they were not eligible for PPP. They have less than $1 million of receipts per quarter. They don't have to meet the test of full or partial suspension or any gross receipts reduction. Don't even have to go to those bullet points. If they started after February 15th, less than $1 million of gross receipts, what happens? Their employee retention credit is limited to $50,000 in the third and fourth quarter of 2021, but they still get to apply the same 70% of wage to up to a $10,000 max wage per employee per quarter, $7,000 per employee, up to $50,000 max. So if you had everybody lined up right, it's about 7 employees will max out this recovery startup business. But from my reading, this is still in play for the third and fourth quarter of 2021. We had 2 businesses in Camp Point, Jerry, who started up a grocery store December of 2020, no PPP. A restaurant that started up in May of 21, no PPP, but they are both in the recovery startup business. They will get this $50,000 credit max for each the third and fourth quarter. And I tell you, to have that much payroll and get $100,000 back from the IRS for their 6 months of operations, I know those 2 businesses are going to really benefit from that recovery startup business. So look for your clients who fit this little niche tax credit, but it's a major, major deal. And Jerry, what we'll see as we continue on our discussion, no double dipping in these programs. You know, if you can have ERC and PPP, that's fine. Just can't use the same wages for both. You have to be a little selective and creative in how you do these ERC PPP calculations. That is also true, Jerry, for the topic you're going to share with us about these sick and family leave credits. No double dipping here either, Jerry.
Well, yes, and we do have another poll question out there for your response. And Bob, you talk about 2 new businesses in Camp Point. You know, that probably like doubled the size of the business district, didn't it? It is very nice town.
It was, and you notice they were both about food. Both about food, Jerry.
Sure, of course. It makes perfect sense. All right, we are now on page 13, dealing with the credits for paid sick and family leave. If you're with us last year, of course, we spent a good amount of time on this. The employers that that up to 80 hours and up to 10 weeks, the various credits. It was a refundable credit, and originally the covered period was from April 1st through December 31st of 2020. And just again, a few other highlights just to get us up to speed here. There were 6 different categories of the type of payments that would qualify for this leave. And these are on the top of page 15. And that will, the first 3, 1, 2, and 3 there are dealing with the individual themselves. 4, 5, and 6 have to do with caring for somebody else. These are the same as what they were a year ago. No changes here. Also, in these credits, they were made available to self-employed individuals. And Bob, I think I'm going to keep a tally of all the different times we're going to say this is something we've never seen before. I mean, most everything in there has, things we haven't seen. Self-employed individuals qualifying for unemployment, qualifying for these credits, the computations that we have, the amounts. There's 10 days, 80 hours, $511 a day. That's $5,110 of credit under reasons 1, 2, and 3. And Bob, also looking at our screen here with this picture, this is a pretty substantial credit. it's nothing to sneeze at, right?
Oh, I see what you did there.
Yeah,
Yeah, that's
yeah.
good. Very
Yeah,
good.
yeah, thanks, Bob. But yeah, so it is a lot of big money getting tossed around here with the ERC and now with these credits. Now they weren't really optional. I know we had some various comments and questions from enrollees last year about employers not doing that, and that really wasn't an option for them. Under the reasons 4, 5, or 6, caring for somebody else, there was a $200 a day, a $2,000 maximum credit. Okay, so that gets us up to some of the basic rules. On page 16, there were some modifications by the CAA. This credit was extended through the first quarter of 2021. So that was, we've got some additional time periods here. And those are mentioned there on page 16. Bob talked about the Form 7200. These particular credits for self-employed individuals could either be used to lower estimated tax payments. We had to compute their average daily self-employment income, which we weren't sure originally how this was going to work, and ended up being, I hope, pretty straightforward. Taking their net SE earnings for the tax year, dividing it by 260. So it's either going to lower their estimated payments, or you could file Form 7202 to claim this particular credit. We show you a 7202 on page 18, also up on your screen. So lines 1 and 2 talk about the number of days that are in play here. And lines 7 and 8 is where we compute the net earnings from self-employment for that particular credit. All right, on page 19, now ARPA made some changes. We've already said it was extended into the first quarter of 2021. Now under ARPA, it's extended I shouldn't say the word extended. There is a new period. There's a reset now from April 1st to September 30th of 2021. There's some additional wages that are paid. Any leave for obtaining the COVID-19 vaccine is included in those various amounts that could qualify. And this same expansion went for self-employed individuals as well. Most all the other computations were about the same, but here's the key point here. You could have the same employee now qualify for these credits the second time. Maybe in the first quarter of 2021, they were under that original period, April 1st of 20 through March 31st of 2021. Now everything starts over. We got a reset for the second and third quarter of 2021. Same dollar amounts, and those are shown there on page 19. So there's more eligibility as well. Again, all those things were the same, were carried forward for self-employed individuals as well.
Jerry would maybe add just a brief summary as we wrap this section up. I saw a 941 that had been filed for the second quarter of 2021 that had ERC and some reset of these sick and family leave credits that Jerry described. The payroll was about 60,000 in that quarter, and the total credits from ERC and FFCRA, $38,000 of credits out of that $60,000 payroll. Jerry, we've never seen something that significant before. I want to just highlight maybe one more summary of all of these. What's the taxable status of these things we've been describing, in our first 30 minutes or 40 minutes here together? The PPP loan receipt that was forgiven, non-taxable. Expenses paid with PPP loans, still deductible. Some people received an idle advance of that $1,000 per employee. The IRS said that was non-taxable. The employee retention credits, though, are taxable subsidy amounts, and they are taxed in such a way as reporting reduced wages in the year for which the credit is being claimed. So your third quarter 2021 ERC, whatever that number is, will reduce your wages on that Schedule C for 2021. And then these sick and family leave credits that Jerry's been just describing, also taxable income, but oddly, the IRS described these as being needed to be reported as other income, adding to gross income instead of reducing expenses. So ERC handled one way, expense reduction, sick and family leave credits handled a different way, add to gross, but these are taxable benefits. But still, Jerry, even though some taxable, my goodness, what a realm of tax credit benefits that the tax professional must deal with. Jerry, I don't think there's ever been a time where the tax professional can verify and document and show their client their real value as a tax professional like they're able to do here in 2020 and 21.
Yeah, you're right, Bob. And so, we don't know if the clients are going to appreciate it, but still, it is very, there's a lot of opportunities for us to really help our clients out. Page 22, this is something new. And even though this doesn't apply until years after 2021, I think we are seeing the changes now, at least here in Illinois, issuing these forms 1099-K. And the IRS came out with this to track down people who were selling items on eBay and Etsy and and the likes. It has been expanded further. Oh, and we do have a poll question out there. Gina just put it up here, so please respond to that. But there's a lot of unreported income. The IRS is trying to track that down. This also includes for those companies who take credit cards. I get a 1099-K for the credit card transactions that I have in my business. But this, under the old law, it was just if you had over 20,000 in these transactions or over 200. Under Arpa, that floor is lowered all the way down to $600. Now, again, this applies to years after 2021, but here in Illinois, we are seeing it now. I had a new client this year, gave me a call and said, I've got this strange form. I don't know what to do with it. And so he came in, we talked a little bit. He showed me this form 1099-K, and it was from an activity. He's retired, but he has an activity. He sells some products online. And so he got this form 1099-K. And I'll touch on this a little bit more when we get to the ethics chapter, is that, this was one of the questions that sometimes you're afraid to ask the client because they might actually answer it. This was one, what happened in prior years? Of course, I knew I had to go over that. I'd ask the client to bring in his prior year's return. And sure enough, there was no Schedule C in 2019. But we did one for 2020. I had him go through. He didn't really have a whole lot of records that were in, like written form, but he did have all his receipts. So we went through and came up with his Schedule C items and reported that. And as I said, in the state of Illinois, his receipts were not that much. It was only a few $1,000s. And after the expenses, his net income, of course, was even less. But most all the time while we're sitting there talking, he's saying, well, I'm not sure if I'm going to really continue this anymore. And I kind of took that to mean that now that he's got to pay tax on the money, it's not quite as attractive as it used to be. So he was a new client. He was the father of an existing client. So I took him on just because of that. And I don't know if he's going to come back. We'll talk about in ethics about those prior years, but I think, you may have seen some of these as well. That wasn't the only one that I saw where people had these activities. Maybe they'd never said anything to me about it in earlier years. Now they've got a 1099-K, and we're going to have to reconcile, come up with a new Schedule C for them. Like I said, this new rules under Arpa applies after 2021. We're probably going to see a lot more of these 1099-Ks in 2021 as well. Bob is going to cover the student loan forgiveness a little bit on page 23, and that will get us further along here. We've got about 28 minutes left before our break.
And Jerry, one more thing about the 1099Ks, we've had questions in the past week about that. Those apparently get issued for almost any type of transaction. I thought they would only be issued in a trade or business activity like everything else in the 1099 world. That doesn't seem to be the case. I mean, if you have a personal activity, even in your client's situation, there's really no defining whether trade or business activity occurred. Those third-party payers are just going to issue the 1099s for any of those amounts. You think that's right?
Well, in fact, Bob, since you mentioned that, we're not sure how these will apply for, payments through Zelle and, platforms such as that. And in fact, just on a personal note, my youngest daughter is getting married on December the 4th. And so I have been sending, my job, of course, is to pay for most everything. I understand that. I knew this was coming. She needs money to pay these various people who will be involved with the wedding. So I said, okay, I will just Zelle you the money. And needless to say, it's more than $600.
Well, it should be, Mr.
Well,
Boone. Yeah, you don't want to. This is not the place to be short on those.
yeah, that's right. Hopefully, this will be the only one, right? So, I've made over $600 in Zelle payments to her. In fact, I found that there's a $2,000 daily limit. I wasn't aware of that. Anyhow, so
Don't let that hold you back either. So keep going.
Yeah, there's always multiple days, right? So, what my question was, is it possible that my daughter might get a 1099K for the payments I'm making for her wedding? I said, we're going to need more clarification on this. It really isn't clear reading through the instructions and the little bit of guidance we've got now. I think the good thing about it, Bob, is that the Arpa rules won't kick in until after December 31st of 21. Now, I talked to my banker. I've got a banker friend who works at Chase. And I said, well, let me ask you, what do you think about this? He says, oh, no, that's a long way off. He doesn't see that for those types of payments through Zelle. We'll see. We need a lot more guidance, but I guess just be aware of that. And probably the worst thing would be to ignore a 1099K, because the IRS isn't going to ignore very many of them. And there will be a lot of CP2000s come out, similar to my new client this past year with his activity.
I think that's good advice. And maybe while we're talking about banks and 1099s would be the time to add in, one other potential, not yet done, but certainly heavily discussed, a 1099 requirement, changing the 1099 miscellaneous to include, the 1099 INT to cause more information to be reported on there. Maybe the average daily balance, the total debits, the total credits. I think the latest version of that is only if there's at least $10,000 of activity in that account. But there is some pressure to put more reporting on 1099 INT by the banks. And we'll see if that gets into the Build Back Better plan. It was not in the plan introduced Friday night, but there is some discussion about more details on 1099s, the Ks, the NECs, the miscellaneous. Jerry, it just looks to me like this whole 1099 reporting world is going to be much more expansive than we've witnessed in our prior several years. Would you agree with that as the IRS seeks to find more ways to identify taxable income?
Yeah, and so there will be a lot of notices if some more of these additional items occur that our clients, which meaning us, are going to have to deal with.
Let's move on to page 23 and discuss a little bit student loan forgiveness. The old law is listed for us on page 23, which basically said only in certain periods or certain events was student loan forgiveness non-taxable. One of those would be you work for a certain period in certain professions. You are a teacher in a low-income school for 5 years. You work in a healthcare industry. You work for the public safety department in your community. Those were types that allowed student loan forgiveness to be forgiven and in a tax-free manner. TCJA came along on December 22nd of 17 and said, let's add to that. If your exclusion from discharge, exclusion from gross incomes also include those discharges when death or disability of the student occurs. And I had a very specific scenario about this that I wish had been the law at this time. But the quarterback for a high school team several years ago went on to college and died in a tragic accident. And I had the challenge of telling his parents that it was good that his loan was forgiven, but we're going to have to file a tax return for their deceased son and report the student loan forgiveness as taxable income. Not the best day to make that type of analysis for a client. But TCJA solves that and says if death or disability occurred, it is non-taxable. And Arpa comes forward here March 11th of 2021 and makes it an even broader group of student loans that qualify for forgiveness. This is all the way through calendar year 25. So 21, 22, 3, 4, and 5, a 5-year arrangement here that almost any type of student loan forgiveness will be eligible for not being included as taxable gross income. You see the very specific instructions on 23 and 24, but Jerry, a very broad definition for almost any loan that's forgiven to be excluded from gross income for that student under a variety of conditions. As we think about the benefits for young people, Jerry is going to describe the child tax credit, the old law, but what about this new law and how does that going to affect our 21 returns, Jerry?
Well, yes, and I think earlier on in the year, I was predicting that the third round of economic impact payments would be our biggest headache this coming filing season. I think I'm going to change that answer to the reconciliation of advanced child tax credit payments. There has been some changes to the child tax credit. We're on page 24. It had been a non-refundable credit, $2,000 per child, phased out with modified AGI, 400,000 joint returns, 200,000 for everybody else. The child had to be under the age of 17 as of the end of the year, and there were some instances where part of that could be refundable. And Bob, as I recall, when this law came into play, one or both of my daughters was just turning 17 at the time, and so wasn't eligible for this credit. And I remember thinking that, I should have had some lobbyists to change that age just a little bit to get that credit for that final year. Anyhow, that's under the bridge. I'm not bitter or anything like that. So let's
maybe we'll get wedding expenses as an itemized deduction in 22.
Yeah, that would kind of make sense. And I don't think too many of the people will hold off and let me pay them into 2022. But yeah, it's worth, maybe I'll contact my congressperson, see what I can do. Anyhow, for the child tax credit, new changes under ARPA. Key point here, these changes, it's going to take us a little while to learn them, get used to them. As of now, they're only for 2021. I think in Build Back Better, there is some expansion of this for multiple years. Of course, that hasn't become law yet. So as of right now, the way we're sitting here today, these new changes are only effective for 1 year, 2021. And now the age of that qualifying child goes from under the age of 17. Now it is under the age of 18. So somebody had a better lobbyist than I did, increasing the age for these children. The refundable portion of the credit, used to be up to $1,400 of that $2,000 could be refundable. Now the CTC is fully refundable. In fact, it's going to be available to taxpayers even if they don't have any earned income. So there's going to be more people are going to qualify for this, and more of it's going to be refundable. And if this wasn't making it complicated enough, we've got some additional items thrown in here. The amount of the credit is being increased from $2,000 under the old law. Now the credit goes to $3,600, and there's a couple different tiers here now. If the child is under the age of 6, and it is going to $3,000 for children ages 6 through 17. So these maximum credit amounts, this additional $1,600 or additional $1,000 are going to have a separate phase out than the original $2,000 credit. These additional credits, or the new additional credits, will phase out at much lower income levels, $150,000 on joint returns, $75,000 for single, and $112,500 for head of household. We've got the original $200,000, $400,000 for the original $2,000 of credit. So additional credits, more people qualify, should be good news. Here's what I think is going to cause us the headaches, is that the IRS is sending out payments for the most part, paying this child tax credit in advance. And at first, it doesn't seem like it should be too tremendously complicated. It will be 6 payments between July and December of 2021. If you take that $3,600 of credit for the children under 6, half of that is $1,800. For those children, there should be 6 checks of $300. For the $3,000 credit for ages 6 through 17, take half of that is $1,500 divided by 6, $250 payments from July until December. They're not going to make any advance payments after 2021. These payments will need to be reconciled. I'm starting to hate that word. Stimulus payments, we had to reconcile them. Advance payments of child tax credit, we'll have to reconcile those as well on the 2021 return. Now, I'm hoping this is the case, that the IRS will send out letters in January to say how much taxpayers received. I told you what the basic rules were. Well, not everybody got those full amount of payments. And the IRS computed the amounts of the payments. I've got a couple, I have no idea why clients got the amounts that they did. They could have used 2019 income if their 2020 return hadn't been processed yet. Remember, these payments started in July. So in my case, my practice, I had a lot of returns hadn't even been filed yet. So they used 2019 income for that. There are, phase outs, the 2 different phase out rates. Oh, we do have another poll question out there about payroll tax deferral that we would like for you to give us your response. So, and in some instances, taxpayers maybe got the first payment and then they decided they wanted to opt out of those payments, and they went on this online portal to either make some changes to the bank information or to opt out of the payments. In fact, my oldest daughter, when they had heard that these payments were going to be coming out, she called me and she says, well, what will we have to do with these payments? I said, well, any amounts you receive, we'll have to reconcile them on the 2021 return. And if it turns out that your new child tax credit is less than what you had before, or if your income is higher, so those new phase out tiers apply to you, well, I said, she said, well, in other words, we'll have to pay it back. I said, well, kind of. You're going to have to reconcile it on the 2021 return. She says, well, we don't want those. So I talked to her about how you'd go in and opt out, and that seemed to work fine. She said, okay, I got that done. Then the next month, she still got another payment. And so she said, hey, I thought we opted out of this. What's the deal? And that's when I said, well, did both you and your husband opt out? And she said, no, it was just me who had done that. So there was still a smaller payment came out in the second month. So it's going to be difficult for us to know what those payments are. At least with the economic impact payments, the stimulus payments, we had some general rules that, for most people, they got $1,200 in the first payment, and 600 in the second, now 1,400, the payment that was made starting in March of 2021. But I had lots of clients who said, well, I don't remember how much I got, or they said I didn't get anything. We claimed the recovery rebate credit, and then the IRS said, well, you really did get payments, and they adjusted their tax deficiency. So, and there was never a letter. Maybe they got a letter that came with the check. Some of them got the first, some of them got both, some of them got one this March for the third one, but there was no letter that said, here's the total in stimulus payments that you received. So there may be some different numbers of children qualify, especially in the example of divorced taxpayers where one spouse takes the credit in 2020, the other spouse claims the exemptions in 2021. So you may have one spouse who's entitled to the credit, didn't get any payments, and you may have the other spouse who got payments and not entitled to the credit. And this is not like the recovery rebate or the economic impact payments. Those were basically free money. There were very, very, very few instances where those had to be paid back. But with these, people or clients are probably getting used to that, say, oh, well, if I got too much, it's okay, right? And well, no, it won't be. So some clients may have to pay that back, but not everybody. We haven't quite complicated this enough, Bob. So there is, and this is at the bottom of page 25, right above the box note, that taxpayers whose 2021 income are below certain levels, 40,000 single, 50,000 head of household, 60,000 joint returns. The joint is not double the single amount. But if the taxpayer's income is below those levels in 2021, they will not have to repay that advance payment. And most all the clients that I talked about reconciling, some of them, their income is probably low enough that they won't have to repay if they got too much. Most of those taxpayers' whose income was lower, we're trying to encourage the payments because they needed the money to meet child care expenses or things such as that. So this is the last point before I toss this back to Bob here, dealing with the child independent care credit, is that this would be a good example or a good instance why you may want to encourage a client to set up the online account with IRS. Then we can go in and see if they don't remember the payments or they don't get this letter that's supposed to come out in January, where we can go in and see, okay, the IRS says you got $250 in July, $250 in August, and then maybe no more payments, or maybe the other 4 payments, whatever the case may be, where we can verify, and then we will be able to reconcile those advance child tax credit payments. So it'll keep things interesting this filing season, I'm sure. And again, a couple items. I'm getting a pretty extensive list here, Bob, of all of those things that we've never seen before. I'm not sure if we want to see them again, but of course, that's not really up to us. These will be, lots of new things here.
Well, as you said, that's for 2021 only. And I heard you describing that whole process. So it looks to me like we will have clients who will have received the full amount of the advance. Some might receive none of the advance, and yet others might have received some portion of the advance, depending on what the source document the IRS used to calculate those for. And so, those letters or the IRS site will be especially critical. So I think at this point, we're up to 2 types of letters that we'd expect to get from clients in filing season, right, Jerry? One about their economic impact payments that we'll use to reconcile as a recovery rebate credit, and then these advanced child tax credits, 2 documents that we'll be looking for this time around.
Yes, even though I haven't seen anything that there will be a summary in January. There wasn't one this past year on EIP1 and EIP2. But with these child tax credits, those amounts could have varied. One other thing too, those payments may have changed once we got later on in the cycle, because now the IRS is using 2020 data to compute the amount of the payment. So it's not going to be anywhere near as straightforward even as the stimulus payments were.
Yeah, another good point. Well, I did a really quick math. One of our children has 3 children of their own. One is under age 6, 2 are not. So they have a $3,600 credit, a $3,000, and another $3,000 credit, $9,600 in child tax credits. A year ago, they would have received $6,000 in child tax credits, $2,000 times 3. And they're going to get half of that $9,600 in advance, $4,800, which means they will still have $4,800 claimed on their 2021 tax return. But a year ago, they had $6,000 claimed. So their refund will be decreased $1,200, or the amount they owe will be increased $1,200 compared to a year ago. But it'll be part of our job, too, to remind them, Jerry, well, you have a smaller refund because you had the advance, and you have a smaller refund because you had the advance. Don't forget, in my son's case, he'll have $4,800 already in his pocket, but a $1,200 smaller refund. This child and dependent care credit is a similar vein of what Jerry just described. This is also a short-lived program, but the old law was a non-refundable credit, had to have tax liability to get it. A maximum of $3,000 spent for one child, $6,000 for 2 children, and you had a maximum flex amount of $5,000. And what that turned into on page 26 of our text, as we look at the old law, generally that turned into a $600 credit for one child, $1,200 credit for 2 children. Could have been more at lower income levels, but generally it was a $600 and a $1,200 credit. We filed that on Form 2441. The ARPA comes along, and ARPA gives us some new definitions and expands this only for 2021. But look at the program of how this changed on page 28 under the new law. Again, a 1-year only program, but look at the changes. The credit amount increased to 50% instead of the former max was 35, but again, a typical amount was 20%, a maximum of 50, or no, I shouldn't say a maximum, but it is 50%. And the expenditure level is also increased, $8,000 for one child, $16,000 for 2 children. Again, those used to be $3,000 and $6,000. So the credit now, $4,000 for one child, $8,000 credits for 2 or more children. And again, the more common was $600 and $1,200, now $4,000 and $8,000. Huge boost in these child and family dependent care credits that'll be claimed on Form 2441. We show example 6 on page 28, example 6, where Charlotte and Nathan are married. They have income, but remember, you have to have earned income to get this credit. Charlotte's employer had a dependent care program that allowed her to make pre-tax contributions to her dependent care flex spending account. She took the maximum $5,000 limit. We had to reduce that out of her $6,000 expenses, and so she ends up with a $1,000 net tax credit times the 20%, and she gets essentially a $200 credit. But she'd already had $5,000 reduced on her W-2 in box 1, 3, and 5 for this dependent care credit. And so we wonder about what should that look like under ARPA as we think about the dependent care assistance program here for 2021 only. As we think about these higher phase out amounts or these higher threshold amounts, it also allowed the dependent care plan to be increased to $10,500 instead of the $5,000 max. And I got to wondering, well, is that a good idea or not? And I think part of that answer, Jerry, what's your favorite tax answer when we have things we're debating of whether this is a good idea or not? Jerry's favorite answer is?
Yeah, of course, it depends.
Yeah, it does
Absolutely
depend. It does depend, but follow my math with me here. If you want to write these numbers at the bottom of page 28, a little fun with math as we wrap up the last couple minutes of our section. So think about what a DCB, a dependent care benefit program, saves if paid through a flex plan, cafeteria plan. I'm going to say the client is in a 22% federal bracket. So that's the first number to write down, 22%. We know it saves the Social Security tax 7.65%. I guess I'm assuming they're not capped out at that 140,000 level. And then in Illinois, it also saves Illinois tax 5%. So 22, 7.65, and 5. If I add those together, do a little rounding in my head, I end up with a 35% savings from participating in the dependent care flex plan. And if I think back to the 2020 rules, which when I normally would have received a 20% credit on Form 2441, well, the 35% flex plan was better. Picked up 15% savings on that $5,000 amount, saved $750. But what about 2021? The credit for this year's 50% under filing the Form 2441 process, and the flex plan saved 35%. So I think in 2021, a very unusual arrangement where the tax credits under the flex plan might not be as good as the dependent care benefit plan. And I know it's November the 9th. We're probably too late to make any adjustments for that. But I guess I'm just saying, if a client comes to you and says, should I raise my flex and put a lot more money in there for the last few pay periods of the year? My answer is probably going to be no. So check my math, check my theory if you agree with the way I analyze that. And I also raise this because I'm sure this is going to, or is being debated to be included as an extension into 2022 and longer. Not in here yet, but in proposals that are coming out. If this does get extended, this math concept is what we should be considering going forward. Now, remember, we didn't know these rules until March 11th of 21, well after people had already made their flex spending decisions for the year. Again, they were allowed to make an amendment, but we might know this earlier and might be able to help our clients plan accordingly differently. In the last minute, I would just add maybe one other comment about these last two pieces, the child tax care credit and the dependent care credit. As these affect clients' refunds, and I guess I would add in there the EIP too, be sure these varying amounts that Jerry described people have received during 2021 do not get reported in their books and records as gross income subject to tax. You know, these are not taxable activities. The economic stimulus payment, sure, it affects their final credit on a return, but is not a taxable receipt. The child independent or the child tax credit advance payments, sure, it affects their return, their final result on their 21 return, but it is not a taxable receipt. So be sure clients are not putting all of these dollars that they've received from U.S. Treasury in their books and records as taxable business income. Be sure those are identified clearly. Jerry, final wrap up on our chapter here.
Yeah, and we're going to take a 10-minute break. Then Keith and Catherine will be in here. My only quick comment, Bob, is one of the other issues we'll have here is that some clients couldn't use their dependent care benefits in 2020 and were able to roll them forward to 2021. And I'll be interested to see how those will be treated in 2021 on the W-2s.
Catherine and I will have you for the next 75 minutes as we finish up our new developments, and then we'll take a 10-minute break, and then Bob and Jerry will have you for the rest of the morning with financial distress. So let's go ahead and join me, if you would, in the text on page 29. And you'll notice that the new development here is the expanded premium tax credit. Now, Catherine, I know that you don't do a lot of work with the premium tax credit in your office, right? But I do some with mine. I also know, Catherine, that you don't do your tax returns early in the year. I try to get mine done as soon as possible. So I had a little bit of a pleasant surprise for some of my clients last year when in March the law changed and they didn't have to repay any of their advanced premium tax credit if they'd made too much money. So they were pretty happy about that. I had one client that saved about $23,000 of what would have been tax liability on their 1040. So they were excited about that. I'm sure you folks out there at tax school have similar stories. That was a good change. That was only a 2020 change, though. So forget about that happening for 2021 or 2022. If your taxpayer got too much premium tax credit, they will have to repay it potentially. Here's what is different, though. I would have you go with me in the text to page 31. Okay, page 31. Find the chart in the middle of the page. Go down to the bottom line of the chart where it says 400% and higher. Highlight that. And then highlight where it says 8.5%. After you've got that highlighted, go ahead and come out of the book. This is why you highlighted that. So under the old law, if somebody made more than 400% of the federal poverty line for their family size, they were entitled to no premium tax credit and they had to repay the whole amount. Okay. Under the new law, this is in effect for 2021 and 2022. Somebody can make more than 400% of the federal poverty line, and then they can still be entitled to premium tax credit. So what's up with that 8.5%? Well, the 8.5% represents how much they would have to pay at most of their household income for health insurance. So let's go ahead and just write an example together. Grab your pen and over in the white space to the right of the chart, just write this example. If somebody had $200,000 of household income times 8.5%, they would end up paying $17,000 for their health insurance. Now, maybe they went and picked a plan, a gold plan or something that costs $24,000. It doesn't matter. They're only going to pay a maximum of $17,000. So you might want to reach out to your clients that you know are using marketplace plans. You also might want to answer the open poll question to record your attendance here. You might want to reach out to them now because open enrollment's been open for 9 days. And maybe if they knew that they were going to be capped on what they would have to pay for insurance, it might be incentive for them to pick better insurance, right? So that's a nice perk. Here's another nice perk with the premium tax credit. Go down to the bottom of page 31 with your highlighter in hand and highlight this. Unemployment compensation, find that on line 1. Not taken into account, highlight that on line 2. So unemployment compensation not taken into account. Okay, for the calculation of household income, you might want to take note though that's 2021 only. So here's kind of how all that works out. Basically, if you had clients get unemployment compensation this year and it was kind of boosted up, I use the expression loosely that they got some government cheese right on their unemployment. That's not going to be taken into account to their household income. So again, maybe on next year's tax return, more good news for those who took premium tax credit. All right, Catherine, that's it about premium tax credit. I'll go ahead and turn them over to you for recovery rebates.
All right. So welcome this morning, and I see quite a few of you. It looks like everybody was participating in the poll, so it's good to know. We do have a few listeners out there, Keith. All right, so recovery rebates. I would say, based on what I have seen on the tax school Facebook group, as well as conversations I've had privately with practitioners, recovery rebates were the bane of our existence for the 2020 filing season. And guess what? They will still be with us for 2021. Interesting thing in your text, that note box up towards the top of page 32. In case you didn't know, recovery rebates means what we're doing when we're reconciling on the tax return compared to economic impact payments, or the advance payments that our clients received. And of course, some were received in 2020, Then they had January of 2021, and then again in the spring of 2021. Of course, many of my clients thought the January of 2021 payment was going to relate to the 2021 tax return, right? So those were the ones that somehow seemed to be a little bit tougher for me to track down. But a very interesting happening with those. So here's, sorry, I forget. I only have this one slide. So here's the thing that I want you to know. If you go to page 34 and talking about the 2021 recovery rebates specifically. So these are the ones, like I said, we're going to reconcile when we do those 2021 tax returns. And notice the difference. If you didn't think about this or hadn't noticed this before, because for many of us, when these payments were coming out, we were deep in the throes of our tax season, right? That the parents or people will receive $1,400 for each dependent. See how that's bolded? Dependent, not qualifying child like EIP 1 and 2. So, the question that came up for me is when we were dealing with EIPs 1 and 2, because they had to be a qualifying child, we had college age dependents, right, who weren't qualifying children and therefore may have gotten their own. Well, what happens for them in 2021? If they are a dependent, wouldn't mom and dad be getting that recovery rebate or that economic impact payment? So just be mindful about that. Really thinking about who's going to claim those college kids now. We do give you the AGI limits up at the top of page 35. Those are the same, but notice that the phase out happens just a little bit faster. So as you're heading into what I call planning season, so you want to be thinking about whether or not you might want to be doing anything for 2021 income in an effort to maximize those recovery rebates when the 2021 tax returns are filed. So remember, they got those payments, the advance payments, based on either 2019, if the 2020 return wasn't filed, or 2020, depending upon when you got those filed. So you have some chances or maybe some opportunities for 2021. Okay, Keith, I think this next section is yours.
It is, yeah. I've never told you this story before, Catherine, but my guy who saved the $23,000 on premium tax credit, before that law changed, he was really upset about how much money the government was giving away with the economic impact payments. He said, who's going to pay for this and how's this justifiable? And yet he was grateful to find out he didn't have to pay his $23,000 back. So
Keith, when you told the story about the $23,000 that he didn't have to repay, I immediately went to, oh my goodness, how much is the man paying for insurance?
About that much. Well, while we're on the subject of insurance, let's talk about Cobra. And you're out there thinking, Cobra? New developments? Cobra? Really? Cobra's from 1985. Keith, Cobra's almost as old as you are. Why would it be in new developments? Go to the top of page 36. Here's what changed under Arpa. Cobra Premium Assistance was made available to help assistance-eligible individuals, we'll define that in just a moment, to continue their health benefits. From April 1st through September 30th, so for 6 months, these assistance-eligible individuals did not have to pay for Cobra, which, Catherine, the one thing I always know about Cobra is it's really expensive, right? So what a boost for these folks. So who are the assistance-eligible individuals? Well, they have to meet all three of the requirements at the top of the text here on page 36. They have to be a qualified beneficiary. We'll define that in just a moment. They have to be eligible for Cobra, and they actually have to have elected Cobra. That makes sense. You're not going to get free Cobra unless you've got Cobra, right? So who's the qualified beneficiary? Well, that's somebody who was covered under the group health plan on the day before one of two things happened. Either they had a reduction in their hours, or they were involuntarily terminated for something other than gross misconduct. So basically, these are the folks who got scaled down maybe from full-time to part-time and lost their health insurance, or they're the folks who just got laid off altogether and lost their health insurance. So as long as they met those requirements, then they got free Cobra. So here's where the question comes in. Anytime that my clients tell me that they got something like this for free, I start to wonder, is it taxable? And the answer is no. Okay, so this is not a 1040 issue. You can highlight that for yourself. Second paragraph to the bottom of page 36, excluded from gross income for tax purposes. That's good. Okay, so who did pay for it? Well, perhaps then if the employer was on the ball, the employer knew that the employee shouldn't pay for it, so then they paid for it. And that's okay. If they paid for it, they're going to get their money back. It's a refundable tax credit on the 941. Now, I don't do hardly any payroll, Catherine, but one thing that I do on like the 6 941s that I file each quarter is I try to read the form and see what changed. And lo and behold, there in 2021, I started seeing this line for this Cobra credit, something or other. And it was the assistance credit, right? It's Cobra credit. So that was there for Q2 and for Q3. If your employers are doing this in-house, maybe they didn't realize that that's what they should put down. So I could see that being a likely scenario. I could see this being a more likely scenario. Suppose that you've got an employer who just rolls along doing this themselves and it's all status quo. Or maybe you, like me, don't do a lot of these and you just rolled along like it was all status quo and you took the money from the employee. Ooh, if you did that, here's what you need to know, okay? Take a look right above the note box and highlight for yourself. Employers are required to reimburse, okay? So if the employer did take money from an assistance eligible individual for their Cobra for those 6 months, April 1st through September 30th, the employer is required to reimburse. So there is no like, we didn't know about this provision, okay? Reimburse it, take the credit on the 941, even if you have to amend the 941s, get in line, right, Catherine? I feel like we're just amending about everything that we filed last year and some the year before. So, all righty. Any other questions about Cobra? Look at that notice. There's 86 questions and answers there for you. All right, the next new development, page 37, temporary special rule for determining earned income. And this kind of blew my mind a little bit, Catherine, when I saw the implications of what this rule could do for folks. Because essentially what it said is if the person's income in 2020 was lower than it was in 2019, and it cost them some child tax credit or earned income credit, because we know if your income goes too low, no earned income credit, no child tax credit, right? So if it costs them any of these credits, then they could use the 2019 income to calculate the 2020 credits. Notice how that works out for taxpayers in need here at the top of page 38, okay? Best seen through an example. So we have Michael and Flora. They have 3 children under age 16. In 2019, Michael earns $36,000, and in 2020, he earns $2,000. You can see where this is going, right? Especially if you've got a lot of clients in the earned income credit space. On his 2019 return, he would have had these huge tax credits, and on his 2020 return, he would have had no tax credits, right? Using this temporary rule, look at what his 2020 1040 looks like. And that's cut out for us here on page 38. Basically, with no income, he's able to get $8,584 of tax credit. So come out of the book with me for just a second, folks, and think about one of two things that could have happened. It's quite possible that Michael did not come to you to have his 2020 return prepared because he just used TurboTax or something, because he said, I've only got $2,000 and I can't afford my tax practitioner, right? And that'd be understandable. I think we could all figure that out. Well, if he didn't know to put in the 2019 numbers on the 2020 return, he missed this credit, okay? So I could see that happening. And then we could be in a position if he comes back now in 2021, look at what happened in 2020 and amend it. Here's the other thing that could have happened. Michael, who only made $2,000, could have made the determination for himself, I don't even need to file a tax return because I didn't make any money. And then we could file an original 2020 and imagine how good you'd feel being Michael and Flora's hero. Okay, that should be the poll question, is how do you feel now about this? But no, that's not the poll question. Go ahead and answer the poll question. All right, here's the other reason. Now, we're talking about 2020, and that's true, temporary special rule, but this actually has implications beyond 2020 because it applies for earned income credit in 2021 also. Okay, so look at these things and see what works best for you. Okay, and I think I might have misspoke there, Catherine. I think this is only for 2020 returns, but the earned income credit piece, let's talk about what changed in earned income credit. Okay, so earned income credit, again, something that maybe you have a ton of in your practice, and maybe you have none of it in your practice, right? It seems like depending on where we practice, that's the way it goes. Up where I'm at in the northwest suburbs, I kind of have what I call the best of both worlds. I have some really wealthy clients, so I got to learn all that stuff to serve them right. And then I've got some of these earned income credit folks too, and I get to be the hero for them. So the old law on earned income credit, if you don't do a lot of work in this space, this will add meaning to it. You had to be at least 25 to get earned income credit, but you couldn't be 65. Okay, once you turned 65, then you didn't qualify for it anymore. I guess the rule was stop the college kids from getting it, and don't give it to the retirees that are just working a little part-time job to have something to do. I'm guessing, right? There was also some pretty strict income level phase outs. So if you would, go ahead and grab your highlighter, go to the top of page 39, and highlight these points. Find where it says $543. That's the maximum credit a taxpayer without children could get, $543. Highlight where it says $21,920. That's what a married filing joint taxpayer could earn in income before they were completely phased out. Highlight $15,980 for other taxpayers. So your head of households and your singles, that's how much they could earn before they were completely phased out. Okay, not very much money. Here's a few, one other piece of the old law here. The investment income on the return couldn't exceed $3,650. So if somebody was the right age, if they had the right amount of income, and if they didn't have too much investment income, this was worth $543 to them on the tax return. Notice on page 39 at the bottom, or on the slide here, some of the things that changed under Arpa regarding the earned income credit. One significant one I'd like to point out, highlight there where it says the investment income is now $10,000. Okay, that was up from $3,650. Okay, so that's a good taxpayer change. And yes, I was correct. Okay, so for earned income credit in I thought I saw this somewhere. For earned income credit in 2021, you can use 2019's income if it puts them in a better position. So again, just knowing to look back and plug that in. Let's go into detail about just a couple of these other changes. Go to the top of page 40 and grab your pen and write these figures in the white space at the top of page 40. Married filing joint, $27,567. Married filing joint, $27,567. That's the new phase out, the end of the phase out. Remember, it was $21,920. Highlight for others, $21,427. Others, $21,427. And remember, on the last page, it was $15,980. Now, in that first paragraph, highlight where it says 1,502. So what we've done here is we've basically said you could make more money and still get some earned income credit. And the amount of the earned income credit that you can get if you don't have children almost tripled, went from 543 to 1,502. What else changed? Second paragraph. The minimum age of eligibility drops from 25 down to 19. And I think this is a good change, Catherine, because the old thinking of like, we don't want college students to get earned income credit, well, that kind of hurt the people who don't go to college, doesn't it? When they step out into the world, they're trying to earn and make their way through it, but they're 19, 20, 21 years old. Earned income credit can benefit those folks, and now it will, okay, because the age drops to 19. If you're attending school, though, the age is 24, Okay, so that provision's still in there. Full-time student, the age is 24. And these changes right now are only good through 2021. We'll see what the legislation does, right? All right, the other thing that changed here is if you're over 64, you also get earned income credit. So the ages are all good. They got lower, they got higher. There's no age restriction now. If you have earned income credit if you have earned income in 2021, you could get some earned income credit. All right, the other change had to do with, I think we've talked about this, Catherine, who would fit this mold? Who would have a valid Social Security number, but then have a child who does not have a valid Social Security number? We came up with just a few, right? We've got kind of like maybe you've adopted somebody from a foreign country and haven't gotten them a valid social yet, or maybe you're a green card holder and you were back home in your other country when you had your child. Well, in the old law, if you had a child on there who didn't have a valid social, you got no earned income credit. The change here under Arpa is that if those parents have valid Social Security numbers and the children do not, they can qualify for up to the $1,502 as if they didn't have children. So again, a taxpayer-friendly change. Here's one more big one. We know that there was never any earned income credit on a married filing separate return. Never had it before. And under Arpa now, we could have it on the case that somebody meets these requirements. They don't file a joint return. They reside with their qualifying child more than half the year, and they do not have the same principal place of residence as their spouse during the last 6 months, or they have a decree of separate maintenance. So what's the takeaway there? The takeaway is somebody may not meet the qualifications, the more stringent qualifications for head of household, but they could still get earned income credit now on a married filing separate return. Okay, so if that didn't apply to you, thank you for taking the deep dive with us, but that's what's new in earned income credit.
All right, so let's talk a little bit about the charitable contributions for non-itemizers. I just want you to know out there in cyberspace world, I appreciate the 3% who answered the poll question that 120% of their clients will take the new charitable contribution for non-itemizers. I also appreciate and sympathize with the 17% who say that 100% of their clients, remember, no right or wrong answer. I just think sometimes it's good to look at the humor. So the charitable contribution for non-itemizers, as we know on 2020 tax returns, this was $300 maximum per return, and it was an adjustment to AGI. Now, I don't know about anybody else out there, but this is why I appreciate the 100%, right? I had a lot of clients that qualified for this charitable contribution, especially since I have so many clients who, with the change in the state tax limitation and the increase in the standard deduction, people who used to itemize who haven't been itemizing the last couple of years. And so this was a little bit of a boost for them, right? We talk about the charitable contributions in your text on page 41. So let's talk about the new law. And in this case, we're talking about the new law under CAA, right? So CAA. So here's what's going to happen for our 2021 tax returns. For married filing joint taxpayers, they will get up to $600 of charitable contributions for non-itemizers. Notice, though, that this 2021 change will not reduce AGI. Instead, this is an adjustment to taxable income. You'll see on your PowerPoints, we have given you a cutout from the draft Form 1040, and you can see that this non-itemizer charitable contribution is down with the standard deduction. So bad news, a little bit of bad news, right? For those of us who might be in a piggyback state like Illinois, so we won't get the benefit of this $600 in Illinois this year or for 2021. A couple of other things I think are interesting. So I just want to point out the statement right above that observation box. It's kind of interesting to see that there was a little bit of teeth for the IRS, and they could charge a higher underpayment penalty if somebody misstates this charitable contribution deduction. Interesting, right? Not monumental, but interesting. So what about charitable contribution limits? So the other thing the CARES Act did under old law, and I talk about this because the CARES Act, these provisions applied to 2020 tax returns. And what you'll find in the new law, CAA extended the application of these rules to 2021 tax returns as well. So the rules we're about to cover apply for both 2020 and 2021. First of all, for your taxpayers who happen to be highly motivated to make charitable contributions, notice that that wage base went all the way up to 100, or wage base, the qualified charitable contribution base went up to 100%. And that's their adjusted gross income before NOL deductions. So you could have taxpayers who would have previously been limited to 60%, and now it's up to 100%. Notice, though, that this only applies if they are actually making charitable contributions of checks, cash or checks, right, directly to the charity. So the money has to go directly to the charity, and it doesn't include goods. So for your clients that are leaving bags of goods out on their porches for Goodwill, I know my clients all say they do, and what do they give me? You know, I got to go back and fight with them about those goods that they gave away, right?
It's always worth $500, Catherine, always.
Yeah, so the good news is, of course, they can't itemize, so I don't worry about it too much anymore. It's a wasted deduction. So in any event, though, cash directly to the charity. What this means is that if you have clients, like I have many clients who, because they can't itemize, right, because they weren't itemizing, we may have been bunching some of their charitable contributions together. And in that particular case, they didn't want to necessarily, if they had pledged $10,000 to their church for 2020 and expected to pledge $10,000 in 2021 as well, maybe they do $20,000 in 2020 to help get them up over into itemized deduction territory, right? But they give the money to a donor advised fund instead of directly to the charity. Well, those donor advised fund contributions in 2020 and 2021 will be subject to the 60% limit, not the 100%. So they're still going to get them. It's just they just don't get the 100% qualified charitable taxable income base. So, and remember too, with charitable contributions, if you have people who give a lot, really give a lot, and they get over this, you know, so they've given away more than they can deduct in a given tax year, carries over for 5 years. So at least there is some benefit as it moves on into the future. So just remember, when you start having taxpayers who are giving away lots and lots of money, they're going to fill up that 60% bucket first, and then you'll see what's left to get up over that 60% bucket. So it's an interesting computation. Just be mindful of how that's going to work. We also mention on the slide and in your text that for C corporations, the limit for 2020 and 2021 is increased to 25% of taxable income. For most of us, it's easy to remember. It's always been 10%, and now that's gone up to 25%. They've also changed some of the rules with respect to donations of inventory, particularly when it comes to food inventory. And those rules are all in your text on page 43. All right, so let's talk about, oh my goodness, I should have been moving my slides. I'm so sorry, folks. It's like a Monday morning on a Tuesday. Okay, so page 44, business meal deductions. So let's talk about business meal deductions. I'm sure most of you remember, and there is a poll question that she's about to push out, so look for that. Okay, so most of you remember, because this was part of the CAA, which was passed at the end of 2020, that says that meals purchased from a restaurant are going to be 100% deductible by businesses in 2021 and 2022, compared to the 50% limit that we had in prior years. Now, a couple of things to think about with this. One, nothing changed relative to a valid business purpose for the meal, right? So all of the same rules that would have qualified your clients for a deduction for a business meal, all of those rules still stay the same. All that really changes, it says, if they have the meal in a restaurant or if they carried it out from a restaurant, they are going to get 100%. Here's the question. Who knew that I needed the IRS to tell me what a restaurant is? I'm thinking to myself, okay, I'm pretty certain I know what a restaurant is, but we tell you there in your text, the IRS issued notice 2021-25 to help taxpayers, give some guidance to taxpayers relative to what is a restaurant. Now, it's amazing to me, even as we had discussions about this among the tax school teachers, right? The different instructors, how clever people are about what's going to qualify and what isn't. So just be mindful. We tell you in the text, and we bolded that we're looking for. We're talking about a business that prepares and sells food or beverages to retail customers for immediate consumption, regardless of whether the food or beverages are consumed on the business premises. And then they go on to tell you a few things that they would exclude. For example, they're going to exclude a grocery store, a specialty food store, beer, wine, liquor store, convenience store, newsstand, or vending machine. So the convenience store one is the one that's caused some consternation around here, in the sense that there may be some of you in communities where those convenience stores produce the best hot dogs around, and those are the ones that you like to share with your clients. All right, on page 45, we have some temporary rules relative to FSA, flexible spending accounts. This includes both healthcare and dependent care reimbursements. I know Bob, when he was teaching this morning, shared with you the changes relative to who qualifies for a dependent care credit, and discussing who may be more interested now in a dependent care credit than they would in making dependent care reimbursement account contributions. I know for me in practice, just given the area that I'm in and the clients who I have, many of them oftentimes get phased out very quickly from the dependent care credit. And therefore, I always encourage them to take advantage of dependent care accounts that their employers offered. Definitely true with respect to healthcare, right? I always tell my clients, if your employer offers a healthcare reimbursement account, you definitely want to participate, right? Because you're not going to get those healthcare deductions anyway. You'll get way more bang for your buck with the reimbursement account. So they changed under CAA. They changed a couple of things relative to these dependent care and healthcare reimbursement accounts. Now, for you, if what you do is prepare 1040s, I mean, first of all, most of these changes have, to a certain extent, come and gone. And most of the changes required the employers to make adjustments to their plans. So, for example, one of the options that we had, or the employers had, was to allow people to increase their contributions partway through the year. So in my particular case, I had used up my healthcare reimbursement account at my husband's employer very, very quickly this year. As some of you may know, or I know Keith knows this, I had a fall right at the end of January and broke both of my wrists. So while those of you were struggling to prepare tax returns in February, think back about February and March and how you would have felt if you had had splints and casts on both of your wrists, because that was me. Yes, that was totally me. So in any event, I was happy to be able to put more money into our healthcare reimbursement account. The other thing that I think is somewhat more important is that they have given us more time into 2022 to claim those reimbursements, and they're allowing the contributions to carry over into next year. It's interesting because I had a client with a dependent care account when I did their 2020 tax return and asked them about, what were their expenses for 2020. And she didn't have very many because the place where they had been sending their kids had closed down for a part of the year, wasn't available. And then, they were working from home. And so theoretically, they should be able to carry that over into 2021 and some into 2022. But my 2020 software was going to take that as it got added back into their income. All right. My final comment about FSAs. My final comment about FSAs. I am so sorry. I don't know. I'm having trouble with the slides this morning, Keith. There's an age limit relief. So if you had a taxpayer or a child who normally when they turn 13, from the day they turn 13 on, no dependent care expenses will qualify. But now they've extended it to 14. So you get a little bit more time on those for the children as they've aged. All right, Keith, now I'm really done.
Probably helps if I unmute. Catherine's got problems with the slides and I can't remember to unmute. Let's go on a trip down memory lane. Back on August 8th, 2020, President Trump was still in office, and he signed an executive order that basically said, hey, instead of taking the employees' share of Social Security out of their checks from September 1st through December 31st, leave it in there and we'll have them repay it in the first 4 months of 2021. And I think everybody who does a lot of payroll went, that is a terrible idea, and chose not to follow the executive order. However, there were a few employers out there who did, notably the federal government, right? So I know that affects Catherine because her husband works for the federal government. So this was the situation that he was in, right? This money was going to be on his check the last 4 months of 2020, and then it was going to be repaid the first 4 months of 2021. Here's what CAA did about that. They said, hey, instead of making it the first 4 months, let's make it all 12 months of 2021. So this repayment has been going on for the employers who chose to do that. Okay, here's what that means for you and I, folks. If you don't do payroll, or if you advised all your clients not to do this, you're thinking you're in the clear, here's what's going to happen. The provisions for the W-2, the instructions for the 2020 W-2s, was basically that after the Social Security from the employee's check was repaid, the employer should then issue a W-2C. So where are we in the stream of time? If this is going to be repaid in December 31st of 2021, that W-2C for 2020 is going to come out in January of 2021, or 2022 rather, the same time that they're getting their 2021 W-2. And they're going to say, hey, I got 2 W-2s. What do I need to do about this? And the good news is, in most cases, we will have to do nothing with it. Okay, here's the caveat. This is when we would have to step in. Suppose that your 1040 client had multiple employers in 2020. Now they get this W-2C that changes the amount of their Social Security. And let's say that they're over the Social Security wage base. What else is that going to change? It's going to change their tax credit for excess Social Security paid in, right? So only in that case will we have to do anything with that W-2C other than make sure that we don't accidentally add it to the 2021 return. I could see it happening in the heat of battle, Catherine. All righty. What else changed here? New development. Page 49, educator expense tax deduction. You know the one that's $250? It's still $250. Okay, so the dollar amount didn't change. I guess if you got 2 teachers married to each other, could be $500 there. So that part's still all good, nothing new. Here's what's new. Now it includes COVID-19 PPE, and that does not stand for plant, property, and equipment. Is that what it used to be for accountant brains? Now it means personal protective equipment for all of us. So masks, hand sanitizer, gloves, air purifiers. Make sure you ask your educators, did you pay for any of that? Because that can count towards the $250. My clients that are educators never needed it because they miraculously spent $250 anyway, Catherine. So they were already there without this added bit of boost. Here's what I'll tell you if you got clients in Illinois. Use this white space at the bottom of page 49. We've taught this for a few years at tax school. It's a legal double dip, okay? legal, not illegal. It's a legal double dip. If you've got an Illinois educator, that education expense deduction reduces AGI at the federal level, so they've already gotten the deduction. There's a credit for it as well on Schedule 1299C for instructional materials and supplies. So I was curious. I looked at the instructions for Schedule 1299C to see if they were including the PPE. They haven't done anything with it yet, but I'm still going to go ahead and include it. Feel free to do that if you'd like to also, okay? All right, page 50 and 51 introduces us to the money purchase pension plan. And I say introduces us because I had no idea what this was until we were preparing for tax school. So I Googled it. That's what all 36-year-old tax accountants do when they run across something new. Money purchase pension plans are defined benefit plans where the employer contributes a set percentage of the employee's salary, regardless of profitability. So why do we care, and why is it a new developments? I guess when they drafted the original CARES Act and they listed all of the types of retirement plans that could qualify for the no 10% withdrawal and that could, be paid back over 3 years and all those cool benefits, they excluded money purchase pension plans. So if you split hairs about this early last tax season, the provisions do apply retroactively. So maybe you got to go back and amend. For my part, Catherine, if it was on a 1099-R, I took it. So I think I probably took money purchase pension plans without realizing it. But what's new in EBLs, Catherine?
All right. So EBLs, you'll see we've put up TCJA. At the same time, there's also a relevant poll question for you about EBLs as well. So you might want to give that an answer. Actually, I recommend you answer the question. Any answer will do. Okay. So here's old law. So remember, this didn't exist before TCJA, right? And then in comes TCJA, and TCJA says if a taxpayer has a business loss, we're going to limit their ability to use that business loss in the current tax year up to $500,000 of loss for married filing joint, $250,000 for other taxpayers, right? So $250,000 or $500,000, and that those amounts would be adjusted for inflation. That's what TCJA told us. And then to the extent that a taxpayer couldn't use the loss in that tax year, it became a part of their NOL that carried forward. Okay. So that was TCJA. Along comes the CARES Act, and the CARES Act says, wait a second, we're going to suspend those EBL provisions. And so for 2018, which of course, by the time we knew about this, because when did the CARES Act come around, right? April of 2020. Some of you may have already, most of the 2018 tax returns were done, right? I mean, unless you were late filing. So in any event, so 2018, 2019, 2020, no EBLs anymore. And in fact, of course, the CARES Act gave us the right to carry losses back. So many of us were amending 2018 tax returns and to make sure that we picked up got rid of those EBLs, adjusted our NOL carry forwards and into 19 and 20. So that's what was happening with CARES, right? So here's the thing that you have to remember. EBLs are coming back for 2021. So if you are working on planning with your taxpayers for 2021, you've got to now begin to think about those EBL provisions again. The other thing that Arpa did was it said, okay, we're also going to extend those EBL provisions into 2026 because they would have sunset in 2025 under TCJA, but now they're actually going to extend a year longer. It's also possible, I mean, who knows what's going to happen with legislation before the end of the year, right? It is possible, though, there's been discussion about extending them on a more permanent nature. We also give you the 2021 inflation adjusted limits for those EBLs this year, 524,000 married filing joint, 262,000 for others. So EBLs coming back to haunt us for 2021. All right, Keith, What's up next?
Speaking of haunting, here's another scary memory from the days of old last tax season, right? Remember what happened with unemployment compensation last year? Well, if you're like me, you do remember, okay? We do a whole lot of volume in our office, at least by my standards. I think we prepared 725 tax returns. All but a dozen of them were done by May 17th, okay? That's just how we operate. When stuff comes in, we get it done and we get it out if we can. Well, what that meant for me is that when the law changed in March saying, hey, unemployment compensation isn't taxable, that means I had about 90 returns that I had already filed, and I said that it was taxable, right? So those direct debits were scheduled if the people owed money. The refunds were already calculated, some of them deposited by then if they were getting some money back, but not enough, right? They were going to get more. So this was a nightmare, folks. And I know it was for you too, because first of all, we waited for the law to change. Thank you, Catherine, for changing my slide. We waited for the law to change. Then we waited to find out whether or not we had to amend federal returns while we were waiting for the states to determine if they were going to tax the stuff. And it was a nightmare, right? So the question is then, do we amend or don't we amend? Okay, and look at the top of page 53. This is the discussion of our text. I'll go ahead and update it as appropriate. Okay, so when we put our text together as late as August, September of this year, we knew that IRS was going to correct the taxable amount of the unemployment compensation. You probably had a ton of this happen. It was a customer service nightmare for us because IRS would all of a sudden just deposit money into someone's account, but not send a letter explaining why, or the taxpayer was waiting while their return was like stuck in processing forever while they waited a refund. So lots of stuff going on there. In the meantime, we thought, well, maybe with this lower AGI, maybe there's some things affected on the return besides just straight tax, right? Maybe there were some additional credits like premium tax credit or earned income credit that were affected by this. So the position of our text is go back and amend to get that. Now, here's what IRS said November 1st. This came out in the IRS Newswire. There was some good news. This is what caught my eye about it. It said the IRS issues 430,000 refunds for adjustments to unemployment compensation totaling $510 million. That was good news because now maybe some of those people will stop bothering me with the where's my refund question, right? And maybe they'll stop bothering you too. In fact, they've issued over 11.7 million refunds just based on this change with unemployment. So huge issue. All right. Here's what they said in this Newswire also. They started with the simplest returns and then went to the more complicated returns. And I said, what? I thought they were just adjusting for unemployment, but they weren't. Okay. Here's what they're saying now. The IRS is going to make corrections for earned income tax credit, additional child tax credit, American Opportunity Credit, premium tax credit, and recovery rebate credit amounts affected by the exclusion. So if you're thinking, oh, wow, that means more direct deposits with no notices, think again, folks. It's worse than that, okay? It's worse than that. Because here's what else they said. The IRS will be sending notices in November and December to individuals who are affected by these changes. The notices are not confirmation that they're eligible for these credits and will require a response from the taxpayer, and the taxpayer will ask you to respond for them, okay? Will require a response if eligible rather than filing an amended return. That's all I know, folks. They don't say in here whether the response is going to be written or whether you're going to have to call some number that they don't answer, but they're going to require a response. Those notices are coming out now, November and December, basically alerting these clients to the fact that they may be eligible for some of these deductions and credits. If you've already amended, you've already amended, right? I don't know what to tell you beyond that other than make sure you're charging to respond to those notices, okay? Because it's not your fault. All righty. We're going to go ahead and leave unemployment behind now. Our practitioner planning tip at the bottom of 53 says make sure that you're aware of the states that your clients are in and how that unemployment exclusion applies there, because they were all a little different. I know I had a client in Ohio. It was like a 4-step process. If they had it, I was grateful they didn't have unemployment. So that was good. All right, page 54 then. Let's talk for a moment about idle loan forgiveness. What we're talking about here is the idle advances, right? So those idle advances were between 1,000 and 10,000. We weren't really sure if that was going to be free money or not. We thought it was, but then CAA clarified this should not be included in gross income. No deduction or business expenses disallowed, no tax attributes reduced, and no basis increase denied. So that was like a big taxpayer win. Okay. You know who else there was a taxpayer win for out of CAA and then later out of ARPA was the restaurants, right? The restaurants. So ARPA created something targeting them called a Restaurant Revitalization Grant. And notice the dollar amounts. Was it between 1,000 and 10,000? No. Grab your highlighter. Look at the bottom on page 55. Giving them funding for revenue-related losses up to $10 million per business, $5 million per location. I don't have any restaurant clients, Catherine, but I would have loved to have told them about this last year, that they could get that kind of government cheese, again, not required to repay. They would get to deduct their business expenses, increase their basis. Who is they? Who are we talking about? Page 56. Restaurants, food stands, food trucks, caterers, taverns, basically everywhere we like to go and eat and drink, right? That's all. They were all included. Their funds could be used for any of their operating expenses, is all good, except look at the bottom on page 56. After an overwhelming response to the Restaurant Revitalization Grant Program, the program closed on May 24th. I would say it probably opened on May 24th, wouldn't you think, Catherine? For as much money as was involved here, and those clients could go out and grab it. If your client was one of the lucky ones, treat it like an idle advance or like a forgiven PPP loan, okay? Because it's exactly the same thing. All right, Catherine, I think you got farming, unless you have something else to say about that.
No, so on page 57, we do mention in your text about modifications to farming losses. Here's the thing. I want to draw your attention to that note box at the bottom of the page and just cross-reference in your text to the farm chapter in both our 2020 and our 2021 book. And don't forget, there will be that ag webinar. So you'll be able to get Bob Ray's take on the NOL modifications for farmers. So, all right, Keith, that's it. That's all I have to say about those.
That's more than I know about farming. So we do appreciate all of you, though, who work in that space with the ag tax. And obviously, it's a big part of our tax school. So, yeah, please make sure you tune in. I'll go ahead and take a little bit of a skim here through disaster-related tax relief, okay? Disaster-related tax relief that came out of CAA was for disasters other than COVID. And we have to kind of make that distinction because a lot of these disaster relief provisions out of CAA remind us of all the stuff that a lot of us saw for the first time during COVID, right? That was the first time that I ever saw somebody take a retirement account distribution that was under 59.5 and not pay the 10% penalty. Is definitely the first time that I'd seen somebody be able to repay their retirement account distribution over 3 years or stretch the income out over 3 years. This actually is what gave birth to ERC. Disaster-related provisions were in place and gave a form of ERC, certainly not as good as the one that we've been talking about for COVID in terms of the dollar amounts, but it was there. So what types of disasters did this cover? Well, notice in your text, CAA, page 58, it covered disasters between the period of January 1st, 2020 and February 25th of 2021. So I looked on the IRS website, what disasters happened in that time period? Well, there were earthquakes in Puerto Rico, tornadoes in Tennessee, serious storms in Oregon, Mississippi, South Carolina, Michigan, fires in California, all of those disasters would count for some of these provisions here. So we're not going to take a deep dive into the text like the author does, but just know that if you've got a client that was affected by a natural disaster, this would be where you want to look to see what kinds of provisions were made available to them. And we're just going to cherry pick a few of the more unusual ones. So page 59 has an unusual one. If somebody took a distribution from their retirement account, it wasn't just that they lived in that area. Okay, one of the qualifications is that they actually had to have sustained economic loss. Okay, now there was at the bottom of page 59, kind of another neat little trick here. If somebody took a distribution to purchase or to build a home in one of these areas that was then affected by a disaster and they decided not to build, they had until June 25th of 2021 to repay that money as if it never happened. Okay. So those were all good changes. Again, there's more in the text relating to taking loans from retirement plans, ERC that was available in 2018 and 2019 in some of these disaster areas. This was kind of a fun perk over on page 61 too, Catherine. You talked earlier about how C Corps, right, could take a charitable distribution of 25% of their income, their taxable income. Well, if they made a qualified disaster relief contribution, it'd be 100% of their taxable income. Folks, make sure you answer the poll question. Okay, so what constitutes qualified relief? Again, bottom of page 61 in the text. And that reminded me of like when I went and did some hurricane relief work after Katrina 16 years ago now. Anheuser-Busch, Catherine, donated a bunch of cans of beverage to us down there. Wasn't beer though, it was Anheuser-Busch water. And I thought this was really nice of them to do that. And now that I've chosen this as a profession, I think, that was still nice of them to do that, but I bet that they got a tax break for it too, right? So in this case, though, these CAA rules, they had to give some money, but all good changes there.
Hey, Keith, I'm thinking in 16 years ago, it's probably a good thing it was only water in those cans, right? You might not have been old enough to legally drink beer then. Thought.
I went down there over winter break and over spring break, okay? And I turned 21 a month before I had gone. So I was tasting beer for the first time down there in Mississippi and then later in New Orleans.
So, the other interesting thing about the provisions that you've talked about, Keith, is and you told us right at the beginning, it was disasters up through February 25th of 2021. And we've had a bunch of disasters since then, right? Hurricane Ida seems to have affected, I don't know how many different people all across, up and down the East Coast as well as down in the Gulf Coast. And so I'm wondering, right? I think that we'll get some extension of these provisions to those disasters as well, right?
Yeah, I certainly think so. And it seems like that's kind of the problem. The disaster happens, and then Congress needs to figure out how much they can afford to give up tax-wise to help these folks, right? So it becomes an issue that pulls through the legislature. And I think we do have one positive change in the right direction comes out of the infrastructure bill that will likely be signed into law. And that's regarding disaster relief. It was kind of just one nice little provision. Again, not certainly the extensive ones we've discussed, but one change that's going to happen here is there'll be an automatic extension of certain deadlines for taxpayers affected as soon as it becomes a presidentially declared disaster area. A 60-day extension, I think, is what we saw there. So that basically then if your house, if you're in California and your house gets burned down in March, let's say, well, your due date wouldn't be April, it would automatically be extended, and then they could extend it even more once they figure out how they're going to structure the legislation, right? So good changes all the way around there for folks affected by disasters.
Yes. And so my final comment about the disasters is that, as I've mentioned, ones that have happened since February of this year, those should be covered with an omnibus budget reconciliation bill that will likely happen before the end of this year. I'm trying to think. I want to say they're extended right now. The federal budget got extended until December, right? But the potential for a federal shutdown looms because they're going to have to agree on that budget bill sometime before then.
Yeah, good point, Catherine. All right, we'll go ahead and leave disasters behind. Again, we're going to look at another piece of new legislation that could affect your 1040 clients, okay? It's on page 63, Emergency Financial Aid Grant. CARES freed up a lot of money, government money, federal government money, for higher education institutions. And they could use that money to support students with their expenses and financial needs related to COVID. That was CARES. The question is then, if the higher education institution gives a grant, an emergency grant to the student, is it taxable? How does it affect their 1040? Notice what CAA did on page 63. Go to the middle of the page. These grants should not be included in gross income. So that's good, not taxable income to the student. But then I'm thinking, well, maybe it's treated like a scholarship, and maybe you're thinking that too. But don't think that way, okay? Because the second point is also it should not be treated as a scholarship. Therefore, it would not reduce the amount of education expenses that could be used to qualify for the American Opportunity Credit and the Lifetime Learning Credit. So that's good for us to know if we have a client then who tells us that if they're the college student, they'll tell us they got the grant, or maybe the parents are telling us, hey, my kid got this grant. If it was an emergency financial aid grant, then no change to the 1040, okay? Literally, again, free money. Now, don't confuse that with other types of grants. That's the point at the bottom of page 63. This exclusion does not apply to amounts for teaching, research, or other services being provided as a condition of the grant. So if you've got those types of graduate students, they're still on the hook for that as taxable income.
All right. So, I want to comment for a second on this poll question, because I thought it was kind of interesting that about 60% of the people who are with us today have not had reason to file NOL carrybacks. And I'm thinking some of you may be like some of my clients. The NOL carryback years perhaps weren't sizable tax years, right? So maybe they didn't pay a lot of taxes in those, and they're thinking about tax liabilities going forward and elected to carry forward only. So just kind of interesting. But in the text, I digress for a minute. On page 64, we mention minimum low income housing tax credit rates. So there's a lot of information there. And here's the thing about low income housing tax credits. For many of you, the only place you ever see them is on a K-1 because you have a 1040 client who has invested in a low-income housing project, right? And what's happening is you have what was about a 9% rate in some cases is now being dropped down to a 4% rate for certain types of housing. The impact for this will be to those people who actually develop low-income housing projects, because how they do their financing will shift. They've always used those tax credits for financing purposes, and now they will have less credit in some cases to push out to their investors, and so it may be a little tougher to attract that money. All right, we also talk on page 65 in your text about a change that was made to residential rental depreciation. If you'll recall, under TCJA, there was a limitation on business taxpayers, large business taxpayers, right? So they had to have over 25 million in average annual gross receipts. And those taxpayers would have been limited to their business interest deduction, 30% of their adjusted taxable income for the business. There was one little catch in there, and that was for real property trades or businesses. They could avoid the 30% business interest limitation and instead elect to depreciate their property using ADS lives. And for residential real estate, that was a 30-year life. But with TCJA, the 30-year life only applied to residential real estate placed in service after 12/31/17. So along comes CAA, and CAA expanded the provision for residential real estate and said it will apply to residential real estate, the 30-year life, even if it was placed in service before January 1st, right? And we give you the requirements there, those bullet points on page 65. Just remember, it will have an impact for a taxpayer who elected out of the business interest limitations and had rental real estate that was placed in service prior to 1/1/18. That will be a good result for them. Keith, I noticed in our text that we have some provisions that have been extended. Do you want to tell us about those?
Yeah, I was all excited when I saw some of these permanently extended provisions until you ruined it for me, Catherine, because you reminded me that permanent doesn't exactly mean permanent. It just means there's no set expiration date now. But of course, we know all these provisions are subject to change. So just a few good permanent changes here, quote, permanent changes. Medical expense deduction reduced from 10 to 7.5%. I don't know why my clients care, Catherine, but I field a dozen calls in January about whether or not this is 10% or 7.5%. I just tell them, give me your medical expenses and you'll get what you get, right? But when you do want to answer someone's question, it's like, is it 10? Is it 7.5%? How old are they? Because some years that mattered. We had like a split rate. So good to know, 7.5% until further notice. The other thing I noticed that was a real good change here is that the tuition and fees deduction is gone. It's giving way to revised income limitations for the lifetime learning credit. So I would have this quite a bit, actually, where I had taxpayers who were American Opportunity, American Opportunity, American Opportunity, American Opportunity. Then they had one semester left that was going to be lifetime learning credit, and they'd get none. And I go, what happened there? Well, the income limitations for lifetime learning were lower than AOTC. Now they're going to be one and the same. So if you qualified for one, you qualified for the other. So two good changes. You got a poll question there, folks. Lots of other good changes if you have clients in the beer, wine, and spirits industry. My goodness. Seems like every provision was for those. A couple other provisions temporarily extended, meaning that they are given an expiration date. Page 68, you might want to highlight work opportunity tax credit. And you probably got an email about the work opportunity tax credit, WOTC, from tax school yesterday. The tax school blog this week is about work opportunity tax credit. Good credit there to help disadvantaged folks get employment. So if you got employers, maybe they want to look at some of these different classes of people to see if they can get some tax credit for it. The other thing that I've always thought was good, and I'm glad to see it's still around, excluding from gross income the discharge of qualified principal residence indebtedness. So talk about kicking someone when they're down, if they've lost their house and now they have taxable income too. So that kind of segues nice into what Bob and Jerry are going to talk about with financial distress. Two more quick points on page 69. Treatment of mortgage insurance premiums as qualified residence interest. Again, that was an on-again, off-again thing for 2021. It's on. Non-business energy property, there's our credit, our little $500 credit for doors, windows, insulation, etc. Again, still on there for at least another year. So, Catherine, that's everything the book has to say. I think you've got some new ledge not in the book that you want to let everyone know about.
Yes, thanks, Keith. Just a couple of things that I want to point out. So I start here. You have a PowerPoint slide for the PTE. That's the pass-through entity tax. So for those of us who are participating today and are in Illinois, this is a relatively new phenomenon, right? So our legislation was just signed this past summer. Many other states across the country have already enacted provisions about this. The idea is to try and provide some state tax relief for business flow-through entities who would otherwise be, the owners would be subject to a SALT limitation, right? That limitation of $10,000 as an itemized deduction. So, and I just want to mention too, as a reminder for you, the tax school will be doing in January an Illinois update webinar. So that's going to happen in January. Keep your eyes out for information about that. I do know the one other thing that Illinois, for sure, the one other thing Illinois changed was to decouple from bonus depreciation. So that's something else we'll be looking for on our 2021 tax returns. So sorry, I digress. So this pass-through entity tax, the idea is I give you an IRS notice that's up there on the screen that was issued in 2020, right? And the idea was that there were a lot of states that were already looking at this. How can I allow my business owners to get a state tax benefit for the tax dollars that they're spending on their flow-through entities? So let me talk about how that's going to work. We've given you the Illinois Public Act, and so far we have relatively little information from how the state of Illinois is going to put this onto forms for us, right? But here's the idea. Assume for a moment that you have an S corporation taxpayer, and let's assume that it could be multiple owners. We'll assume one owner. And page 1 shows ordinary income of $100,000, okay? And we know that $100,000 is going to flow through, be subject to tax at the individual level, and they're going to pay state income tax on that. So what this PTE says is we're going to allow the S corporation to figure out the Illinois state income tax on that, 4.95%, not changing replacement tax, okay? That's not changing, but at least the 4.95%. And we're going to allow the entity to take a deduction for the state income taxes that it's paid, the $4,950 on that $100,000, and then that net of the $95,000 and change is what's actually going to flow through and be taxable to the individual shareholder. Couple of things to think about. That $4,950, if you're a cash basis taxpayer, probably needs to get paid before December 31st, and then $4,950, depending upon the marginal tax rate for your individual taxpayer. If it's, 20%, you're only going to get a 20% tax benefit at the federal level, maybe not that big. And remember now, their income for purposes of QBIT has been reduced as well, so even lesser. So I would say, at least in practice, you're really looking at large taxpayers. So like I think about a couple of clients I have that have significant income, okay, so multi-millions. And then I also think about some of the partnerships or the law firms, for example, where the law firms might have a significant bottom line. They may not actually benefit much from QBID because of the fact that they're a specified service business, right? And so this deduction may be more worthwhile for them. A lot of things to take into account. Remember, I think about my individual taxpayers that are business owners. They've been making their quarterly estimated payments. The business is going to have to pay in this tax potentially before the end of the year to get the benefit this year, but my individual taxpayers won't be able to get that money back until they file their tax return, which you guys know for me might not be April 15th, right? So they may be waiting a while. I'd probably have to get them filed sooner this year. So anyway, a number of things to think about when it comes to that PTE. All right. Notice that the draft 1040 form was released back in July. You can actually Google that and see what the 1040 form is going to look like for 2021, or at least what the draft form looks like. Interesting, they continue to play with the question about virtual currency. And we noticed that, at least as part of the infrastructure bill, right, they're trying to reshape how those cryptocurrency transactions are reported. So, the IRS continuing to try and wrap its head around how they're going to chase after those cryptocurrency transactions. All right, my last comment is to continue. We just have to continue to follow the Build Back Better. So the second piece of the legislation that the government's been working on. I will say that it appears, at least the most recent iteration of this, as the president has proposed, seems to be pulling back some of the taxes on lesser people, right? So they're really looking at most of the provisions are going to affect taxpayers that have income north of $10 million. So for those of you who deal with the really, really wealthy, It may apply to some of your clients. I don't have very many, and I may only have one, I think, that would even get close to that. So I think that some of those provisions, there are some things that they will keep, but many will start to disappear. But we'll be tracking it, and who knows where we're going to get with that before the end of the year.
But now we're going to go to Chapter A2 on financial distress. That's going to take us all the way up until our stopping point for today at 12:10. And so we will be done at 12:10. We will probably not have announcements at 12:10 unless there's something really earth-shaking that Gina thinks of between now and then. She has that, of course, prerogative to do that. So we will continue our discussions tomorrow morning at 8 o'clock with the the rest of our day one. It takes us 2 days to get through day one, but that's okay. Anyhow, in Chapter 2, starting on page 71, we've got this is a timely topic, I think, with the pandemic, with the how taxpayers were affected. I'm sure there's a lot more of them who are in financial distress. So we've got various topics that may apply to them. We will spend most of the time under canceled debt, and you see different subtopics under canceled debt. And we'll spend a good amount of time on bankruptcy. Bob's going to be covering that, and I found that I really learned a lot about bankruptcy rules from this particular text and Bob's interpretation of it here. So I think that'll be, hopefully that'll be valuable for all of us here. And then a few other items as we go through, ending with some alternatives to bankruptcy, some of the things that the IRS has made available to our clients. Anyhow, so let's go ahead and get started on page 72. And, we are probably one of the first people who may be able to tell that a client is in financial distress. We may be aware of it, maybe even before they are, but there's some signs. If it's a client that you only see once a year, well, then maybe not so much, but clients that you're working with on a regular basis, you may see some changes that weren't really happening before. And some of the warning signs we're showing there on page 72, they're getting slower in paying their bills. Of course, hopefully not slower paying your bill, but just in bills in general. Maybe they're not really sure how the company is doing. They're getting late on their payroll tax deposits or some other governmental payments. They don't have any money left to write themselves a check, or they're holding checks because they can't be cashed currently. And maybe they're receiving information or letters from creditors. And as I mentioned before, with the IRS, you may be a part of that because you will see that they're getting notifications from Illinois Department of Revenue, IRS on payroll type of returns. Some of the other signs at the top of page 73, their attitude is changing. Maybe there's some other signs there, some personal issues, increasing some interest payments. Their financial ratios are not quite as good as they had been. And in the planning tip there on page 73, yes, we are accountants, but we're kind of taking, in these instances, maybe a few of the characteristics of a counselor, because they may ask you what all they can do. They want help from you. And of course that, I assume that we're not trained for that. But we can maybe help notify them if you're seeing something in their business that is showing some signs that maybe there are some issues there. And we've got a couple examples on page 73. First, in example 1, we talk about Mary sells a lot, who's a real estate agent. And Bob, I think if I'm selling my home, what better person to list it with than Mary sells a lot? I mean, that's exactly what I'm looking for.
Probably a lot better than her cousin Mary sells a little. So yeah, this is one you'd want.
Yeah, I think I think this particular one. Yeah, I'm gonna talk to her. So we tell you here in example 1 that she's got 175,000 of payroll. Oh, and by the way, we have our first poll question of this chapter is up on your screen. And taxpayers who are having financial difficulty, what should they do? And we've got various choices there, all interesting choices in their own right here. So please answer, give us your response for that. We'll have more as we go through. Anyway, getting back to Mary, she's got 175,000 of payroll on her S-Corp return, but 100,000 of those checks have not been cashed. And she's telling you that she says, I don't have the money to both pay the payroll taxes and cash the checks. So Cynthia, which is us, advises Mary reduce the payroll, amend those previously filed tax returns for those amounts that are never really going to be paid, and try to make some changes going forward. Okay, that is her S-Corp. Now in example 2, we now get to her 1040, and we see some other issues for Mary, that she didn't make her fourth quarter estimated tax payment. We see that she's got a second mortgage out there to cover credit card payments, and maybe even those first 3 quarters of estimated payments that she was able to make. So, there's a lot of different signs, and it does, we can help our clients by, trying to steer them maybe to some options that they might have. No one answer is going to be right for everybody. So, maybe they could talk to some of their creditors. You might advise them to do that, making a payment plan with the IRS, things along those lines. And we'll go through various other different issues and maybe some planning as we go along. So, Bob, our first, other topic here on page 74, dealing with canceled debt. We're going to talk about a lot of different things here. Why don't you start us out with talking about SBA loans here?
All right, Jerry, on page 74, this canceled debt is really the all-encompassing notion about having a liability that gets paid by someone else other than the borrower, and when and if that might create some taxable event. So on page 74, we describe the very basic economic concept that we don't have taxable income when we borrow the money because we still have an obligation to pay that back. So we don't have any economic benefit to us. So there's no taxable event that occurs there. And as Jerry described, the financial distress sort of setup to the chapter, every time he was describing that, I kept thinking about, well, I wonder what that balance sheet looks like. I wonder what their income statement looks like. I wonder what their statement of cash flows looks like, because as the accountant and tax trained people, we're accustomed to looking at the numbers and the forms, and hopefully that gives us those clues about what their financial condition might look like, in addition to what their tax return looks like. But we're basically deciding here on whether they have a change in net worth to determine if they have any taxable debt discharge. If there's no change in net worth, as our first example, or as our first description says, probably no taxable event. But then they have a loan that's paid off for them, and that liability disappears off their balance sheet. Well, their net worth did improve. And I think, Jerry, that's the most difficult thing for us to explain to taxpayers is, well, I didn't get any money. Why do I have any tax liability or taxable issue? No money occurred, Jerry. That's a hard one to explain many times from us to the taxpayer.
Well, yes, and I think the issue that I've found with clients when they come in with 1099-Cs, which we'll talk about a little later on, is that the creditor is forgiving part of the loan, and they really don't tell the client that it's not necessarily a free lunch there, in that there's a possibility there's going to be some effect on their tax return and some additional taxes will be owed.
This was another very unique piece of the pandemic economic stimulus pieces on page 74, the SBA loan forgiveness. And you see the different types of loans on our slide, but these were loans that were in place before March of 20, generally, these were loans that were in place for working capital, building facilities, buying equipment that businesses had through SBA long ago. And what the CARES Act provided in March of 20 was for the Small Business Administration to essentially pay themselves, pay the interest, the principal, any fees for up to 6 months for these loans that were already in place and had been dispersed before September 27th of 2020. SBA made those loan payments for the taxpayer borrower. Now, there were some monthly caps on how much those were. In my mind, it seems like it was an $8,000 or $10,000 monthly cap. So it wasn't all debt, but there was some subsidy provided. What then we worried about, well, what's the tax implications of this activity for those SBA loans to be paid for the borrower? And the Consolidated Appropriations Act said all these loans, even after September 27th, if not fully dispersed, are in this program, and they are going to qualify for some very favorable treatment. Now, there are different types of SBA loans, and different types of tax treatments apply, and different types of debt forgiveness was available. So we don't cover all those pieces. But what we wanted to really drive home here was this point on the slide on page 75. Even though SBA made the loan payments for the borrower, it's not taxable income to the borrower. It's not canceled debt. It's not CODI. It's not discharge of indebtedness income. It's just another stimulus program that's treated as a non-taxable benefit to the borrower. And even further, the expenses paid, I would say here, on behalf of the borrower by the SBA through that loan program, those expenses remain fully deductible. So SBA made my principal payment for me, not taxable. SBA made my interest payment for me, still deductible by me. The best of both worlds. Notice 21-06 gives us a little more guidance about this very unique treatment of several months of my SBA loans being paid. So that's another question we'll be asking our clients. Did SBA make any loan payments for you, and why? Well, we want the balance sheet to properly reflect the decreased loan balance that SBA paid, and we'll have income on our books not subject to tax as the offset, and we'll still have an interest expense that we can deduct. So that's the question we're asking to find more deductions for the clients. Jerry, there's also some distinguishing features on the different types of debt that might be involved in some type of discharge.
Well, yeah, there is, Bob. And I always like when the IRS or anybody defines something in this way. And we're on page 75. We're going to differentiate between recourse and non-recourse debt. And first we tell you, well, if the taxpayer is personally liable for that debt, it's going to be recourse debt. And non-recourse debt, maybe this is Captain Obvious here speaking, is debt that is not recourse debt. I mean, that makes perfect sense, right?
Yeah,
So,
I guess I just have to get one of those definitions right, and then I automatically know the other. I appreciate the simplicity there.
Yeah, so the other one just falls into place. And this non-recourse debt was a lot bigger. I know back in my days when I was with the IRS, dealing with tax shelters where taxpayers had debt that was non-recourse. And, so why were they able to increase their basis and get deductions for debt that they never really had any risk of paying back? So you don't see a whole lot of non-recourse debt out there anymore, but there is a difference. And we're going to be dealing here with recourse debt. And here's the general rule that when recourse debt is canceled, generally it's going to be income, ordinary income to the taxpayer. Now, what is one of our main rules when we're dealing with tax law and tax law general rules? And that is that there's going to be a lot of different exceptions to those rules. Non-recourse debt generally isn't going to be taxable unless the lender keeps the collateral and reduces the amount of the remaining loan. But getting back to recourse here, again, the general rule is that it's going to be taxable. Now we're going to talk about exceptions and exclusions, a couple different ways that debt cancellation will not be taxable to the taxpayer. And more of the time, we're going to talk about exclusions, but I do want to mention the exceptions there on page 75. Certain items are specifically excluded from income. They talk about gifts and inheritances. If there is in a will, it says, well, okay, now once I pass away, then my daughter, for instance, isn't going to have to pay back this loan. So I pass away, the loan gets canceled. That is specifically excluded from income by law. Certain other qualified student loans, other debt that if the cash basis taxpayer was paying the debt would be deductible to them. And when we deal with the Form 1099-C, we need to determine if there is interest in there that had the taxpayer paid that would be deductible for them. That will be an exception to that general rule. And also the fourth bullet point there about purchase price reductions given by a seller. So there's these exceptions. Also, and this is where we're going to spend most of our time here, these exclusions shown on the bottom of page 75, dealing with, and it says here on the screen and in your text, Title 11 bankruptcy proceeding. Don't confuse that with Chapter 11 bankruptcy filings. Bob's going to talk about various chapters within Title 11 and how those will be affected here. So we've got those, we've got insolvency, which I'm going to cover, and a few other bullet points there. Also, we've got a polling question out there dealing with what's not an exclusion for debt forgiveness. So I guess, we're kind of giving away the answer. Just look at the screen up there. Hopefully we'll help you out there, even though, of course, there is no really, it doesn't really matter if you get them exactly correct or not.
Yeah, open book questions are certainly valid here on during tax bill. No problem, Jim.
Yeah, and of course I always liked those. We're just trying to give you a little help here.
And I think you grade on a curve too, don't you, Jerry?
Yeah, I think so too. So
that's good.
Yeah. So there's a nice table on page 76 that you can use dealing with the various exclusions that we've got up on our screen, on our text, that has the requirements for the various exclusions, some of the limits. And I guess the key that I want to bring out on that table on page 76, all of them have reporting instructions or reporting requirements on Form 982. So that form is going to be critical if the taxpayer is trying to exclude debt cancellation from their income. This Form 982, and we're going to see a couple of these, talk about these as we go through here. It will tell us how much of that, indebtedness that's been discharged is not going to be income, and what we might have to do about it if there are some attributes that need to be reduced, as we mentioned also in that table on page 76. So the planning tip on page 77, I've already mentioned before about the 1099-C. You may assume that there is a taxable income out there, and it may very well be the case, but we'll need to go through the various exceptions and exclusions to see if the taxpayer qualifies. I know I had a client had come in, she had a loan that was forgiven, and the comment I mentioned earlier, she thought that she was going to get a fresh start because this debt was canceled. And, then she brought that 1099-C into me, and we didn't find a way to exclude this. And it ended up, she had a pretty substantial tax liability. And so she was, I guess, disappointed, might even be understating it. She thought everything was free and clear. Now she's got a large tax liability on your 2020 tax return. So, it's something like I said, I wish that they would be getting the whole story, but I guess, our job is to tell them the effects of what all they have done. So again, general rule, it is going to be income unless there is an exception or an exclusion. And a lot of times, if it's related to a business, it's going to be shown on a business form. Otherwise, it might be shown as other income on Schedule 1, line 8. So on page 78, here's a sample of the 1099-C at the bottom of page 78, if you haven't seen those before. A key item on this form, if you look down at the very bottom of the form, is in box 6, where it shows the different codes that actually gave rise to the 1099-C. These codes, we show them there on page 79. And the most common ones that I've seen in my experience, probably number one is letter F, just an agreement between the creditor and the debtor to cancel the debt. I see this with credit cards, with car loans, things like that. But also another common one is code A, dealing with bankruptcy. And I know, Bob, if you've got some comments here, go ahead and throw them in, and then we'll, I'll have you dig into some of the bankruptcy rules on page 79.
Yeah, I would agree. In my experience, that's what I've seen as well. The F and the A are the two primary ones that happen more often. On the residential side, it seems like there might be a few more foreclosures that might be happening as opposed to a bankruptcy proceeding. So if you have the qualified principal residence, I wouldn't be surprised if there's a code D in that 1099-C that those come along. So Jerry, you probably don't see too many of those on an annual filing season or even over a 10-year period. Not many, but it's important when they do show up that we get these correctly stated and reported on the return, because IRS will be, as with other 1099s, matching these up and looking for that information to be reported someplace. And what we'll see during this process, as Jerry alluded to on the 982, is it's generally income, but there's ways to exclude that from income. But if you do that exclusion, you're going to give up certain things and pay more tax later. So at the end of that cycle, canceled debt's going to result in either income presently or loss of some attributes that will generate more income later, most likely. So let's dig into a little brief review of the different titles of Chapter 7 bankruptcy and what those mean for our tax planning steps. So Chapter 7 is the first one we describe on page 80. Chapter 7 is known as the liquidation type of bankruptcy. We're going to sell assets, pay off debt. If there's some debt left after our collateral's gone, we're going to ask the bankruptcy court to have that eliminated and give the taxpayer borrower a fresh start after the Chapter 7 bankruptcy liquidation is completed. On each of these sections over the next few pages, we give a few pieces about whether we're creating a new estate, whether we need a new EIN, and how tax filing goes on. So for Chapter 7, the way that piece works is we're going to set up a different bankruptcy trustee, or estate, I should say. It gets a new ID number. It's a separate entity. We're essentially creating a new business activity and putting our assets directly over from the individual to Chapter 7 in a tax-free exchange. The debtor remains liable for filing their individual tax returns, paying taxes on their income outside the bankruptcy estate. And we're not going to get any deductions that happen inside the bankruptcy estate or related to that process. Chapter 11, different, and I highlighted at the bottom of page 80, footnote 25. Footnote 25 describes USC 11, and that's the United States Code, which is the overarching set of rules under which the different Chapter 7, Chapter 11, 12, and 13 chapters reside. So Chapter 11 bankruptcy is not the same as Title 11 proceeding, which is the definition we see on Form 982. Chapter 11 bankruptcy is a reorganizing process. We're going to perhaps liquidate assets, pay off some debt, revise our business plan to improve our cash flow so that any debts that continue on are able to be paid in a timely, perhaps extended, perhaps reduced interest rate fashion. But our cash flow will be critical here for getting a Chapter 11 bankruptcy to be successful. Under the Chapter 11 bankruptcy, we also notice it is a separate bankruptcy. A state is created, a separate entity, gets a new EIN. The bankruptcy trustee is heavily involved in filing all the activity inside the bankruptcy estate. The individual might have things outside the Chapter 11 that they will still be responsible for. And we use this term, debtor in possession, which means the business debtor possesses the property, but that is sort of the clue that they are involved in a bankruptcy proceeding, again, to reorganize their business. Chapter 12 is also a reorganizing bankruptcy provision designed only for family farmers and fishermen. They have a debt limit that's at the $10 million level. If your debt's over that and you want to reorganize, you're going to be in Chapter 11. The Chapter 12 bankruptcy rules are very favorable to the borrower in that they have a lot larger stake in how their creditors are dealt with in the bankruptcy proceeding, of course, under the guise of the court and under the guise of the Chapter 12 bankruptcy trustee. The plan is going to be developed by the bankrupt individual and is going to be presented to the creditors, but the creditors don't have as much of a say in approving a Chapter 12 bankruptcy cash flow plan as they do in a Chapter 11 reorganizing bankruptcy plan. These are usually 3 to 5 years in repayment. The debts will be adjusted to reflect cash flow. We might sell assets to get debts down to resize the business, and that's okay. And even in Chapter 12, as the court cases have emerged over several years, there are today some major tax benefits of Chapter 12 bankruptcy when we have sales of assets occurring at taxable gains. Those are able to be placed into the bankruptcy cash flow process as essentially an unsecured creditor and paid out over time instead of taking a priority claim and making a Chapter 12 reorganization plan harder to do. Now the new rules will make that reorganization plan easier to do. The Chapter 13 bankruptcy, also reorganizing my business. If I'm an individual or sole proprietor, or maybe I'm just an individual wage earner, all of those are eligible for Chapter 13, reorganizing, repay my debts over a 3 to 5 year period. These have a requirements to participate in credit counseling. They also have debt limits at the bottom of page 81. Secured debt, $1.2 million. Unsecured debt, $400,000 of limits. Now, secured and unsecured debts are treated differently in the debt limits. They're also treated differently, as Jerry described, the recourse and non-recourse debt for discharge amounts. Chapter 13, again, reorganizing, but for smaller sole proprietors, mostly for businesses. In Chapter 13 and Chapter 12, there is no separate taxable entity created. The individual is going to continue to file under their 1040 return, and they're going to keep doing that even after the bankruptcy is initiated. On page 82, a reminder about a good new rule here about adjustments to income. In these deductions that we list that are involved in administrative expenses or other costs related to the bankruptcy proceeding, accounting, attorneys, court costs, maybe appraisal fees, they're going to be deducted now in Form 1040 Schedule 1 as an adjustment to income. In older years, these were treated as an itemized deduction and not that valuable of a tax deduction. But with some recent rulings, some as recently as a couple of years ago, we have learned that these types of estate administrative expenses, not only for bankruptcy proceedings, but also decedents' estates and trust administration, those are allowed as a more favorable adjustment to income, Schedule 1. So these are very helpful to get these tax deductions to clients in a more favorable way than we used to do. One of the real pieces about a successful bankruptcy filing is to make sure tax returns are filed fully before the date of filing and also during the bankruptcy period. If returns are not filed before the bankruptcy case commences, those types of tax liabilities get a higher priority and are not as easy to deal with. And if we don't keep filing returns, the bankruptcy trustee or the type of bankruptcy, a creditor, could require the court to convert the case from a reorganizing bankruptcy to a liquidating bankruptcy, or maybe even have the case dismissed in total. Neither one favorable to the client. On page 84, and on our slide, we describe this very special election in the year of bankruptcy that's worthy of some planning prior to filing the bankruptcy petition. Look what happens here under this 1398 special election. You're allowed to close the tax year at any date of the current calendar year. And that results in the taxpayer having 2 short tax returns to be filed for the year. So let's say I filed bankruptcy today. My first short year ended yesterday, and I would file a 1040 return from January 1 through November 8th, reporting all of my normal income and expenses that I would generally have during that 10-month time period. My second short year starts today and ends December 31 of 2021. And the reason I'm doing that is perhaps I have some solar energy credits I haven't used yet. I have a passive loss that's still on my books. I have a net operating loss that's on my books. I can use those things up on my first short year where I individually am still the filer, and I burn those up, or use the phrase harvest those tax attributes, and they do not then continue over to the bankruptcy estate. So they favor me, they disfavor the bankruptcy estate, but I'm allowed to do that to give the individual the best possible answer before filing. Otherwise, those tax attributes could be lost, or they could be consumed to pay off debts that might not otherwise be due and payable in full. So it's designed to be a debtor-friendly, taxpayer-friendly provision. Jerry?
Bob, I wanted to interrupt here just to make sure everybody was aware of the polling question that's up there on 1099Cs. And in my mind, there's only one good answer for this. Whenever one of the choices is, it depends, then you know that's going to be the one that I gravitate towards. And actually, as of right now, about 2/3 of us have agreed with that. I just wanted to make sure that you were aware of that, Bob. So then when you're weighing your answer, you know which one you might want to have.
Yeah, it depends is always a good answer, and the leading vote getter as well. We're going to go forward to page 85. Here's an example 5 on Riley, who files a Chapter 11 reorganizing bankruptcy petition on June the 5th, makes advantage of this 1398 2 short year elections. The first short year ends June the 4th with the return due date of October 15th. The second year, the other 7 months of the tax year still ending December 31. Why did she do that? Some good planning let her harvest some tax attributes before. Discharge of debt, which we want to dig into a little deeper here. And under Chapter 7 any debts discharged are going to be non-taxable first because we are in a bankruptcy proceeding. And so we are dealing with both, is the debt discharged at all? And if it is discharged, is it taxable? And our slide on page 85 and the next few pages describes certain tax debts that are not dischargeable. And eighth priority claims, more about that in a minute. If I haven't filed a return yet, not dischargeable, which means that's going to be my liability individually after my Chapter 7 is completed. If it was a late return or a fraudulent return, those will not be discharged during the course of a bankruptcy filing and will follow me outside of bankruptcy, not give me the fresh start I was hoping to do. So our summary to that strategy is this on page 87. If you know clients are contemplating any type of bankruptcy proceeding, be sure they get their returns filed in advance and be sure they keep filing during that bankruptcy petitioning period. Not only does the statute of limitations unlimited, but they have this problem about unfavorable treatment inside the bankruptcy proceeding. The Chapter 11 discharge, it works just like Chapter 7. Those debts need to be incurred prior to filing the bankruptcy petition so they don't follow me outside, and I can get those inside my bankruptcy plan for more favorable treatment, either as a discharge or as at least a scheduled longer-term repayment plan. In Chapter 12, that, again, we haven't created a separate entity here, so those debts are going to stay with the individual, but the debts I have before filing can be placed inside my plan, a part of my cash flow, and once the court discharges all of my debts in the plan, I can have those removed from my ongoing liability. Chapter 13, and Jerry, I'm going to ask you to talk a little bit about the one here, the very first one, where the debtor might be liable. But as you're prepping for that, again, we have the same things here: non-filed returns, late filed returns, fraudulent returns. Those are not dischargeable in even a Chapter 13 bankruptcy proceeding. They will follow you after the bankruptcy. But Jerry chatted just a little bit about these withholding taxes when a debtor who doesn't even own a business might have some surprising liability.
Well, yes, if there are payroll tax debts out there, the IRS is going to be looking for anybody who could be considered a responsible party. And as you said, it may be somebody who is not the business owner. And we've had cases in the Rulings and Cases chapter in prior years where the accountant may even be that person if they have control over making the payroll deposits and chose not to pay some other debts instead. Then there may be some fallout. And if they're liable in some capacity, then those taxes won't be dischargeable under the Chapter 13.
Very good. Thanks, Jerry. Well, these are the eighth priority taxes I mentioned briefly ago. They're described in more detail on page 88, but these are taxes that existed before the bankruptcy case was commenced, before the petition was filed, and within 3 years before the filing. These have a higher priority. Withholding taxes that Jerry just described, these would be those same type of trust fund taxes that an individual might be liable for that is subject to a higher priority. The employment taxes of the employers making payments, again, these are those same type of trust fund taxes that get a higher priority of being paid. They can be paid out of the bankruptcy estate assets. That's what we would like for them to have happen, but they're going to be paid after the secured creditors are paid first, and any other higher priority claims are paid second. Then we're going to dig into these eighth priority claims. What happens many times is once the secured creditors are paid, there's no more ability to make any payments. In a Chapter 11, these eighth priority claims can be put into a payment plan over a 5-year period, still paid in full, but paid over 5 years. In a Chapter 12, we can make payments over time in the 3 to 5 year Chapter 12 reorganization plan, again, established by the debtor without a lot of input from the creditor. And Chapter 13 filers also can make these tax payments over a few years as well, but they are still a liability to be incurred. And Jerry, I ask you to chime in on this question as well about a tax debt versus a tax lien. So once we've determined a tax debt, meaning I owe $5,000 of payroll tax, the IRS might come in and establish a tax lien to further shore up their position and where they rank in priority. Jerry, in your IRS days, I know you really weren't a collector, so to speak, but you did probably see this in revenue side of dealing with taxpayers having to deal with tax liens along the way.
Yeah, these may be a debt, as you mentioned here on the screen. The IRS has already assessed the liability with a statutory notice, something along those lines. They've already asked for the money. They haven't got the money in time. Now they're filing a lien. And so I would see that perhaps if I was doing an examination, and because the taxpayers filed an amended return, for instance, saying this amended return will take care of most of my tax debt, so the taxpayer will ask me, well, I want to have that lien removed because I'm not able to get financing, things along those lines. And so I could make recommendations to the revenue officer or in collection, saying that, yeah, their tax liability is going to be reduced because of this amended return. There might be other instances as well, but that's the main one that comes to mind.
Thank you, Jerry. All right, let's get into a few more pieces about these tax debts and liens. The bankruptcy discharge of income tax eliminates the personal obligation to pay the tax. Filing these liens, those are going to be recorded against the property, just like a security interest from a lender would be recorded. So everybody will know that there's an IRS tax lien on that rental property if it's expecting to be sold. Filing these returns by the bankruptcy estate, once bankruptcy has concluded, you're going to get returns from the bankruptcy estate because we need to know what was left inside that estate that's going to come out to the individual. Is there a different depreciation schedule? Are there any net operating losses that might be available? So this is a time where the bankruptcy estate filer, if that's different than you, the individual 1040 filer, need to get your heads together to see what's available. Well, you had to do that at the beginning of the process too, because if the individual had an NOL, that would have to be known to the bankruptcy estate filer. So here, the 1040 and 1041 filers are going to work together to know what's remaining to carry from one group to the other. Well, another big piece of the debt cancellation process is what do we do about tax attributes? And page 89 begins our discussion about all of these pieces, which are generally designed to, again, delay the recognition of income, delay the recognition of tax liability, but not necessarily allow that to be fully eliminated. So if debt forgiveness is excluded from income or canceled in debt or insolvency or in any other way that Jerry described those exclusions earlier, we can avoid putting that debt forgiveness on the current year return as taxable income. Great news at that moment. But we have to reduce certain tax attributes which have the long-lasting effect of causing more taxable income, more tax liability in the future. The Form 982 is where we do that process, and it prescribes this order of reducing the tax attributes. Net operating losses has always been at the top of the list. Those get eliminated first because those carry over directly year to year without any reduction and have a really high tax value. So we're going to give those up first. So if I have $30,000 of debt discharge in bankruptcy, I'm not going to report that as income, but I have to reduce my NOL by $30,000, which causes me to pay more tax going forward. I have to do a similar thing for business credit carryovers, R&D credits, solar credits, any other type of investment type business credits are going to be reduced going forward. Minimum tax credits get reduced if I'd paid AMT in a prior year. I'm going to reduce my capital losses. Well, that one might not be so critical because I can only consume $3,000 of those anyway. So I've always thought it would be neat if I could move those up on the order list and use those up before I used an NOL, but I can't. They go in this order. Next, we have basis. I have to reduce basis in my depreciable and non-depreciable property, meaning if I have a $30,000 debt discharge in bankruptcy that's forgiven or that is non-taxable, I have to, under this scenario, reduce my undeveloped land basis by $30,000, or the basis in my crane by $30,000, or the basis in my commercial building that's being depreciated by the same $30,000, and reset my depreciation schedule. Now, I do have a choice that I can move this one up higher on the list and reduce my basis first before having to give up my NOL. Why would I want to do that? Well, let's say I want to preserve my NOL for income next year that I'm going to have post-bankruptcy, and I'd rather reduce basis in my farmland today because I never expect to sell my farmland, so a low basis doesn't mean anything anyway. That could be a reason to move the basis order up higher. Well, there's a few more things that could be reduced. Passive losses, foreign tax credits are specifically stated as other items that could be reduced. Now, I never have to reduce those attributes any more than the amount of the debt that I'm excluding from gross income. That's the biggest attribute reduction that has to happen. And NOL has some certain specific issues here in the bankruptcy filing. The debtor can't carry that NOL back from years ending after bankruptcy to any year ending before the case began. The estate has an NOL. That doesn't transfer to the debtor. The bankruptcy estate carries that NOL back to the estate's previous activity. These attributes are reduced dollar for dollar on tax attributes that are really deductions, but they're only reduced 1/3 for every dollar if the attributes are really credits. You calculate your tax for the year, you make these various tax attribute reductions, and we reduce those credit carryovers in the order that they're prescribed on Form 982, and we make those reductions first in the year of the debt cancellation. Again, don't forget about this option to maybe reduce basis first, depending on the different mix of assets the taxpayer owns. Basis reduction might be a more critical first step. This page describes our balancing and limitations. We're reducing these the year after the year of debt cancellation. They're applied to all the property held at the time of that reduction, and we're not going to have any more reductions that exceed the total amount of debt cancellation. Various other rules we describe on page 91 that are going to work our way through. One of those being we don't have to reduce our basis if it's in exempt property, meaning my personal residence exclusion, and the other limitations. We describe these going forward on Form 982. And we also put this second bullet point, I think, is a critical step, that if we had to reduce our basis because of the tax attribute requirement, and we later have a sale of property, the portion of the gain that would have otherwise been capital gain is now converted to ordinary income to the extent of the basis reduction I had to make because of my debt forgiveness. So all of these rules are laid out so that going forward, this Form 982 that describes why we have debt reduction, describes the amount of our debt reduction, and then in Part 2 describes the various tax attributes we have reduced. All of these are meaningful going forward so that the taxpayer will have less attributes, less deductions, less basis. All of that really means more tax liability going forward. And Jerry, the final comment I would make about this is remember in your tax software too, make those attribute reductions such that your NOL gets diminished, your basis gets diminished, so that you have the right answer going forward that matches what you're reporting on Form 982. All of that is the bankruptcy part of debt cancellation, Jerry. The next box to check is insolvency that you'll lead us through.
Well, yes, and that's starting on page 92. Again, this is another exclusion item, and insolvency is when the total debts exceed the fair market value of the taxpayer's assets, then they are insolvent, and they may need to compute that if they're using this exclusion to not pay tax on some cancellation of debt. And there's a nice worksheet for us in Pub 4681. That's what the IRS is going to be looking for to see if they agree with the computations that you make. So we've got a couple examples here. The first one at the top of page 93, example 8 with Barry Bondsman. He has $15,000 in credit card debt. I would say, Bob, that is a giant amount of debt. So
yeah, I see what you're leading up to here.
Okay, there you go. So he's got a 1099-C with $15,000 of canceled debt income. We tell you his total liabilities were $100,000. His assets are only $45,000. So he is insolvent, in the amount of $55,000. That's more than 15. So in Barry's case here, his Form 982, he will check the box on line 1B on Form 982, discharge of indebtedness to the extent insolvent, not in a Title 11 bankruptcy case. And then in line 2, he's going to show the amount of the debt that is going to be excluded from gross income. And because he is more than $15,000 insolvent, he's going to exclude the entire amount on line 2.
I think for Barry, this would exhibit a home run, don't you think, Jerry?
I'd say it probably does. So, let's move forward to page 94. Look at Evan Rodriguez here. He has some credit card debt. He gets a Form 1099-C. One other point I want to mention about these 1099-Cs. Often, if it is a joint debt, both spouses will be issued a 1099-C for the entire amount of the debt. So there's going to be some, we're going to have to make sure the IRS is aware of that if some attributes are being reduced, then, there's only one debt, even though there were two 1099-Cs that did that. In fact, I have a client now, we've been going back and forth with the IRS for a while. She got a 1099-C on her former husband's debt. And so we've been trying to get that, reduced. And actually it wasn't until we were down the road a ways before she told me, oh, by the way, we filed Chapter 11 bankruptcy. I said, well, that would have been nice if you'd have told me that ahead of, up front. And also with that, I think most of this was student loan debt, which now I'm looking at current law where just about every student loan that's being forgiven is not going to be taxable income to the debtors. Anyhow, I just wanted to bring that out, that there may be two 1099-Cs for the two spouses, whether they're still married or whether they're divorced and two separate taxpayers. Anyway, getting back to Evan here, he's got a he has a 1099-C, $20,000 here from the Ranger Card Company. His liabilities were $62,500. His assets were $50,000, so he is insolvent by $12,500. Now, the debt forgiveness was larger than that, so when he fills out his Form 982, he's only going to be able to exclude $12,500. He's going to check the box on line 1B, and then on line 2, the amount that he's going to be able to discharge is $12,500. Why is that? Well, once that $12,500 is excluded from income, now he is even. He's not insolvent anymore. So what happens to the other $7,500 of debt? Well, he's going to have to pay tax on that. And in example 9 here, we show you his part 1, line 8 is the cancellation of indebtedness that he's going to have to include in his income. So, that's how these particular rules work in the area of insolvency. Bob, you're going to tell us about a couple other.
Yeah, I'm just looking at this one. It just seems like Evan can't catch a break here, Jerry. So we're going to talk about qualified farm indebtedness on page 95. This is one that has some unique provisions. We identify on the screen here a ARPA enacted program that USDA pays up to 120% of the loan balance. That's really going to be treated as a different type of ag loan or an ag program payment, not really a debt discharge. But that whole piece is put on hold pending some litigations about the application of that rule. But we also have this unique piece about other qualified farm indebtedness that says you can't exceed your attribute reduction by your adjusted tax attributes and your basis of qualified property. So in addition to being either bankruptcy or insolvent, qualified farm debt has one other type of exclusion, as does the qualified real property business indebtedness has to have is eligible for a different type of ability to exclude debt discharge from income in addition to bankruptcy and insolvency. In both of those, they sort of end up with some basis reduction amounts initially, instead of having to fully exclude or to fully report canceled debt as gross income. Jerry, we mentioned student loan cancellations in new developments briefly, but this will take us a little deeper into when these may or may not represent taxable income.
Yes, and we've got 3 different bullet points there on page 97, that there may be some exclusions there if the loan cancellation is due to some specific employment. If it's because of death or permanent disability, the example that Bob gave us during new legislation earlier. And we've also, we've got another poll question out here dealing with student loan repayment plans, which we've got a little bit of information coming up here about that. Some student loan repayment assistance will also able to be excluded. But also take a look at the box note on page 97. Look at all the different changes and modifications in this area over the last couple of years. Some of these are just what I call kicking the can down the road, but all of the student loan relief, where payments didn't need to be made, interest was not accruing for a period of time, those periods of time were extended by some other provisions. I had very few clients who had any student loan interest to deduct on their returns. In fact, I have to remind myself that once 2021 comes through, if they're making those payments again or in any future years, make sure, because there wasn't any deduction in 2020, we need to know when that starts up, how much there might be. So just look at all of those different measures, extending due dates, extending deferral periods along those lines. On page 98, with some of that student loan debt being canceled, there's a couple requirements. They have to be a qualified lender. I don't think that's going to be real difficult to to prove. Most of the ones I see are the U.S. Department of Education, maybe Navient. There's a few others, I think Discover. There's various ones out there. I'm hoping that isn't going to be much of a problem. And hopefully the eligible financial institution isn't either. And that seems relatively straightforward. However, as we tell you above the box note on page 98, the educational institution has to have a regular faculty and actual classrooms. So those schools that are 100% online are not going to be able to meet these. Schools like the University of Illinois that has lots of online classes, but they do have actual classrooms. I've seen them. If we had windows in this room we're in, we could probably see some of those from right here. But the qualified lenders, we also have there on page 98. Page 99, dealing with student loan repayment assistance. There are tax-free benefits from employers. The CARES Act made this available for the last 9 months of 2020. CAA extended that through the end of 2025. There can be $5,250 per employee toward eligible education debt that are not going to be included in the employee's income. They're not debt forgiveness income that the student has to pay tax on. The only catch is the student won't be able to deduct the student loan interest because the payments were made by the employer. And that's only, I guess, fair. I hate to use the words fair and tax law in the same sentence, but it really is. So on page 100, a little bit about income-based student loan repayments. This is what our poll question is asking us here. Have you had married clients decide to file separately to take advantage of these income-based student loan repayment programs? And almost 30% of you have said yes. We show the different types of plans there on page 100. But the key here in this particular area, I guess a couple of them, one is once this repayment term under any of these programs is done, then the rest of the student loan debt is automatically forgiven. But keep in mind here too, with the amount that needs to be repaid under these programs, if it is based on a joint return, then joint income is used. If they're married filing separately, then only the debtor's income is included here. So it's not an ethical dilemma. It could be, and I think we're going to talk about that a little bit in the ethics presentation, but it may be advantageous. This isn't exactly income tax, but there may be a little bit of additional tax to pay under the married filing separate, but it'll be more than offset by the now lower student loan repayment program payments. And that's what we talk about in the planning tip there on page 101. So there's a lot more to it than that. And like I said, it looks like some of you have already taken advantage of that. So just be aware of that if your clients are participating in any of these programs. I'm going to skip the example on page 101. Bob, I'm going to toss it back to you to talk about some of the other provisions here.
Very good, Jerry. I'm kind of flipping through a couple of slides about the qualified principal residence indebtedness that has its separate set of exclusions. A couple of good examples on pages 105, 6, and 7 that describe how the qualified principal residence indebtedness can be excluded from income and maybe even insolvency if that might occur. I'm going to jump forward to page 111. Excuse me, a couple of brief descriptions about foreclosures and repossessions. The foreclosure is essentially the same thing as a sale. And page 111 describes our calculations of gain or loss, no different than anything else. It's the amount realized over basis or the amount realized under basis, determining that gain or loss piece. As Jerry described earlier, we have to note if we have recourse or non-recourse debt. Generally, these are going to be recourse debt scenarios. And so we will have the lesser of the debt before the transfer or the fair market value will be our beginning point to determine the amount realized. In the rare case where you have a non-recourse debt, the full debt amount is the amount that's going to be realized. We have some good examples on these pages too that describe what happens to both the debtor and the creditor in a repossession. So example 15, Jeff has a race car that's a hobby activity. The car is worth $3,000, but he owes $10,000 against it. The bank repossesses the car and forgives the $7,000 loan. So we know he's going to get a 1099-C for the $7,000 amount. We know it's a recourse debt because there was collateral, and he has a non-deductible $17,000 loss because it's a hobby, not a trade or business, and he has $7,000 of cancellation of debt income that has to be looked at. Was he insolvent? Was he in bankruptcy? And if it was excluded from income, we reduce his tax attributes. Installment sales can have a similar calculation about gain or loss. And remember, on installment sales, we're considering what was the gross profit percentage as an applicable piece. And so here's the other side of Jeff's deal with the dealer's gross profit of 30%. And what do they end up with? They have a loss of $5,000 on this repossession to the dealer's side of this example. We have a real property example that also is reported for Benny in example 17, who sells his property to Matt, and then will end up getting this property back. He had a $5,000 profit at the commencement of this activity. He's going to get the property back as the repossessor, and Benny has taxable income on these worksheets that provided in the IRS publications of a $2,700 gain. And Gina's giving us a repossessing poll question. And then we're also going to look at what is Benny's basis. This worksheet also calculates this basis for Benny going forward. And we're also going to look at what might have happened if it was something that had been abandoned and a 1099-A is delivered to the taxpayer with a $60,000 loan, but a $100,000 mortgage balance. A few more examples as we work our way through those abandonments, Jerry. But what I really wanted to highlight in that kind of quick run through the foreclosure piece is pay attention to those worksheets that exist in those IRS publications. You really have to walk your way through the steps of those worksheets. And when you do, you end up with a clear answer to both the debtor and the creditor on the impact of those foreclosures and repossession processes. But, usually you're probably not going to be dealing with both sides of that activity, but it's easy to walk through those and see how those different activities look. Jerry, we want to begin a little discussion about some alternatives to bankruptcy when tax debt occurs. And the first one are these installment agreements. And I'm sure you've seen many of those in your career. It's Form 9465. There are reasons we might apply for these. But Jerry, what is the success you've seen with clients on using installment agreements, either from your IRS career or your current practice?
Well, I think with my clients now, I've been surprised at how low the payment amount is for some of these installment agreements. I've been a couple clients, I've had power of attorney and called the IRS, or they've gone through, and it's really been surprising how low the amount is. And of course, that sounds great. Then as I think about it a little bit further through, these installment agreements, I think the IRS uses having this debt paid over a 6-year period. So think about that 2020 balance due could be in there for the next 6 years. And I think we all probably have clients that have a balance due every year. So once they get a new balance due, they fold that into their existing installment agreement. And it just seems to me like an endless circle, but it does keep the taxpayers, quote, in compliance. It keeps them from having the IRS file liens as long as they're making their installment agreement payments. Of course, in these days where different correspondence to the IRS is maybe they're crossing paths with each other, amounts that are paid aren't posted right away. So there are some unique challenges there.
Some taxpayers might have a larger balance due, and if they do, they might not get the automatic installment payment treatment. They might have to also file Form 433A or B, which is just more detailed financial statement information about asset values, debt values, income, and expense cash flow values for that client. This is generally an online activity. You'll get an immediate notification it's been accepted. You can have a less than 120-day plan or a more than 120-day plan. If you're looking for that, your debt limit can't be more than $50,000. These are great for sole proprietors, independent contractors who file as individuals and either as wage earners or someone who has an unusual income item that generates an unusual tax liability. Lets them make payments over time, and as Jerry said, be in compliance. Business plans are easier to file if the balance due is under $25,000, and so one of the strategies might be to encourage your taxpayer to pay down their debt to get to one of these levels that is easier to get qualified for an installment agreement. And if we can't get an installment agreement, Jerry, or maybe we have one, but we want to dig deeper and try to wipe out the debt, starting an installment agreement might be step one, but the offer and compromise might be step two for certain clients, Jerry.
Well, yes, and the things that the clients need to keep in mind, they watch the TV commercials or they hear the commercials on the radio to settle this for pennies on a dollar. And of course, that sounds really good, but there are sets of rules that the IRS is going to look at. And I had a client who was talking about an offer and compromise. In fact, the one who had the debt forgiveness that I mentioned earlier in the chapter. But I took a look at her return and I said, well, you've got a substantial W-2 income here. The IRS is going to look at the financial position of the taxpayer to see what the chances are of actually collecting that debt. So we look here, well, maybe the IRS is saying, well, the amount of this debt may not be totally accurate, and they don't have a lot of income, they don't have a lot of assets to pay that amount due, or there is some sort of economic hardship. And what we have for you here, a couple items, we've got about 2 minutes left here, Bob, is that in the offer and compromise, the IRS allows you to account for an amount for living expenses. There are some standard amounts from the table on page 121, which can be entered, and the IRS will accept those. And also, there is this pre-qualifier tool starting on page 122 with example 21, where we've gone through the various screens and where Joe, in this case, Joe the plumber, goes through this qualifier to see if he might be a candidate for offer and compromise, using, of course, the information to the best of your knowledge to see if an offer and compromise is there. Sometimes the taxpayers will be charged to file this OIC. There's a lot of people who do this for a living, and so you don't want to go through, get your hopes up, and then find, well, you don't qualify for an offer and compromise, and then everything's gone for naught. So if you haven't gone through the pre-qualifier, then take a look at example 21 we have here. Bob, we're just about ready to adjourn here. Any final comments?
The final comment I would say, a successful OIC applicant will be a person who has limited net monthly cash flow and very limited equity in any assets as compared to what their tax liability will be, because it's going to be a combination of net equity plus their monthly cash flow times a factor, and that will be the minimum offer that the IRS will be accepting.
Catherine and I have you for the first 55 minutes today, and I am going to talk to you passionately about a subject that I am passionate about, representation before the IRS. And let me tell you why I feel this way. Well, first of all, what is representation before the IRS? This is when we're talking about helping clients who are in exam, which under audit, or in collections, which sometimes in the CPA community is referred to as controversy work, right? We've got some type of difference here between our client and the IRS. How do we help them out in this situation? Some folks out there, like myself, actually seek out this type of work for non-clients. So we're not preparing the returns, but clients come and find us for this. And we've got lots of magical little tools in our toolbox that we can use to help them out of a tight spot. You're going to find out about some of those tools today. Why is this so important right now? Well, there is a tax gap, an estimated tax gap, meaning the difference between what the Internal Revenue Service actually collects and what they believe is owed to it, of $600 billion with a B dollars. The other thing is legislation seems to suggest that the IRS is going to be getting some money, and they plan on using it for enforcement and for building new and better computers that'll help to match up things that are filed on tax returns. So if there's more audits, then that's going to be more audit work, and that's going to result in more collections work. Another reason I'm passionate about it is because I'm on the younger side, right, of a tax practitioner, and I've heard something for the last 15 years that I've been in business. I've heard that the 1040 work that I love so much is going away. And I have seen market share change a bit as more and more people do their own taxes. Here's what else I've seen. Every time someone does their own taxes, they usually make some mistakes, especially if they're trying to do something more complicated. So for all of those reasons, I believe that representation has a glorious future, and I'm happy to be able to talk to you with my friend Catherine about this today. So if you would, go ahead and open up to the text. We're going to start on page 132, and I would like to introduce you to a character you're going to see woven throughout our chapter, Paul No-Filer. Notice example number 1. He's a self-employed landscaper, visits a local bank to borrow some funds. The bank tells him, "We'd love to lend you some money, Paul, but we got to see 3 years of tax returns first." And he says, "Yeah, I'll go get those." And then, doesn't tell them he really doesn't have any tax returns, at least not for the last 10 years, right? So if it wasn't the bank, how would people find out about Paul? Or, well, notice what could happen. Example number 3, page 133. It's possible that the IRS would send him a letter or send him a revenue officer to secure these unfiled returns as well. So in either case, maybe Paul is looking for a little bit of help, okay? And he finds that help, if you go with me to example 4 on page 134, by scheduling an appointment with Sue Ketchum. Now, Sue's going to also be woven throughout our chapter. She's a really good example of how to help somebody through IRS representation. So he schedules the appointment with her, asks her if she can file the returns, say, "Hey, I got a meeting on the books here with IRS." And notice what she does right away that's very, very important. She makes no guarantees. She makes no guarantees. She responds by telling Paul she's going to discuss the situation with her boss. She doesn't own the practice. Maybe she uses a line like I use, which is, folks, it's got to be win-win or it's lose-lose, right? So if this engagement isn't a good fit for one party, it's not a good fit for either party. So not making any promises, that's where we leave off with Sue and with Paul. So the author does a little bit of a dive here into some penalties. We're not going to be able to cover everything in detail that's in the chapter. So what Catherine and I are doing is just kind of picking up the most important points, some of the best bang for your buck, if you will. And that's why at this point, I'm going to go ahead and turn it over to Catherine for client engagement letters.
All right. Thanks, Keith. And yes, welcome everyone to the second half of your day 1. I know we didn't make announcements today, so just a reminder, if you need the agenda, you can find it in that handouts tab. And as you may have noticed, we will again be pushing out poll questions, and we will try and let you know when those pop up. All right, client engagement letters. Now, I know that many of you, because I know I've been teaching tax school for a while, and we have talked about engagement letters many, many times through our ethics presentations. And so I know many of you out there use engagement letters, especially for your tax compliance work. I would say it's not unusual to see those engagement letters being generated by your tax software. And those are great for compliance work. But if you are choosing to represent a client for something beyond their tax compliance work, you should be thinking about a separate engagement letter to cover that topic. Okay. So, and we mentioned in your text there that practitioner planning tip on page 139. Making sure that you're also mindful of any other requirements. You know, Keith, you said CPAs refer to this as controversy. And when you said that, I thought to myself, well, I don't know, sometimes controversy seems to be what happens between me and my clients, not necessarily between my clients and the IRS. Okay.
That's the importance of engagement letters too, right, Catherine? Solve
That's
the
exactly-
controversies, head them off.
That's exactly right. So anyway, make sure that if you are a CPA or an attorney, that you are mindful of any other requirements that could apply to your engagement letters. So you see, we talk about 4 key items in a representation engagement letter, and those are bullet pointed for you at the top of page 139, and then discussed more fully in the next couple of pages. A couple of things that I want to mention about those. So the scope of the engagement, it's important to identify exactly what controversy you intend to cover. So for example, if you are doing an IRS audit engagement, if you're representing a client for an IRS audit, you want to make sure that you say that, and that it doesn't include IRS appeals, for example, right? So if it's for an IRS audit, that's what your scope is. Unless, of course, you intend to do all of that, in which case it's fine. Just make sure you're clear. The downside is if you fail, or if you if you're not specific about the scope, then you can get into what I lovingly refer to as scope creep, right? So the client expects you to do something beyond what you thought was you were responsible for. Responsibilities and requirements. We talk in detail about those on page 140. The importance of this is making sure that the client in particular understands what you're responsible for, more importantly, what they're responsible for. If you've told them that they have to supply certain records and they have to do it within a specific period of time, it's important that you lay that out so that you can hold them accountable for making sure that that information is prepared for you within when you have asked for it. We have a practitioner planning tip down at the bottom of page 140. And so you may want to take a note in that. And again, making sure that everybody agrees what an acceptable settlement might be. So again, if you're in an IRS audit, making sure that you have identified what would work for the client in terms of a potential settlement. All right, let's see what else I want to tell you. So fees. Many of you who have heard me speak before, we talk about fees over on page 142, and you know that my fellow instructors think that fees are the most important thing that happens in my office. Well, I would like to suggest, I am in business to make a living, so I do like to get paid for what I do. Well, in an engagement letter with respect to an IRS representation matter, you want to make sure that you've got those fees and your payment terms laid out in that engagement letter. In a lot of cases, Keith will tell you, he'll actually take a retainer, what he calls a retainer. I refer to it as prepaid fees. As an attorney, I'm careful about not identifying something as a retainer, because in the attorney world, retainers are client money until you've earned it. And we have special rules with respect to how we have to keep track of that. That's why attorneys have trust accounts, because that's where retainers go until the money is earned. So just, again, make sure that that's laid out for your client in your engagement letter. The final thing on engagement letters, the last point down at the bottom of page 142, is making sure that your engagement letter is clear about what would cause the end to the engagement, right? When's it going to terminate? What circumstances would result in you being disengaged from the job that you've been hired to do? And there can be plenty of things that could happen. For those of you who are sitting there thinking, okay, so my tax software is not going to generate this engagement letter, where am I going to find one? We have included in your text on page 143 a sample engagement letter with respect to an IRS audit. Okay, so just something there to use. For those of you, for example, in my practice, I have the AICPA recommended E&O insurance, and they provide me with a website where I can pull sample engagement letters for lots of different topics. Your first poll question of the morning is being pushed out, so make sure that you answer that. And then take a look at example 7 down at the bottom of page 144, because in example 7, Paul, he is now, so Sue has talked to management. Everybody's agreed that Sue is willing to represent Paul. She prepares an engagement letter, and look at the terms of her engagement. He needs to provide her with 10 years of bank statements, and he's going to agree to allow Sue's firm to reconstruct income and expenses. Notice that she's going to charge $250 an hour, and she wants $2,500 up front. So she wants 10 hours prepaid before she's going to start the engagement. And Paul has to sign this engagement letter and a power of attorney, and then make sure that that $2,500 retainer is paid. So a really good example of what you would want to do in this representation engagement. So Keith, how should we be communicating with the IRS?
Yeah, that's a great question, Catherine. I was really encouraged to see the results of the poll. Did you notice that 70% are using engagement letters? I would assume mostly referring to their tax preparation, because if the question is about IRS representation, you should 100% should be using engagement letters. There's no two ways about it. I mean, we'd recommend that for tax preparation too, of course, but very, very important information you just shared. Here's some more important information. So this comes up sometimes, more so I would say in the audit space, right? You might get an information document request, or what's referred to as an IDR. And here's what you need to know about that. When the IRS makes a proper and lawful request for records, and we're in the text on page 145 if you want to follow along there, you have to promptly submit the requested information if you have it. If you don't have it, then you have to just let them know, I don't have it, right? And you have to let them know who does have it, which is usually going to be your client, right? So you do have to reach out to the client for that information, but you don't need to reach out to anyone else. So if there's some information that you don't have and the client doesn't have that they're asking for, you just tell them that much. And if information's been given to you, you also aren't responsible for verifying it, okay? So sometimes we think that, well, that's great. If I take on the power of attorney, then my client, the IRS can't contact my client. The buck stops with me. Well, guess what? If you ignore them, they're going to talk to your client. Okay. So make sure that you're responding to them in a prompt way. All right. Let's talk about a few different types of representation. I'll go a few different types of authorized representatives, I'll say. Okay. And we'll look at the value of each starting on page 146. So the first one we mentioned is third-party designation. You might not think you know what third-party designee, but then, you might be mistaken. Sometimes we don't know what we don't know. This is something that's on every tax return that we prepare. And you probably, when you originally set up your software, if you're the one setting up your firm's software, you probably put a name in here, a phone number, and a PIN number, and then just clicked a box that said, throw this on every tax return. I know we do that in our office, and I'm the guy. I'm the third-party designee on every return. You're saying no, Catherine.
I know, I disagree with this because
Uh-huh.
if you look at what the question says, they're asking the taxpayer whether or not they allow. And so in my practice, I have a question on my organizer. And if they don't mark that question, yes, I don't fill in this box. They haven't agreed to allow me to answer those questions. So, listen, I just think that we may want to ask before we fill it in.
Okay. Yeah, no, fair point. Fair point. These are the many things, folks, that I learned from Catherine from teaching with her. So she's making all of us better here. I do take third-party designee. I'm glad that I did do that because this year I was able to solve a lot of, I'd just say, customer service issues because of this. I'd call the practitioner priority service, and the first question they would ask, are you the third-party designee? This lasts 1 year from the due date of the return, and it kind of just lets you talk about what's on that tax return. So I use this year to talk about recovery rebate stuff, estimated payments, economic impact payments, all of that kind of stuff without having to go the extra mile and submit any additional documentation. The next step that we would use, if we do need to step up a little bit, would be Form 8821, which is our tax information authorization. We have a copy of that in your text on page 148. It's a very simple tool, just kind of has the client's information, your information, what years and what tax forms it covers. And it just allows you to do a little fact finding, I would say. And I use it at the beginning of a potential engagement. So if a client comes to me, says, hey, I'm getting these IRS notices, I owe money to the IRS, I haven't filed returns, anything like that, step number one, they're going to hire me to do a little bit of discovery. And I'll use Form 8821 to go out there and do the discovery. And what I find more often than not, Catherine, is that my clients lie to me, okay? And they don't do it maliciously. It seems like a lot of times clients lie because they just don't understand. You know, my clients get a notice from the Illinois Department of Revenue and they tell me they got a notice from IRS, right? Or they'll tell me that they didn't file a 2018 return when it was really the 2019 return that they didn't file. So Form 8821 is really useful to go out there and just kind of confirm all those facts. Now, after that, if they decide that they're going to engage me, and if I decide that I'm going to take the engagement, then I'll kick it up a notch one more time with Form 2848, which again, we have in your text on page 150 and page 151. The first thing that you'll notice is that this is 2 pages instead of 1 because it gives you a whole lot more authority and it gives the client more options as to how much authority they're going to give you. So automatically with a 2848, you can speak for the taxpayer. So instead of just finding out information, you could actually communicate and give information to the IRS. You could also advocate for their position. You could execute a closing agreement. You can inspect and receive confidential information just like we could with the 8821. So lots of power there. Then there's some discretionary powers also. It's possible that, there's check boxes on this form to allow then the representative to substitute in other representatives to sign returns. Personally, I don't do any of those additional powers, so I don't really worry about that section of Form 2848. I like the client to be a little bit more involved in the process. One thing we will tell you is even if you have the power of attorney and you have stepped into the taxpayer's shoes, so to speak, you cannot negotiate a refund check or have their refund direct deposited into your account. So if you're ever tempted to do that, don't do it, even if you have POA. Catherine mentioned that there may be a time when you need to withdraw from the engagement. I've done that twice before, usually because the client wasn't cooperating with the terms of my engagement letter, right? So I told them, this has come to an end. How do you do that? Well, over on page 152 in the text, we see exactly how to do that up near the top of the page. You literally write withdraw across the top of your power of attorney, and then you resubmit it to the IRS. And what'll happen after that is you'll get a letter saying that you're no longer the power of attorney, and the client will get a letter saying that you're no longer the power of attorney. Don't let that come as a surprise to them, would be my advice. So make sure you tell them that you're withdrawing according to the terms of the engagement, okay? All right. Bottom of page 153, we have some useful information here for you. How do you actually submit these forms? Okay. So I guess that we're told in the text historically these were mailed in. That was before my time. I've never trusted IRS mail. Okay. So I've never done it that way. What I've done is I've faxed them in. So I'm going to give you a couple fax numbers. Grab your pen here, folks. Grab your pen at the bottom of page 153 or somewhere in the white space. Go ahead and write this down. If you are west of the Mississippi or in the state of Wisconsin, west of the Mississippi or in the state of Wisconsin, the fax number is 855-214-7522. If you are east of the Mississippi or in the states of Louisiana and Arkansas, it is 855-214-7519. And I believe Gina is going to put that in the chat for us. So if you miss those numbers, you can get it from there. So all you have to do is fax that in. Then you have to wait for it to post. That's the CAF unit that you're faxing it to, Central Authorized File. You wait for it to post, and then once it posts, then you can use your e-services, or you could call Practitioner Priority Service, and then they'll be able to see that on the IRS system and talk to you as the representative. Okay, so that's one way to do it. Go ahead and answer the poll question, folks. The other way, the new and improved way, is to use the Tax Pro account. So I went in yesterday to set up my Tax Pro account, and I was pleasantly surprised to find out that I guess because I have an e-services account, I already have a Tax Pro account. So the hard part of this that I can see is helping the client set up their account, because the client needs to set up an online account with IRS in order for me to initiate my request to be POA. But here's how I understand this working. If I've got the client's account there, I request the POA, they say yes, I instantaneously post to CAF, and then I can do all the work that I want to do, okay, which is mainly pulling transcripts. So back to our engagement with Sue and Paul. Example 10, page 154. Sue gets the signed POA from Paul, faxes it into the appropriate service center. Sue is doing awesome so far, isn't she, Catherine? Everything she's doing spot on. Next in our text, the author takes a bit of a deep dive again into IRS notices. And we're not going to cover each notice individually the way that they're covered in the text. What I will tell you is this about IRS notices. Make sure that you read them carefully. Even if you think you know what they say, it seems like they're always changing. They look a little different. Maybe they say to call instead of writing, or maybe they give you a fax option that they've never given before. Take those things seriously and just follow the instructions in the notice. That way you can always go back to your client and say, hey, we've done our part. Now it's up to the IRS. Okay? So that's all I have to say about IRS notices. We mentioned at the beginning of our discussion today that we as tax practitioners have tools in our toolbox that let us help clients. I think that that's probably nowhere more true than in the arena of penalty relief. Okay, so sometimes clients are assessed penalties like the ones at the top of page 158. So if you go there, page 158, clients will be assessed a failure to file penalty, or a failure to pay penalty, or a failure to deposit taxes as required, right? Or even some other penalties. And oftentimes, because the IRS has assessed it, our client just believes that they owe it, and there's nothing that can be done. Wouldn't you agree with that, Catherine, in a lot of cases? So here are a few tools.
Actually, Keith, sometimes they believe nothing can be done, but they don't think they owe it. They think you owe it.
Engagement letters, folks, engagement letters. That's where that can save you. We do have tools in our toolbox, though, that we can help get out of them so that they don't have to pay them and you don't have to pay them either. Neither does your E&O insurance, right? So let's just discuss these one at a time. The first tool in our toolbox is administrative waiver, and its most common iteration is the first-time penalty abatement. So in addition to first-time penalty abatement, I think some other administrative waivers would be like what we were talking about yesterday, Catherine, where during COVID, some of these due dates change for estimated payments. Those would be administrative waivers that we could literally just look back and say, hey, according to what you said here, that actually was this. And then they go, oh yeah, you're right. That was on time based on that direction. But how does first time penalty abatement work? I read one time in an article that this is like a secret handshake between us as practitioners and the Internal Revenue Service, because our client doesn't know what it is, and we can just invoke first time penalty abatement and boom, their penalties are gone, right? But in order to qualify for that, they do have to meet the 3 requirements that are in our text on page 158. No penalties for the last 3 tax years, filed all current returns or have an extension of time to file, and then paid or arranged to pay any tax due. So as long as the client has met these requirements, and the IRS will let you know too, you could just ask them, does this penalty qualify for first time penalty abatement? They've got an indicator in their computer that'll say yes or no. Then you can request that. So that's one very, very good tool to alleviate penalties. If you can't get first time penalty abatement, another tool is reasonable cause. Now, the IRS has software on their side called the Reasonable Cause Assistant, and that basically looks for certain buzzwords in the letter that we write back to them, or if the client has already paid the penalty and we're trying to get it back, we would use Form 843. Okay, so this is how we're actually doing this, writing a letter or using Form 843. And we want to use words like this: ordinary business care and prudence. Highlight that at the bottom of page 158. And then you just write that in the letter. Based on the facts and circumstances, we believe our client exercised ordinary business care and prudence. Then you have to explain how your client did that. So take a look at the top of page 159. What are some facts and circumstances that could have prevented a taxpayer who's showing ordinary business care and prudence from meeting their obligation? Could have been a fire, could have been a natural disaster, could have been inability to obtain records. I heard a story one time, Catherine, I don't know if it's true, I just heard it, right, at a seminar, but it was of a guy who had a tax practitioner he'd given all of his documentation to, kind of like Paul did with Sue. And then that guy was like doing cocaine or something and ended up in jail. And then his office was locked. And then all the stuff got thrown out by the landlord. Inability to obtain records, right? Entertain these reasonable cause assistant folks, I guess, if you can. Also, death, illness, these other things. And take note of the note box, though, at the top of page 159. Not having the money is not a reasonable cause. But look at why the client doesn't have the money. Did they have some of these other instances happen in their life that led to them not having the money? If so, use your best effort there to use reasonable cause. It is a powerful tool. All right, the practitioner planning tip is a good one too on page 159. We really need to weigh out which tool we're going to use, right? Just because we can use a hammer doesn't mean we should use a hammer, right? Maybe we want to save first-time penalty abatement for another period. Or maybe reasonable cause is that the taxpayer couldn't get the records because we were in jail with the cocaine conviction, right? You got to think about which one of these things is going to work out best for the situation. And that's really, I found that in these engagements, Catherine, that's what they're really doing. They're paying us mostly to lay out the strategy, to use our heads to think our way through what's going to work best here. And then the added bonus is we actually do the work, right? Okay, so turning away from penalties now, I'd like to just talk to you about a few more little resources you can use in communicating with the IRS. And I'd like you to take a bookmark and throw it on page 160. If you've got like our little tax school flags, you could throw those down there where it says taxpayer transcripts. And then grab your highlighter and highlight 2 of these: record of account transcript and wage and income transcript. Just like we say you should never do any of this kind of work without an engagement letter, you cannot do this work without pulling the record of account transcript and the wage and income transcript. Those become treasure chests that show you what your client filed, what IRS has done on the account, what information was reported to IRS that your client may have lost along the way, like if you're dealing with a no-filer like Paul. So really good resources there. Go ahead and jump over, if you would, to page 163. I want to highlight another resource for you. That's the Practitioner Priority Service. before you go, oh, practitioner priorities closed, COVID killed them, they don't even answer the phone. None of that stuff is true, okay? Here's what I will tell you. If you call the number, which is in the text on page 163, 866-860-4259, or it's on our slide here. If you call that number between 7 a.m. and 7 p.m., here's what used to happen. You used to say what you were calling for, then you'd get in queue, and if you were still on hold after an hour, there would be a courtesy disconnect. And it was really, really irritating, okay? Here's how it works now. You call, and they'll tell you up front if they're too busy to take the call. They'll just tell you that, which is nice. They say call again another day. So I tell my clients, sometimes it might take me days to get through, okay? The other thing that's nice is when you call them, you're going to find that they'll tell you how long you're going to be on hold. They're going to say 15 to 30 minutes, 30 to 45. I've found this year that that number is surprisingly accurate. They'll also offer you a call back if you don't want to listen to the dun, 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 you know, for 35 minutes or whatever. It's fine. You just give them your phone number and they will call you back. It actually works. It's kind of cool. So that's what's happening now. Here's the other little twist for the last couple of years. You call them, and even though you're calling to talk about the client, they're going to ask you a few questions about you. They're going to say, Catherine, what's your date of birth? Catherine, what's your social security number? Catherine, what's the AGI on the most recent tax return you filed? So don't be shy. Here's what they're doing. They're making sure that you are the person that you say you are when you're representing the client. So just because a POA is on file, you know, it'd be very easy to just steal a bit of information off that POA and call in with it, right? So play along. If you do, you'll get the answers to your questions. When we talked before about submitting these authorizations and then having to wait a few weeks, practitioner priority service works a little different. So I could call, and if I could get through today, I can actually fax my POA to the lady or the gentleman that I'm talking to on the phone. And then once she has it, she can send me the transcripts and everything that I'm looking for in one call and then forward that down to the CAF unit. So this is kind of like a priority service that we can use. And again, it doesn't work great because sometimes we can't get through, but when we can, it works. It gives us what we need. All right. The last thing that I want to talk about as a resource here is e-services. So this is discussed in our text at the top of page 164. Remember I said you could fax your authorization to CAF, and then you can go in and pull these transcripts once it posts. You do that with an e-services account. So if you're not registered for e-services, this might be something that you want to consider doing, because once you're registered for e-services, then you're not bound by being able to get through to practitioner priority service. And once you're on the CAF, then you can go in and you can see updates on the account transcripts and things like that. So very useful tool, e-services. Look at example 13 at the bottom of page 164. That's what Sue does. She uses e-services to find out that not only has Paul not filed, but the IRS has filed for him with substitute for returns. We'll come back to that here towards the end of our chapter. But for now, I'm going to go ahead and turn you over to Catherine for IRS exam, unless you have any other comments about what I mentioned, Catherine.
So Keith, I'm still trying to get over the fact that clients lie. And
you
I've
know
heard
it's true.
Well, and I've heard you say it so many times. The other thing is that the notion that lies have varying degrees of maliciousness, right? That's when I put my attorney hat on and I think, okay, well, if you're sitting on a stand and perjure yourself, I'm not sure how much maliciousness comes into play. All right. So IRS exam, we are on page 165. Now, I don't know about anybody else who might be listening out there, but my clients believe that there are specific things that I know that will make their return more subject to audit, right? They assume that if I file an extension, they're going to get audited. They think that if I amend their tax return, they're going to get audited. Of course, if you're my teaching partner, my former teaching partner, Tom O'Sabin, he tells me that all of his amended returns get audited. I do notice that we have a poll question out there, so make sure that you get that answered. All right. So what we really know is that audit selection is in fact random. So I always tell my clients it's really a random process. There may be some specific circumstances. They may be looking at different items on the return. And if there is a substantial difference between yours and what other people, what other people in that same, like if your charitable contributions are really high compared to your income and that statistic is off, that might be something that could at least have the IRS looking at your charitable contributions, for example. We also mention related examinations. If, for example, they are examining a partnership, they may look at the returns for the partners. Now, of course, in today's world, we have this ability to elect out at the partnership level relative to where the taxes would be assessed, right? So allowing the assessment to happen at the partner level. And then we have business associates. When I have had corporate tax returns audited or S corporation tax returns audited, they typically will look at owners or officers' personal tax returns, not necessarily to audit them per se, but they're just looking to see what's on those returns. We talk in your text about the statute of limitations. Here's the thing that I want you to remember, and I'm sure for many of you, we're really clear about that statute of limitations, right? For some people, October 15th is a relief, not because they got all of their tax returns filed, but because another year on the statute has closed. And so they are free from responsibility for another year of tax returns that were prepared, right? So we know if a tax return is filed, the statute of limitations is open for the later of 3 years from the date the return was filed or the due date of that tax return, right? So 3-year statute. But notice right below those other bullet points, if a tax return is never filed, statute doesn't run, right? It hasn't had a starting point because you haven't filed a return. So in our example of Paul No Filer, right? The statute of limitations is still running on all of those tax returns because he hasn't filed them yet. So when do audits normally happen? If they happen, it's oftentimes you're at least 2 years already into the statute of limitations, right? So it's not unusual to have the IRS asking the taxpayer or you as the representative to ask the taxpayer to extend the statute of limitations. And we mention in your text that you really need to give some thought. You wouldn't necessarily want to just blanket say, here, you got to sign this because, the statute's going to run and they can't get their audit finished on time. Well, that's not necessarily the right answer. Maybe it's in the best interest of your taxpayer to let the statute run. Force the IRS to push the issue forward in a faster way. So just something to think about when you're looking at those statute extensions. We also mentioned refund claims on page 166. I know this can be an issue, for example, with our taxpayer Paul No Filer, right? What if any of those tax returns, the really old ones, what if he has money coming back to him? Well, we know that the refund or the statute on a refund claim runs very quickly, 2 years from the time the taxes were paid, right? And so for Paul No Filer, he's going to be SOL on those really early tax returns, right? In terms of his ability to recover any potential refunds. So certainly something you have to take a look at. We mentioned example 16 down at the bottom of page 166. Notice that in this case, Sue contacts IRS collections because that's who's been contacting Paul, right? So she lets the IRS collections officer know that she's on the job. Paul's, engaged her to do this. She tells collections that she needs 90 days to get these back tax returns prepared. And the IRS agrees to a 90-day extension on her time to process, right? And the rep also lets Sue know where she's supposed to send those returns, right? So she now has a new place to send those. All right. Let's talk about types of audits. Up at the top of page 167, we mentioned the 3 different types of potential IRS audits: correspondence, office, and field. For anyone else out there who's been doing this as long as I have, you may have experienced all three like me for different clients. I have had all three show up in practice at some point in time. Of course, for the last couple of years, we certainly weren't having any office or field audits, right? But Keith mentioned earlier that at least in the latest iteration of the Build Back Better bill, they have included additional money for the IRS. I noticed in something I was reading yesterday, though, that most of that money is being allocated both to the computer resources and for increased audits on the higher income taxpayers. So I thought that was kind of interesting. All right, types of audits. So then we talk about in your text about requested info for taxpayer records. And Keith talked a little bit earlier about IDRs. Notice up at the top, right above that note box, no time limit is specified for the retention of these records. Now, so we're talking about the things that taxpayers are required to keep. Now, interesting that they indicate there is no time limit. And yet I always tell my clients, well, the statute of limitations expires after 3 years. So, not required to retain those records after 3 years. So I guess the question becomes, if you don't expect to get audited, which if the statute's closed, you should be good. But there is some bullet points there in your text on page 167 about the information that the IRS can request if you've been audited, if your taxpayer is being audited. And I guess my question back to all of us as practitioners, do your taxpayers know what information they have to retain? And have you let them know that? I know sometimes in my practice, I include that in my engagement letter. I also include that in the cover letter that goes with their tax returns, assuming that they read those documents, right? But ultimately, oftentimes my taxpayers think that I've got everything. So sometimes I have to be really clear with them. It's your responsibility to retain these. Don't count on me because I don't keep everything. So something certainly you want to keep in mind. Notice the practitioner planning tip on page 168 about electronic data files and the caution box. So you have to remember the IRS has the right, they actually have the right to ask for backups of certain accounting files. That would include QuickBooks. They have access to own licenses for most accounting softwares that are out there and have every right to ask for a backup. Now, I would say, and the caution box is pointing to, whether or not, if you give the IRS a complete backup, have you given them access to data that could be beyond the scope of their audit, right? Or beyond the scope of that IDR. It's interesting, if you start to read some of the information on the IRS website, of course, the IRS is going to tell you they have every right. And guess what? Even if you give us the backup file, we're not going to look at any of the old stuff. We're only going to look at the stuff that's under audit. Here's the thing. What if instead you could parcel out, right? So, can I not instead just give you an Excel spreadsheet that has all the information that you want? And so that's something to think about. We do include down there in the text, way down at the bottom, a reference to, it's the footnote, 119, I think it is. It's hard. It's the middle footnote down at the bottom of page 168. We reference a spot on the IRS website where they specifically discuss the IRS position with respect to electronic records. If you're in this situation, I would suggest you bookmark this page and take a look at that specific spot on their website, just because there's some really interesting information in terms of the IRS position on those records. All right. A couple of additional things on audits. We talk about audit outcomes. We mentioned the 3 potential audit outcomes there at the bottom of page 168. No change, agree or a partial change, and a disagreement. Again, in practice, I have seen all 3. Okay, so it can happen. I have seen all 3. I actually have had no change letters. It does happen. Sometimes they audit and there's nothing to find. I know my clients don't believe that, but it can happen. I noticed that we have a poll question up, so you may want to make sure that you answer that. The last thing I think I want to tell you in the audit world has to do with disagreements. Over on page 169, we talk about disagreements. And here's what happens. So your audit completes, and you're going to get an audit report from the IRS. And included with that audit report is going to be the taxpayer bill of rights. There's some, information that they have to give you, and a 30-day letter. Okay. So it's called a 30-day letter for a reason. The same thing with a 90-day letter. Those 30 days, that is a statutory requirement. A taxpayer has to respond. They have to do something within the 30 days. They either have to agree and sign the paperwork and make arrangements to pay the tax, or they have to say that we're going to disagree and either request a meeting, do something, right? So don't let your taxpayers ignore and don't you ignore those 30-day letters, and even more importantly, the 90-day letters. Statutory 90 days says if you don't do something within 90 days, this is going to tax court. And, you can, a few things will happen. We talk on page 170 about appeals. The thing that I really want you to look at with respect to appeals, there's a lot of information in here about appeals. I have taken cases to appeals, and I suspect many of you may have also done that. But I want you to highlight that fast track settlement program that we have on page 170. It doesn't apply for all types of audits. For example, a correspondence audit does not qualify for a fast track settlement. But in some cases, a fast track settlement may be in the best interest of your taxpayer. So there are a few requirements. We bullet point those for you on page 170. And guess what? There's a form to file, right? Because it's the IRS, it's the government. There's a form for everything. All right. So we give you that form on page 171. The thing about the fast track settlement program is, first of all, you may be able to get agreement or at least get your issues settled faster, which could save your taxpayer money, right? Both in your fees as well as some penalties and interest associated with the audit. And remember, with any type of appeals, so every time, and this is true for fast track settlements, if your taxpayer doesn't get the result that they want, they have not given up the right to the regular, more traditional appeals route. So all along the way, the taxpayer continues, as long as they haven't signed something agreeing, they continue to have the right to push their case forward. All right. And the last bit of time that we have left, there is information, like I said, in your text about appeals and some information about going to tax court. Okay. We're going to leave all of that for you guys to review on your own in case it's something that comes up. You might want to take a look, but I want you to go all the way forward to page 173 so that Keith can talk to you a little bit about IRS collections in the last bit of time that we have left.
Thank you, Catherine. Yeah, it's actually page 180, folks.
There you go. Sorry.
Yeah, so right topic, wrong page number. But I love collections. And out of the book for just a second, I'm going to give you a recommendation. If you're a big tax nerd like I am, you might enjoy reading this book, okay? There's a book called Confessions of a Tax Collector. One man's tour of duty through the Internal Revenue Service, and it is awesome. Okay, so go ahead and read that at your leisure. Now join me back in the book. Here's what I love about collections, starting on page 180. Collections motivates people. When that revenue officer knocks on someone's door at night and says that they're there to secure 1040s, or when they walk through the front door of the business to say that they're there to collect the taxes that the business owes, that motivates people to take action. And those people will take action by hiring you and I if we hold ourselves out to do this type of work in the community. So let's take a look at example 19, bottom of page 180. And Catherine, I'm hearing just a little echo. I don't know if you're not muted there on your thing, but bottom page 180, example number 19. After Sue gets all these returns filed, they all get processed, and the IRS assesses all the failure to files, failure to pays, failure to deposits. Paul owes $190,000. Okay. You remember how we met Paul? We met Paul sitting in a bank wanting to borrow money. So Paul likely does not have $190,000. If he did have $190,000, the easiest way to solve his collections case would be for him to just make full payment after we've done the best we could to abate penalties, right? But likely that's not the case for Paul. That's also not the case for many of the people that you and I will work with. So what is our objective with collections? We want to make sure that the IRS does not levy our client. Okay, that's the objective. Make sure that the IRS doesn't just reach out and at their own discretion choose to grab funds from the bank account or the retirement account or seize the car or anything like that, right? So how do we go about doing this work? Well, we got to get them a collection alternative. If they can't full pay, maybe they can use one of these 4 methods, okay? And this is what's described in our text starting on page 181. Method number 1, an installment agreement. So in an installment agreement, you look at Paul's case here, and Paul would end up paying the whole $190,000. The IRS could break that down to what he's required to pay per month. They'd give him 72 months to go ahead and pay it, and he'd get under the installment agreement. And as long as the IRS agrees to it, everything is just fine. Paul's paying his taxes. Okay. Couple of ways to submit an installment agreement, and the level of documentation that you need to submit in order to get one depends on the dollar amount that's owed. That's discussed in our text at the bottom of page 181. Okay, go over with me to page 184. We'll look at this second collection alternative, which is the partial pay installment agreement. So maybe when someone owes a lot, like Paul does, they might come back and say, Paul, you've got to pay $1,700 a month. And Paul says, I can't afford $1,700 a month. And he submits his collection statement, his 433 statement, and it shows that maybe Paul's only got an extra $1,200 a month to pay. Well, they might enter a partial pay installment agreement where he pays the $1,200 until the end of the statute. They're going to ultimately end up settling for less than they owe, but this is a viable collection alternative, okay? Here's the third one. You've heard about it here at tax school already because Jerry talked about it yesterday in financial distress. And that's the offer in compromise. So this is the settling for pennies on the dollar sometimes, right? More often than not, though, if a client is a candidate for an offer in compromise, they kind of meet these sort of requirements. They're generally older, meaning that they have limited income potential for the future. They have no assets. They're low income. They rent instead of owning where they live. All of those kind of things. No equity, no income potential. Maybe a candidate for an offer in compromise. Okay, they have insufficient assets to pay the full amount due. That's a good program for those that it's a good program for. The problem is every one of our collections clients thinks they're a candidate for the offer in compromise program, and they may not be. So there is a pre-qualifier tool that you can use on irs.gov and that you should use to make sure that your client qualifies. And some of the conditions are listed also in your text, okay? Let's take a look at Paul in example 20, page 185. Sue asks him to list all of his assets, liabilities, and income and determines that he is a candidate for the offer. The offer is actually driven by data, okay? So when you fill out a 656, you're going to find out exactly what the offer is at the end. It's not something that's just, okay, we'll go ahead and offer him $1, you know? It's like there's actually a number that comes out of that thing that you propose. And in this case, for Paul, the proposal's $2,000. Not bad if he can settle $190 for $2,000. Here's another collection alternative. This is the fourth one on page 185. Our text calls it a collection delay request. I've heard it more often referred to as currently not collectible, CNC. And what that is basically the IRS says we're not going to pursue any collection at this time because the client has nothing. We'll revisit it in 2 years and see if their situation has changed. Okay. Again, nice deep dive into appeals. You can appeal all these things if the IRS doesn't go for them. Again, your job is just to make sure that they don't get levied. Okay. One quick comment about criminal investigations on page 189. Our poll question asked, can an EA or CPA represent somebody in criminal investigations? The answer is no. They can work with an attorney who's representing someone if they're covered by a Covell letter, okay? But that's not the case for most of us. We're just going to be representing clients who aren't under criminal investigations and referring them out when they are. All right, 2 minutes to conclude here with non-filers. We're in the text on page 190. here's some really good advice. Know your clients. So know if your non-filer is habitual, meaning that they never file on time. If they're a skipper, I've got a skipper comes to mind. Maybe you do too. This is someone who comes to you like every 3 years to have their taxes done, and then you do 3 years worth of returns. And then you got a dropout, somebody who maybe used to be active, then a life circumstance changed. Maybe the spouse who handled the return died, and then they've dropped out. But here's what's really important. No matter who they are, you're going to find out in your discovery whether the IRS has prepared substitute for returns. Those are not going to be accurate. They're going to take all of the income with none of the deductions and credits, but it does give the IRS something that they can then collect against, right? So make sure that if you've got a client who's done SFRs, or that the IRS has done SFRs for, that you're stepping in there and filing accurate returns. Let's see how things end up for Paul here at the end of our chapter. Example 23, page 195. The IRS approves his offer. He settles for pennies on the dollar, pays his $2,000. As long as he stays compliant for the next 5 years, the 188 literally never comes back to haunt him. Okay. He has to stay compliant for 5 years. He decides he's not a good candidate for being self-employed. So he goes and works as a W-2 employee, uses TurboTax, gets his refund, and enjoys it. But hey, Sue always gets to think about the fond memories of how much she saved Paul and how much fun it was working with him. So thanks for being with us for that, folks. Enjoy your 10-minute break.
So the Ethics is Chapter 4, starts on page 197, has several topics, and we will be discussing really in a couple of different layers here. The first layer is, well, what's included in Circular 230, and to what extent does that impact, the way we practice and meet and serve our clients? Then we have several scenarios that bring those things to real life examples. And Jerry and I will cover a few of those, and Catherine O'Keefe will cover the balance of those. And we will see in those scenarios some of the newer things that have emerged, this season, last season, regarding the way we have to deal with tax return preparation and filing. And many of the new things we've discussed in new developments and other sections so far, have an impact on how we deal with our clients in the most ethical manner. Circular 230 is a document that's been around for a while, and there was a letter written from the AICPA group, and it's noted in our text on page 255, and that's where I'm going to start my discussion to talk about things that might be helpful to have in Circular 230, because there has been suggestions that it's time to update that document. So the letter from the AICPA group was written last March the 4th, and it's about guidance on changes to Circular 230. I want to highlight just a few of these because we're still waiting for the update to happen. And these suggestions, might be included. And even if they're not included, they might be things that we need to be thinking about as we modernize our role working inside the Circular 230 platform. One of those I want to mention is in subpart A on the letter on page 256. And this subpart A says sort of the initial part of a recurring theme in the letter, revising parts of Circular 230 to reflect something that happened in the Loving and Ridgely court cases. And here specifically, we're talking about the elimination of the Registered Tax Return Preparer Program. Those two cases focused a lot on the IRS's ability to regulate tax return preparers by giving them a license or giving them required professional development rules. And these Loving and Ridgely cases, one outcome was eliminating that type of RTRP program. But there's still interest on the IRS's part to regulate tax preparers. We'll see what they come up with down the road. On page 257 and page 3 of the letter, section 1020 discusses the privilege exception. and describes privilege about the digital delivery of scanned records. While there might not be privilege for those properties of the client, they might not have the authority to share those records unless they receive authorization to do so. And even in our ethics chapter today, we will have poll questions that come up periodically. Gina's rolled out the first one for you. So throughout our day, be sure you're registering your attendance for your credits. In section 1021, which is knowledge of omission, the AICPA group suggests adding a clarification that we have no duty to notify a former client of an omission from subsequent events after the engagement has been terminated. In 1022, the suggestion is revising the diligence as to accuracy section so that when you're relying on third parties, you don't have a requirement to dig deeper into that third party's abilities, so that when you engage that non-signing independent third party, and it's outside the reach of the signing preparer to supervise and train that person. 1027 and 1028 and 1029 sections are identified on page 4 of the letter. 1027 describes final effect, more about the Loving and Ridgely cases. 1029 describes information about a de minimis exception to the conflict of interest rules. For example, if an owner has less than a 5 or 10% ownership stake in an entity, they would not be considered an adverse or affected party for the conflict of interest rules. There are other considerations that they identify in page 6 of their letter. These new provisions would include things that are not currently a part of our requirements under Circular 230. For example, there are no provisions about confidentiality, about privacy, about data protection, about record retention, and those are suggested to be addressed. Also about online access from OPR decisions, making that more fully available to us as tax return preparers. So all these things are noted in this letter. I highlight that additionally because I know that group, the AICPA group, has had a very influential position in a variety of tax-related pieces recently as I've watched that. Certain things as PPP deductions, certain things about how to handle tax-exempt income on entities related to PPP and the AAA and OAA accounts for S Corps as an example, and even about the filing due dates. So I think this group is tuned in to what's happening in Washington, D.C. I will be really curious to see when we get a new Circular 230 to what extent these suggestions are included and how modernized that publication is the next time it arrives in our email, Jerry. And good morning to you, Mr. Brune. Welcome back to our session this morning. Your opening comments on Circular 230, and Jerry's going to talk about the goals and some of the key sections of Circular 230 as well.
Yeah, I sure am, Bob. But, I'm just glad to be in the company of the rich and famous. I understand that you know the person who wrote that letter from the AICPA. So I know, maybe you can be our lobbyist or something like that. So
I wouldn't know about that, but Chris Hesse authored that. He has a very prominent position with AICPA group. I am not a CPA, not a member, but I've had several conversations with Chris over the years. He is extremely talented, extremely committed to a good taxpayer professional experience. I'm glad he's on our side there too. So I'm glad to have some input with Chris. He's doing a great job for all of us.
Yeah, so between that and meeting the IRS commissioner in an elevator, it's just, there are just no boundaries to.
Yeah, I should have had a better elevator speech ready for that. That was surprising. I was intimidated by the security detail accompanying Commissioner Reddick the day I saw him in the elevator. I had a chance and I blew it.
The IRS commissioner was in our building in a training class I had, and basically instead of letting us meet him, they kind of locked us into the classroom. We couldn't even go out to go to the bathroom for a while because they were afraid we might run in to the IRS commissioner, whose, of course, the goals that they had, we as revenue agents were trying to make those happen. Anyway, I'm not bitter. I'm sure you can tell that. But getting back to the Circular 230 updates, as with other tax law, there's various sections that direct the IRS to come out with some more guidance, and some things happen, some don't. I think we're all pretty well aware that the IRS has got a pretty full plate right now, and they're really struggling to do what they can in the areas, to keep as many fires out as possible. But with the Circular 230, and it mentions at the beginning of that AICPA letter, the final regulations, which are the ones we're still dealing with, came out in June of 2014. So 7 years, that's pretty much, forever in the area of tax law, where, that's, I don't know how long permanent is, but it may not even be as long as 7 years. So, maybe it needs to, I think it needs to be updated. A lot of you felt that way also in the first polling question. And I think, for it to work for us and tell us what all we need to do, keep us in our, the straight and narrow. Myself personally, I was in favor of regulating the preparer community, having some minimum educational requirements. Of course, I was a little bit biased since I'm an instructor for what I think is the best source of 16 hours of CPE. So, that would be something that I would be in favor of, because now basically anybody can prepare taxes, and that's the case in some instances, and the tax-paying public doesn't necessarily know. Just like going to a doctor who doesn't have a medical degree. I mean, it's anyhow. I digress. Let's get back to the goals, and we go back to the beginning of the chapter. If you're not already there, on page 198, the Circular 230 on our ethics chapter has to deal with the Circular 230, which has been the same for at least the last 7 years. It gives guidance to us. Most of it is things that we're not supposed to do, but it is, to work for the benefit of the taxpayer, to arrive at the least amount of tax that the law allows. I started thinking about that during the dealing with the economic impact payments, the recovery rebate credits. It's pretty much, you get a check. And sometimes I wondered if all of these payments should have really gone out. But then when I looked at the law, it was perfectly permissible. And that helped me to sleep at night, knowing that, well, all these billions of dollars are getting paid out. I want to make sure that my client gets their share, no more than what they should get, but at least as much as what they're entitled to. So that's one of the goals. Also, for to follow the law in our work, advise taxpayers, when their desire to minimize tax liabilities, we want the least amount that the law allows. A lot of times clients want it to be minimized, period, whether it is really something in the law or not, because they read something on Google, they were talking to a friend, when they were at the at the neighborhood bar or something like that. And so then they wonder, well, how come I can't do that? And we say, well, because it's illegal, or whatever the answer might be. So this is the framework covering all these different sections that we should operate. And it also talks about what happens if we don't. So we will cover starting on, we've got 6 different sections listed there at the bottom of page 198. And these are provisions that we, of course, have covered in the past. So some of these will be a reminder. Before we get to these various scenarios, in these various scenarios that are coming up, I talked to Tom O'Sabin, who is here with us, even though he's not teaching right now with our webinars here. And of course, we're glad to have Keith here as well. But Tom, of course, is doing a lot of work behind the scenes, and he wrote this chapter. I talked with him during filing season, after the webinars last year ended. And I said, Tom, I think you would be able to devote the entire 2-hour ethics presentation to, I think I used the words stimulus scams, which may not have been too far from the truth. And we will see when we get into the scenarios that some of them will deal with that. Anyhow, let's go back to page 199. We've got a couple different sections here that I want to discuss here briefly. And besides that AICPA letter, in the pages before that, starting on page 215, we have reprinted the entire Circular 230. Now, you're not going to have to page back there during our discussion today unless you want to, but if you ever are coming across a particular question and you're wondering, well, what exactly does Circular 230 say about that? Then we've got the entire circular is in our text this year as well. So with section 1021, the first one here we're going to cover, that's on page 229. And we've also got a poll question shooting out here that if taxpayer has an issue you're not familiar with or you don't know the answer to, what do you do? So remember, there is no right answer. The only thing wrong would be not to answer or something like that. So yeah, go ahead and give us your response there. Well, I talk a little bit about section 1021. It's our duty to tell the taxpayer what the law is. And if there's something that we've seen that there's an error on the client's return, and typically that's going to be in a prior year, then it's our duty to tell them about it, what the consequences of not resolving the error will be, and exactly why what we found on this prior return isn't really correct. Now look at the box note there on page 199. There isn't a requirement that we need to force the taxpayer to fix it. If we tell the client, we say, okay, there's an error on your prior year's return, and if you don't fix it, we're going to tell the IRS on you. Well, that's not, that isn't our duty to do that. It's just our requirement that we tell them about it. If they choose not to, that's between them and the Internal Revenue Service. In fact, we also tell you in that box note, there's no requirement that we report that to governmental representatives. In fact, that might even be a violation dealing with client confidentiality. I know our Bob and I's teaching partner, Rich Walden, he gave me some good advice in this area. He says he tells the client, well, here's the error on the return, and here's the tax difference it would make, and would you like me to prepare that amended return for you? And of course, if they say yes, then we've got, we know that omission is being taken care of. But if they say no, then really our job is done. And I wanted to bring up, if you remember yesterday when we were talking about the 1099K, I gave the example of the new client who had a 1099K. And when they showed me their prior year's return, there wasn't any Schedule C. So I knew they had not reported that Schedule C income in an earlier year. And I think, yesterday I said, it's a question I was afraid to ask the client because they might answer it. Well, because, I kind of knew what the answer would be. I saw that 2019 return. There's no Schedule C. And I did the same thing. Well, I said, well, if you've been doing this over a number of years, I don't see any Schedule C on 2019. Did you want me to prepare an amended return for you? And, he said no. And that, again, that was the end of it. I think I also said yesterday he was making comments that, he might not want to continue in this now that he's found out he's got to pay tax on the money. And so now my question, my concern is, if he comes back next year, I said, I took him on because he was the father of a very good client. So, it was something I thought was a good thing for me to do. So now if the client wants to come back, I don't imagine that he has fixed his 2019 return. He'd have to go to somebody else to do it. Maybe he could prepare it himself. The reason why he came to me is that he didn't know how to fill out a Schedule C. So now it's my ethical dilemma. I've got this client maybe coming back next year. Do I want to take him on again as a client? When in my mind, I've let him know about an omission and he didn't want to make things right. So that's a decision I may have to make next filing season.
Jerry, to add to that, it's very likely this client might get a CP 2000 notice several months from now and come back to you and say, what did you miss on my return? Why did you do my return incorrectly? So this conversation you've had, I hope we might recall that. If not, we document what occurred there. But in those types of things, we also might deal with this several months after the action ended.
Well, yeah. I mean, if he got a CP 2000 on 2019, that's the return he did himself before he came to me. That's the one that I told him about the client omission. So I would be, I have to keep myself from saying I told you so. We'll see how that works out. But I said, I've done my job. I told him, that I think there's an error on the 2019 return. And then, like I said, my duty under 1021 is done. In the planning tip on page 199, do you want to have some questions in your organizer to get the information that you need? That's going to be something that's going to be a record, a written record, what some of the questions you asked and the responses from the client. Now, I've had a lot of clients when I had a longer organizer with a group with a couple of pages of questions. I've had clients saying that they thought they had to take a test in order for me to prepare their return. So I try to minimize that as much as I can, and then maybe just ask those questions when I actually talk to them. But you do want to make sure you cover everything that you need. The next section, the bottom page 199 on 1022, which is the due diligence provision. We've got to use due diligence when doing, well, just about everything. Look at that list there on the screen at the bottom, 199, preparing returns, approving, filing, dealing with the IRS. We have to exercise due diligence in all of these things. And we need to document, this is in the planning tip on the next page, the top of page 200, we need to document how we completed our due diligence. And so the question or the issue in the planning tip on page 200, what happens when the client responds and says, well, it's the same as last year. And I know when I used to wear my IRS hat a lot more often than I do now, I think, well, they probably don't have the charitable contribution substantiation, and maybe it's something that shouldn't be there. But now that it's been a longer period of time, that I'm not a bad guy anymore. I'm a good guy. I'm on the other side of the desk preparing the returns. And now I'm starting to think, well, maybe if they really kept good records on their charitable contributions, they might have more than what they had last year. So it's not necessarily a bad thing. So I'm prompting them, especially now starting in 2020, when even those clients who haven't been able to itemize under the TCJA, they haven't really worried about charitable contributions because they don't have enough to itemize, and I haven't really pushed it. But now we've got this above the line, $300, now $600. I'm going to add that in my checklist organizer letter in January. Say, hey, go back, go through your records and see exactly how much you had for charitable contributions, because everybody will be able to get at least something with these tax law changes. Okay, on page 200 also, the next section, or I guess also with the due diligence, one other point, there are checklists that we need to fill out while we're doing the return, where we need to tell the IRS that we did that. And we're all aware, I think, of the 8867, where we show our due diligence for the earned income credit, for the American Opportunity Credit, for head of household filing status, all of those things. And I know every time I fill one of these out, I know the boxes I need to check to get those critical diagnostics to go away. But I have to keep reminding myself, well, I need to think about it for a second. Did I do this? Have I really covered all my bases here? Okay, let's go to section 1029, deal with conflicts of interest. This isn't always going to be really clear. In fact, I found in my practice, now I've been a business owner for 6 years, and in this past filing season, it seemed like there were a lot of instances that I found that one of my clients was related to another one. They were all clients of the seller who sold the practice to me. And, I didn't realize they were related. They were clients from the seller, but then they're talking to me and they say, oh, my brother, and the brother has a different last name, or, I hadn't always put two and two together. Now, I don't think there's a conflict there, but now I'm aware that I've got a couple clients that are related to each other, and I want to make sure that representing one of them won't, result in the other client being treated differently, something that would adversely affect them. Now, the main situation that I think of in this area are clients who are getting divorced. In fact, one client who just came in right before the October deadline, she came in to pick up a return. Everything was pretty straightforward. And so we were just, we went through, got all the, got the information that I needed, got the authorizations, got the payment. And, pretty much as she was almost getting up to leave, she said, oh, by the way, my divorce just got finalized a few weeks ago, so that'll be different on the 2021 returns. So that just kind of hit me broadside. Now, fortunately, right away, I'm thinking, okay, am I going to have a conflict of interest here? I'd only talked to her. She'd brought in the record. She answered the questions. She paid me, all of those things. But I told her, I said, well, yeah, your filing status will change in 2021, and there will be different changes to your tax return. They've got a couple children. And so I said, there'll be a lot of questions we'll need to cover in 2021. And so now I made a note of that to make sure that I can, remind myself of the provisions of 10.29. Do I need to get a consent from them if I decide to represent both of them in 2021? Of course, assuming that they both come back to me and have me do their 21 return. So that's, sometimes you just never know when this will happen. We've got another polling question up dealing with client organizers and questionnaires. So again, make sure you give us your response on those. The next provision on page 201, the best practices for tax advisors. This is a rare section. So many of the provisions under Circular 230 tell us things that we're not supposed to do. But 1033 is telling us things that we should do. Now, it'd be nice if there was a lot more detail of all these different things that really are best practices for us. So it isn't probably as specific or as far reaching as I would like. It just kind of says in general, we need to tell the clients how we came about the conclusions. We need to communicate with them. We need to understand. They need to understand what we're trying to do. We need to understand what they're trying to do. And some of the other things that would just be good office practices, like engagement letters, organizers, all these different things in the planning tip on the bottom of page 201.
Jerry, I would add that it looks like this season, as you've been describing this compared to prior years, will be one other season where the communication understanding will be most critical. These best practices comprise about a half a page of the 42-page Circular 230 that Jerry noted is in our manual today. But communicating to people about these child tax credits, they got some in advance, but not all, understanding from them with the letters that they're going to get. What did they get as an advance payment? Why is their refund smaller than last year? Well, because they got some of their credits in advance. How are they going to handle the child care credits? Understanding the EIP that gets reconciled to a recovery rebate credit on the return. I just can't see, Jerry, a season where it's been any more critical to adopt those best practices in the areas of communication and understanding. And so I'm saying that because it's not just for our new clients who we know little about. This is for our clients we've had for a long, long time, but there have been so many changes that impact their return. This understanding and communication will certainly be, a strong key for this season, because if we don't have the right understanding and communication, getting this competence right will really be a challenge, don't you think?
Yeah, I really do. And so, the competence is the next provision here on page 202 under section 1035. We need to have this minimum level at least of competency and understanding. And the key is, and I remember hearing this quite a few times when I was with the IRS, the accountant would say, well, I didn't know about that law. And that's not going to cut it. We can't say ignorance of the law isn't going to be an excuse. So if it is something, and we had a poll question a little bit earlier, if there's a question you don't know the answer to, what are you going to do? And some of you might have been, said any answer was fine for CPE purposes, but it is something we don't just want to make up the answer. We need to either get some better knowledge of that particular topic, or find somebody who does have better knowledge of that topic and then talk with them. Just, my main example, as soon as somebody says the word agriculture, I say, well, I got to call my teaching partner, Bob Ray or Rich Walden, because they have so much more experience in Schedule F returns than I do. I do exactly one of them, and that was new this past year, a client who's a physician, and now he also has a farm. So, now I'm a Schedule F preparer, but I am, of course, by no means an expert. I used to know a lot more about that when I lived down in Peoria, but up in Bolingbrook, we don't have a whole lot of Schedule Fs floating around there. So I don't feel comfortable with that. I was talking with Keith and Catherine earlier this morning, about my one Form 990 that I do, which is due on November 15th. And I said, it's really something, I'm really not as familiar with that because I only do the one return. So I've got to make sure I've got the proper knowledge to prepare at least that return properly. I think I know enough to know I don't want to do a whole lot more of them. So I don't know if that really comes under the competency or not. But anyhow, so.
Well, certainly about the knowledge area, you're a prime example of, even at your level of experience, you learn something new about Schedule F filing. And we've said this, probably every year, but certainly critically true the last couple of years, that if your personality says, I want to be somebody who keeps learning, I'm a lifelong learner, I want to find new knowledge, I want to apply new knowledge. Boy, Jerry, I don't know of any better place to do that than following the tax code changes, the regulation adjustments that we see on an annual basis.
Yeah, absolutely, Bob. So, this is another, I guess, I get kind of amused sometimes at some of the definitions. There's not a whole lot in Circular 230 under 1035 about competence, but boy, there is a lot in Circular 230 about incompetence and disreputable conduct. There's a lot of examples of the things that are bad to do under Section 10.51. We list them there on pages 202, 203, top of page 204. And my experience over the years, as I've read through some disciplinary findings from OPR, where some of our fellow preparers are getting suspended or disbarred, the main reason, the most common area where preparers really get into trouble is not filing their own tax return. Not filing their own returns, not paying the tax that they owe. Getting an installment agreement still counts as paying the tax. So it's not like you have to write a check for the balance due each year, but you've got to make arrangements so that tax will be paid. And of course, we joke about it sometimes that the preparer's return is done last. Bob, I filed my return on October the 14th, so I actually had a day extra there. So maybe I'm getting a little bit better in that area, but at least I did get it filed. I had a refund, and so I knew my tax liabilities are taken care of for another year. In fact, you have already renewed your P10. Is that right, Bob?
I have done that, paid the $35.95 fee, relatively easy to do. And just, a few days ago, the filing ability to renew your EA, your enrolled agent license, opened on November the 1st. Let's see, is it this year your Social Security number ends in 0, 1, 2, and 3? Probably those four numbers, I think, are what is in your renewal period. Have to renew that by January 31 for your 3-year cycle. I think that fee is $67. So there's a couple of ways that IRS is, I wouldn't say necessarily regulating too much, but is certainly tracking P10 numbers and EA filers. We're in the system, and IRS can view every return that I prepared. When they search my P10, they'll see all the work that I have done. And I have always told clients, they'll say something about an issue, and they'll say, well, what is the chances of IRS ever looking at that? And my answer is 100%, because they're going to be able to look at every return that I filed under my P10 and see all the things that I've done and scout for unusual conduct that might be incompetent, disreputable, or certainly in a pattern that would bug the IRS about that. But we don't look for those to happen very often. But yes, P10 renewal is happening and EA renewal is open too, Jerry.
Well, yeah, and in the P10 renewal, there was a question still that you have to answer, that you filed all your tax returns, not had any felony convictions, questions that should be relatively easy to answer, but those are available through December the 31st. If you've been to Central Team schools, I think you already knew, that Bob gets this stuff taken care of promptly, whereas I wait till after the last tax school, but not till the last minute. I don't wait until December 31st. So I have not gone through and done that. I haven't made my Tax Pro account yet either. I think Keith was talking about that in the last chapter, that it really wasn't that difficult for him to do his side because he's already signed up for e-services, and I am too. So it shouldn't be difficult. The hard part will be from the client's end. Anyhow, let's get back to page 205, get into some of these scenarios here. And as I had mentioned earlier, I told Tom, let's devote the whole thing to stimulus payment scenarios. Well, we've got a couple scenarios in here about that. So there's some things that are new. We put it on that list of things that we haven't seen or dealt with before. But all these different, pandemic provisions, including the economic impact payments, give rise to a whole lot of potential ethical dilemmas. And in fact, Bob, you want to read us some of the...
Yeah, I'll set up the scenario number 1 that we'll show on the screen for Brad and Kelly, our couple who has a scenario that we'll be building on for the next couple of discussion points. So we remind ourselves with those EIP, those economic impact payments that were mailed out, $1,200 for each adult, $2,400 for a couple, plus $500 for children under age 17. So Brad and Kelly are married, 3 children, but only one of those under 17. So their EIP 1 was $2,900, $1,200 for the parents and $500 for their youngest child. So they come to get their return prepared. They knew that the older 2 children did not get any EIP because they were too old. They talked to their enrolled agent to work on their 2020 return, explained to Rita, their enrolled agent, they'd heard the EIP was an advance on their 2020 return. Well, that's correct. They wondered if they did not claim their 2 oldest daughters, could the daughters receive their own $1,200 recovery rebate payment when filing their 2020 returns and doing the reconciliation. Gina's put up another question for you to mark your attendance today. Rita tells the parents, hey, that sounds like a good strategy, especially since the older daughters earn a few $100s as lifeguards and could file their own returns. Besides, if you don't claim them, Rita tells them, they certainly should be able to claim themselves. So this is a very common question I think people were finding last filing season. For whatever reason, we didn't get the maximum EIP. What can we do now to get the maximum EIP? And in many cases, Jerry, there were sound reasons. Maybe you had too much of an AGI in the prior year. So this year you make an IRA contribution, fall below the AGI limit, and you will get the rest of your recovery rebate credit. But in this case, they're looking to really review the facts and circumstances for this family and determine who is eligible to claim the 2 oldest daughters as a dependent. That's the real question. And what questions, Jerry, would come to your mind about whether these children should claim themselves or whether they should be claimed on the parents' return as dependents?
Well, I think, and you were doing fine in that scenario till the very last paragraph where, well, Rita anyway, she says, if you don't claim them, they should be able to claim themselves. She basically hasn't asked any questions except she knows they made a few $100s being lifeguards. So has she asked anything about the support of the 2 children? Because it isn't just a choice, whether they claim themselves or whether the parents claim them. It's what the law says, whether the parents should be claiming those 2 kids. And, I heard that too in my practice. Some of the younger clients would come in and they'd say, I'm in college and all of my friends are getting, well, actually $1,800 in payments. We talk about EIP 1 for $1,200, but there's also EIP 2 as well. And now EIP 3 in 2021 with the $1,400, so they want to know why other people are receiving this money and they didn't. Now, actually, in this particular area, I felt pretty good in my practice about this. I would, as soon as the client came in and I knew that they had children around this age, I'd say, well, how's the son or daughter doing? Try to get some facts before we even talked about, economic impact payments. And in many instances, the client would say, well, my daughter's out of college now. She graduated in May, and now she's living on her own. And so I'm not going to be claiming her anymore. I said, okay, that makes a lot of sense. I've tried to gather the facts first and then say, well, the good news is, if she's going to be able to claim herself, she's providing her own support, then she should be entitled to her own payments as well. So I think that's my potential issue here. Has Rita exercised due diligence to get the right answers? Has she shown a level of competence about knowing the laws about exemptions and who can claim who and who can't claim who? And, I think she knows what the basic rules are for the EIP payments. But yeah, there's lots of different potential issues here in scenario 1.
Yeah, will she have the ability to prepare an accurate return? Has she done her best practices about communicating with the clients what the law is and how it impacts them? A few other questions I might have is, are the daughters married? Do they go to school? Do they have education credits, tax credits that might be applicable? Do they have any other type of income? And even, how do they spend their money? Just need to dig a little deeper to find out more about this family. And we move to scenario 2. Then on page 206, we add a little more depth to this discussion and change a little bit of the facts. So when they're talking about the oldest daughters to claim themselves or not, Rita finds out that each daughter made more than $25,000 waiting tables. Pretty good summer job there. Rita asks probing questions on how the support is provided to the daughters. The parents say the parents pay all of the daughters' expenses. The parents had no idea their daughters earned that much money. Rita says, well, that satisfies me. I'm documenting these details. We're going to have the older daughter claim themselves on their own return. They will each then get their $1,200 recovery rebate. As Jerry said, probably plus the $600 as well, and whatever their net result was from their tax and withholding. So, Jerry, we have a little more depth here, but does just because the daughters earned that much money, how does that change the scenario, if at all?
Well, I think here, Bob, she's asked some questions about support, but then she ignored the answers, it appears to me, because the parents did say, well, we pay all the daughter's expenses. So it's seeming to me that that's not going to be, that they should be claiming the two daughters anyhow going forward. So, asking questions is great, but once you get the answers, you have to follow through properly. Is that, you agree with that, Bob?
Well, right. I think the biggest question is, does it earning more than $25,000 change anything? Well, it changes my perspective about what the other questions I want to find out more about. And I'm not yet comfortable with her conclusion that at the face of these facts, that the children are able to claim themselves. I'm still looking for more depth. Another question I might ask is, where did the children live for the year? Even though the parents said they paid expenses, where people live makes a difference as well. Well, we're going to add to scenario 3 and twist it slightly differently, where in this example of scenario 3, or this portion of scenario 3, we say here that under further questioning, especially about support the parents provide, they now explain the daughters pay all their expenses. The daughters buy all their own clothes. The daughters pay for their own food. The daughters pay fair market value rent to their parents.
Wait a minute. Hold on a second there, Bob.
Yeah. Why are we just now hearing about this with our children all grown, Jerry? Where did that come from? So Rita asks both daughters the same questions and gets the same answers. So she documents those findings and now concludes the daughters can claim themselves on their own return. They will get the EIP through the recovery rebate credit and whatever the final answer is on their own. $25,000 of income minus the standard deduction, minus their withholding, and they individually, daughters, will have their own return to be filed with all of that included. And Jerry, how you feel about it now?
Yeah, I think I'm, I guess maybe it's, what took her so long or something along those lines. Now I think she's asked, enough questions that I'm a lot more comfortable with it. And instead of just jumping to the conclusion right away to save time, make the clients happy, the clients are wanting to get money for their daughters, which is very noble of them. I'll tell you, Bob, I'm still stuck on that fair market value rent to their parents. I'm having trouble getting beyond that. Boy, we should have had this scenario, years ago when my kids were, ages, in their late teens, early 20s. Anyhow, that's right. I'll get over that. But yeah, I am more satisfied, and I think now she has done enough to defend the recommendations. And it isn't so much that she's doing, so the clients will be happy. It's, has she done the right thing? And I think I'm feeling a lot better about it now.
I still think there's pieces to consider in the overall tax preparation process for this family. We haven't mentioned things about whether they have tuition and fee credits, the American Opportunity Credit. Do they have a saver's credit where they're contributing to retirement plans that might be beneficial, also if they were on their own. We know if they are claimed on the parent's return, they're giving up that $500 dependent credit that we now have. So you have to look at the totality of all of that and explain that to the clients, because so often, just in this example, the clients thought the daughters were losing out on a $1,200 deal. Well, if they didn't have very much income, we know the parents would have been losing out on a $500 deal. So it's really not a $1,200 issue at all. It's $700. So explaining that to the clients in more depth gives them more knowledge about their tax return along the way too. So, are they in school full time? Do they have credits? Do they have other things that might impact their return? And even there might be state level considerations. In Illinois, each individual gets $2,325 as a tax-free exemption, or the exemption amount. So if they're under that, it's sort of tax-free money, but when they go over, it's all taxable. So my experience had always been kind of explaining the totality of this to the client. Clients generally want to know what occurs in that tax return. It's their return. They're signing it. They're paying the fee. They're paying the tax. They're getting the refund. I think the more we can do those best practices about educating the clients of what's going on, that will serve you and the clients well long term. Jerry, how about we go forward to scenario 5 and talk about Rob and Hugo? Sound okay there, Jerry?
Yeah, sounds good. We're at the bottom of page 207. I'll go ahead and set this up, Bob. We've got Rob. He's a CPA, been around a while. He's got a client, Hugo, who's being chased by the IRS. And while I'm setting this up, we've got another polling question out there. Did you have clients who filed their own returns as non-dependent? So Gino, keep that up here for a minute or two while we talk about scenario 5. So Hugo has got some IRS collection issues. And so Rob is a power of attorney, arranges the meeting. And we tell you here that Rob knows the IRS collections representative because he's been around for a long time. And so when Rob meets with the collection rep, she asks Rob to step outside and tells Rob that Hugo's had a lot of issues with the IRS. The IRS is considering Hugo as a shady character, and that, Rob, you've always worked well with us, and we don't want your reputation to be ruined because you're representing the shady character named Hugo. So, does Rob have a potential conflict of interest in representing Hugo here? What do you think, Bob?
Well, I think the challenge here is maybe twofold: Rob and his client, and Rob and the IRS person. But I think our conflict is primarily between Rob and the IRS person. Atypically what we think about of conflicts with our clients. So if I was, Rob, and had this engagement with Hugo to help him in collections, if I was comfortable in the collections world, I'm all in. I'm going to help my client the best that I can. And then when I show up at the IRS office and have a separate private meeting requested by that person to tell me that they don't think that kind of my client, well, it certainly would give me some pause on what I should be doing. And I would have to determine, am I going to tell Hugo right then before the meeting starts that IRS has given me information that might impact my ability to fairly represent him? And my conflict is with the IRS and my professional reputation versus my objective to help my client. And if I think that my professional reputation will preclude me from fairly representing my client, then I'd probably step away from that. If instead I thought that my long-term experience and my reputation with the IRS would be helpful to my client, then I think I probably don't have a conflict and would move forward. But I think the immediate question for Rob is, what do you tell Hugo, his client, and when do you tell him? And Jerry, I'll pitch it back to you. Have you ever had a condition in your IRS career where even in an exam, you pulled the professional out before the exam and said, I want to tell you something privately about your client? That seems unusual to me.
Yeah, it really does to me also. Yeah, that I would never thought that was my place. I usually tried to look at each taxpayer I was auditing, to try to not be biased until something happens that, changes my mind a little bit. And actually, Bob, I know, you are very familiar with the IRS people in your local office. And, these days we don't deal with near as many of the local IRS people, because everything is, if things are being handled through correspondence audits and, calling toll-free numbers where we're calling who knows where to try to talk to somebody with the IRS. But, my opinion here is normally, I would like to think that is a plus for my clients, that, they should feel more comfortable, the fact that I'm more familiar with IRS procedures, at least the way the IRS is supposed to work, and knowing the various IRS rules. And I don't think that I would tell Hugo, oh yeah, I know this particular revenue officer, and she's a very good revenue officer. Or maybe even worse would be, well, she's doesn't have much experience. Maybe, I don't think that she's really that great of a revenue officer. Those really aren't my place to do that. But I think, you're right here. The main issue, I think, is between Rob and Hugo, and secondarily between Rob and the IRS. But his relationship with the IRS, is that going to help Hugo? That's what we'd like to think. That's what we hope happens. Or is it going to be a hindrance, cause a conflict? And Bob, we got about 4 minutes left here. So what else do you want to add with this?
Well, I know, but I think so many times in these conflicts and these ethical dilemmas, as the time moves forward and actions develop, it's easier to see what maybe should have been done. So let's jump forward to scenario 6. Rob continues with the engagement, visits with the IRS. He doesn't get the deal he'd hoped he could get. Later, Hugo's friend tells Hugo that he saw Rob standing outside the IRS office talking with someone who was maybe perceived to be an IRS person. And Hugo says, well, I didn't get the deal that I thought. You're standing outside talking with the IRS. What's up with all of that? And now Rob has to come clean and tell his client that, yeah, I know the IRS collections person. Our slide says old friends. Well, to me, that's a big factor. Are they old personal social friends, or are they just professional acquaintances who have worked together? And Rob says, but I don't think my friendship had anything to do with the outcome of your meeting. And Hugo might not like that answer, that he thinks maybe he got the short end of the conflict here because Rob didn't want to upset the apple cart with his friend, the IRS person. So, Jerry, here's maybe what happened after that event. So now looking back with the benefit of good vision, what maybe now looks like should have happened.
Well, in fact, the question that's on our screen, why Rob didn't negotiate a reduction, well, we don't have any idea why that was, whether it had, whether the revenue officer, thought Hugo was a shady character and didn't cut him any slack, or whatever the reason might be. But I think the key question here is, which is what you were alluding to, okay, Rob has told Hugo that he knows the revenue officer and that Rob doesn't think that it caused an issue or affected what happened. But that's not really important. To me, what's important to me is, well, what does Hugo think? And, he didn't really have a choice before this meeting. Well, he's still got choices now. But, if Hugo says, okay, yeah, that makes sense. I think you tried your best. That's okay. But wouldn't it have been better to mention that to Hugo up front, then know that Hugo's on board, where he says, okay, well, that's fine that this person. That might actually be helpful, because you're familiar with how the revenue officer, works, and maybe that will help me out. Now, I talked about options. Hugo does still have options here. Can he can always go to somebody else and have them represent him and try again. But we've already done, this amount of work here with Rob, presumably paid Rob some sort of fee. And I think some of that could have been avoided by putting that out, communicating at the very beginning.
I think that's right. I think the best practices portion, although a small section of Circular 230, is really the right section that would drive this discussion here. A little bit of communication, a little better understanding up front would have eliminated any of these potential problems that Rob, Hugo, and the IRS may find themselves in at this moment. I think a disclosure might have been helpful, and disclosure not in a formal sense, but just some communication about what was happening, and let Hugo make the decision. As we've said a few times, it's the taxpayers' deal that we're working on, their return, their issue. They need to make the final call.
Okay, so please join me, if you would, on page 209, and Catherine and I are going to introduce to you Howard Craig. You'll find him in scenario number 7. Catherine, I think Howard, like a lot of us, figured out last year that you've been onto something all along, right? Because I know in your office you don't do any face-to-face tax preparation appointments, and you haven't for years, right? Or if you even have ever, I don't know. When did you ever do those, or no?
Maybe for the first 2 years after I left big accounting firm world. So 2 years out on my own, and then I stopped.
Okay, yeah, and I know we're kind of split, in my practice, I see more and more people don't want a face-to-face appointment, and more I don't want a face-to-face appointment. So COVID really helped further that agenda. We invested in a virtual tax platform that worked great for us last year, and we refused to see people in person, even for a pickup appointment. That's, I think, more common in my office, is somebody comes by after we've got everything all wrapped up, and that's when they hand me a check, which I like, and then let me kind of do my dance about what happened on that return and let them know what's coming up. And, I did kind of miss those little 15-minute appointments, but I wouldn't say that I missed them as much as I loved wearing my shorts and my hoodie all tax season, unless I had Zoom appointments. Then I looked about like how I look right now, at least waist up. So anyway, I digress from Howard. Howard, in the scenario, he didn't want to meet with clients face-to-face. And he thought, this is working out great for just about everybody. But he had 2 elderly clients that it didn't work out so good for. And here's what they did. They didn't feel like they had good enough internet at home, so they went for their tax appointment. They went to a busy local restaurant. And because it was busy, they couldn't hear. So on their device, they're cranking it up, the volume, so that everything Howard said, they'd make sure that they heard. But then, of course, everyone else hears around him too. Some people even turned and kind of waved at Howard. So definitely not the most confidential space for a tax prep appointment. So anyway, Howard finishes that engagement, and then his clients call him up 2 days later and they say, "Hey, Howard, we are disheartened by your process. We feel like you made us make our tax information public." So that is the situation we find ourselves in. My question for you, Catherine, do you feel the taxpayers have a point?
Well, I'm going to play Jerry Brune. Maybe. It depends. So, I will say the notion of not having good internet service at home probably is striking a nerve for a lot of people on listening to us today, right? Have had a lot of problems with internet around over the last couple of days. So, but here's the thing. So I believe that, yes, the taxpayers actually do have a point, but I think that there's a level of responsibility on both sides. So, I think that it's incumbent upon us as tax practitioners. So, for example, in my office, I have a virtual platform, but I have some clients that won't use it. I have some clients who will swear to me that they have no email. Of course, I remind them, right? Do you have a cell phone? Right? What do you have a cell phone? So in any event, sorry, I apologize, but the poll question actually popped up on my screen too. So I had to stop and answer it in order to be able to see our PowerPoints. So in any event, there is a poll question up for you guys as well. So that's one way to make sure your instructors know it's there. Okay. So anyway, what could Howard have suggested to the clients? Keith, you're asking, right? What do you have to say about that?
I think I'm right there with you. I mean, when obviously we took a bold stance last year, there were no vaccinations yet. We didn't feel like it was fair to our clients, to endanger our health or anybody else's health, especially because we work primarily out of a home office. So it's like we didn't we didn't want to take any chances. And what we kind of did that I would recommend to Howard is you got to communicate this stuff ahead of time. I don't know of any clients that I lost last year, like that didn't come back because I wasn't seeing face to face. I don't know if that would be the same this year. It seems like we have a lot of people that, up at least by me, that kind of believe COVID's a thing of the past. So I don't know how it would go this year if we took the same firm stance. I don't really know exactly what stance we're going to take. I've procrastinated on making the decision. What I would tell Howard is whatever decision you do make in this regard, you got to communicate it ahead of time. You got to let your clients know what to expect. So if he told them that this was the only way that their taxes could have been done, then I think shame on Howard. I know what we do, and I'd be interested to hear what you do, Catherine, as well. But when we had clients who didn't want to use our virtual platform, we offered them that they could drop off in our secure drop box physically, their documents. They could mail their documents to us, or they could use our website link, which is just like a one-way portal to just kind of drag and drop if they didn't want to go through the process of setting up an account. So we did kind of give them other options on how we could do the engagement. And I think if this couple had been given another option, they would have probably taken it. Well, maybe they would have taken it. It seemed like they were all on board with this thing until 2 days later. So I don't know.
And so the thing that you said that I think that we forget, and that's communication, right? So even, you asked me if I did face-to-faces, and I did, because I bought a practice and that practitioner had done face-to-face. So I had a group of clients that were used to sitting across from somebody, answering their questions and leaving with a tax return and paying their bill at that time. So I gave them a lot of notice. I let them know what the plan was going to be. I gave them some transition options, and I knew it was possible that some of them were going to change tax preparers, but I was okay with that, right? And so the same is true. I think Howard would have to think about whether or not this particular couple is a good fit for him. And so he really has to think about how he wants his practice to look going forward, and then make sure that he is communicating that clearly to all of his clients and any prospective clients. And so that's one of the first things. If somebody calls me and is, looking to change tax return preparers, one of the first things I tell them is, I don't do tax returns while you wait. So if that's the kind of preparation service you're looking for, I'm not a good fit for you. So I just think that it's really incumbent on us to be really clear about our methods and the fact that they may or may not work for everybody. And then you get to choose. If you want to create a method that is different from your normal method in order to accommodate a particular client, great. That's perfect for you. Communicate it.
Yeah, I thought it was interesting. One thing that Sam Phillips does, who probably a lot of our tax school friends here have heard Sam teach before. He told me that he basically offers a discount if you don't want an appointment. So I thought that wasn't a bad idea. It's not that you do an appointment surcharge, which may make people feel like they're being taken advantage of, but whatever the tax prep fee is, then he gives a discount if they don't require a face-to-face appointment. Maybe just something that's useful for for others out there. But as we dance around with Howard's situation, then Catherine, you've talked about communication. I've talked about communication. Do you think there's anything egregious enough about what Howard's done to this elderly couple to warrant a 230 violation?
Well, I guess I'm perhaps not quite as I dance a little bit more than you might, Keith, in this situation. So, I don't think that it's Howard's responsibility that the public information was disclosed, because I would suggest that the fact that the taxpayers accepted the engagement under those terms was a waiver of disclosure, right? So I mean, I just don't think that the disclosure problem is an issue. Otherwise, I'm not sure that there's a Circular 230 violation. What do you think?
I don't think so either. I think the one thing that would make me just a little nervous if I was Howard is if they had to crank the volume up on that device to hear me. And I get the same thing that happens on the phone. I mean, I try not to talk on the phone too much during busy season, but my clients, my older clients, I should say, they like to talk on the phone. So there's always kind of this question is, I know what I'm saying, but I can't confirm what they're hearing, and what they're understanding, So that's the only part I think about 1022 diligence as to accuracy, before we call it good enough, which was what one of our poll questions sort of said is, what do you have to do with the client's information, before you call it good enough, you kind of got to know in your gut that, like, I got the information that I needed to do an accurate and complete tax return. So that was my only concern. But no, I don't think OPR is knocking on Howard's door at all here. Okay. So moving forward then, Catherine, any additional advice for Howard and for those here at tax school who are trying to make our practice work the way that yours has worked for years?
Well, I think I've already given that advice. I think that each of us, how do you like to say it, Keith? You do you, right? So I think that each of us has to decide what works for us and then communicate that clearly to their clients so that your clients have an opportunity to decide for, make a choice to move to a different tax preparer if that's what's going to work for them. So, just, understand that not every method works for every taxpayer. So,
yeah, I agree. And I like this question that's posed at the end of the scenario. Should Howard have pulled the plug on the engagement once he realized that they were at the restaurant? I answer emphatically no, Catherine. And the reason why I say that is because then the clients would have been disheartened that he didn't meet with them, right? You can't please everybody. And I think not pleasing everybody is an excellent segue into our next scenario here with Jackson and Mia. Would you like to tell us what they're up to?
Well, so here's the deal with Jackson and Mia. We tell you in the text that they're talking to their tax return preparer, Rock, and Jackson. And I said they. And in fact, Jackson is talking to Rock. And Jackson tells Rock that he and Mia want to file married filing separate this year, because Jackson believes that if they file separately, he will be able to then qualify for lower student loan repayments under the income-based repayment option for student loans. And Rock lets Jackson know, you understand this is going to cost you additional tax dollars in doing this. And Jackson says, hey, I'm okay with that because we're going to save a lot of money, more than the tax cost, in terms of our repayment of our student loans. And so everybody agrees, or Jackson at least agrees, and they file these. Rock prepares married filing separate tax returns. Those get filed, approved, accepted. They pay the tax, or maybe they didn't. And then after that's all done and Jackson knows that those tax returns have been accepted and his income-based repayment plan has been accepted by the lender, he calls Rock and says, hey, Rock, we'd like to now amend our tax returns, those married filing separate returns, and file them jointly. So they want to switch to married filing joint. What is Rock up against right now? So what do you think, Keith? Where are we going to go with this?
This does not smell good on my side of the room, Catherine, this scenario. Yeah. I think if we're looking at potential ethical issues regarding 230, I think 10.33 comes into play here. Best practices, right? And best practices would say that Rock and Roller had better communicate what he believes to be the potential consequences of going down this road. I mean, I'm not an income-based repayment loan expert person, but I do know that generally speaking, when you apply for any type of significant loan, in the fine print, you're authorizing the lender to go and pull transcripts, right? And to look at what's been filed. So if they could see that the original return was filed, I'd think they could also likely see that an amended return was filed. So again, just kind of laying out the consequences here, and then probably getting something in writing from Jackson and Mia saying that they understand those potential consequences and are willing to take the gamble.
So it's interesting. I'm going to play a little bit of a devil's advocate for you here, because there's nothing in the tax rules, right? I mean, there's nothing in the tax rules that said they filed married filing separate. As long as they both agree, they could amend and file married filing jointly. There is nothing under tax law that says they can't do that, right? Right.
Yeah, no,
And
that's exactly right. Yeah.
right. And so the real question, and I think you identified it, but the thing that bothers me is, can Mia and Jackson hold us as tax return preparers responsible for understanding all of the rules with respect to student loan repayment programs? I just heard Keith say that he doesn't know anything about income-based repayments. So how is it that Jackson and Mia can hold us responsible for that? And yet, I have been told on many occasions they will throw us under the bus just like that, right, Keith?
Yeah, can they hold you responsible? No. Will they hold you responsible? Yes, it's your fault, right? I think, Catherine, you and I have both had this conversation where for a lot of our clients, we sort of become the go-to person in their life for anything that has a dollar sign in front of it. I got this advice from my financial advisor. What do you think I should do? Should I pay off my mortgage early? Should I finance the car or buy the car outright? What's the best way to give money to my kids? All of these questions that don't have hardly anything to do, if anything to do with their 1040 or even their business return. And it's like, yeah, that you're their trusted source. So that's, again, maybe it's not an OPR kind of ethical issue, but I really do think that we have an obligation to at least be able to see down the road a little bit, because we see down the road a little bit farther than our clients a lot of times. I think it's good business if we just kind of keep them informed, as to how this looks from our point of view and what the potential consequences would be.
So one of the things that bothers me about this scenario is that it leaves me wondering about Jackson and Mia's ethical standards, right? It reminds me of a situation where, if you've ever had a client say, well, these are the books that I keep for the IRS, but these are the books I keep for the bank, right? Now, I've never had a client like that. If I ever had one that said anything like that, rest assured they were disengaged right away. But that's kind of what my feeling about this. I did notice that there is a poll question, so you may want to make sure you answer that. And so that's the thing that really bothers me about this, is that am I now left with a client that I can't trust? Because if I can't trust them, I'm not sure I want them as a client.
Yeah, and I'm right there with you. That's kind of the advice that I'd have for Rock at this point too, is like, if you're getting some blowback here, or I think, like you've mentioned, Catherine, Mia's not factored in here at all. I had this situation last tax season where a friend of mine who's also a client, right? So already kind of make sure that you tread carefully, but she married a guy, and this guy called me last January. He said, hey, he's self-employed. And he said, hey, I'm kind of getting my QuickBooks caught up. And this is the first question he ever asked me. He said, I know that you're my wife's accountant, so I'm going to use you too. Where do I put my beer? Is it supplies or is it meals? Because if it's meals, I think I only get 50% of it as a deduction. and he's talking about his write-offs. So after I had like a 20 or 30-minute conversation with just him, my stomach didn't feel right, and that's the advice I'd have for Rock. If this doesn't make your stomach feel right, then, think about whether or not you even want to continue with this client. Ultimately, that's what ended up happening with me in this situation. The wife brought me her information, and then he gave me like the link to his QuickBooks. And once I started looking in there, I said, hey, man, there's a lot of issues here we got to talk about, and I said we in terms of all three of us. And he kept responding to just me and cutting her out of the reply all. His last question to me was, why does my wife have to be involved in it? And I said, you know what? She doesn't, because I'm disengaging right now. So like, you've cost me and her our relationship professionally. We can all be friends right now if like we stop now, but you got to go somewhere else for your taxes. And the friendship stayed intact, thank goodness. But the business relationship, it was lose-lose for both of us. So no good. But anyway, that's my story.
I don't know, Keith. I smell a representation engagement for that client sometime in the future.
Yeah, he'll come see me when he's under audit, right? That's the but that's the plot thickens here in our real scenario too, right? Because Rock did lawfully what he was asked to do. He amended those tax returns. We've already said no tax consequences here, right? But notice in scenario 9 what happens. Jackson gets a letter from the U.S. Department of Education accusing him of filing false, fraudulent information, and now he is barred from the program. And who's he mad at? Rock. Because it's always the accountant's fault, right? So, interesting twist in the scenario, Catherine. Do you think that Jackson and Mia have a valid complaint against Rock? And why do you answer that way?
So personally, I think they don't, because I don't know that they have the right to hold him responsible. On the other hand, if Jackson, one of my concerns would be if Jackson said, okay, we're specifically doing married filing separate for the repayment, and now we're going to amend, should Rock have had any reason to know that this could cause a problem? Because we do know, I know in practice, if a client were to talk to me about that relative to a bank loan, I would know that that could be a problem, right? And so that's the point that we're looking at. And I know personally for me, because my clients know that I'm an attorney as well as a CPA, oftentimes they hold me to a higher standard because they believe that there are things that I should know given the fact that I am an attorney. Sometimes I know them, sometimes I don't, right? But I am held to a higher standard. So, whether or not they have a valid complaint, as you said early on, whether it's valid or not doesn't matter. They're going to raise it anyway, right?
Exactly. So that's why I like this question so much. What other advice do you have for Rock, and how would you have handled the situation if you were in his shoes at this point?
So, see, for me, if I were Rock, I would have said when Jackson came back and wanted to file married filing joint, I might have stopped the action and said, why don't we take a look at those rules relative to your income-based repayment plan? Maybe I should take a look at what you signed when you applied for that program, because maybe there was something in what he signed that would have given me a clue if I was Rock. And if Jackson continued to push forward, then I would have recommended that the three of them, so Jackson, Rock, and Mia, have a meeting. And then that's where you suggested. I think at that point, I would have had them both sign something indicating that they were in agreement with filing a married filing joint tax return.
Yeah, that's all really good advice, Catherine. I think, you can't, I wouldn't say you can't, but if you've got a client with an income-based repayment plan, and I made the comment earlier that I don't know anything about them, I do know some stuff about, because I've got 2 clients that have these, and we literally, it just becomes part of the engagement that we have to figure out how much are you going to save in student loan interest by doing married filing separate, and then how much additional tax is that going to cost you, to see if this is a positive thing or not, in addition to any non-tax considerations, like Medicare premiums and stuff like that. So, that's all part of that original engagement. And I got to believe that that's what I would tell my clients then that do this. If my client's Jackson and he comes up and says, hey, now I want to unwind that, I got to say, but wait, we determined you were $3,000 in the good if we do it this way. And now the consequences, potentially, if we unwind it, you end up having to back pay all that interest. This is going to cost you $3,000. Are you nuts? I mean, that's kind of the approach that I would take. But if everything had played out the way that it did in the scenario, suppose that, Rock wasn't involved in that original conversation, then I think there's 8 words that apply here, fire them. No one needs clients like that, right? I mean, that's really what that amounts to. I mean, Rock didn't do a thing wrong. He didn't violate any tax laws, didn't violate 230. He could apologize for not explaining the consequences, but ultimately I would remind Jackson, you're the one that signed all this paperwork, buddy, So at the end of the day, this one's on you. So yeah, I would throw Jackson out on his ear, I think. That's how I'd handle it. That was a good poll question that we had there, Catherine, about whether or not someone has purchased a practice. I don't know if you saw that. That's going to segue nicely into our scenario number 10 here. Do you want? Yeah, I'd be happy to. Yeah, if you want me to. Interesting. Yeah, so 76% of us have not bought a practice. 20% of us have. So 2% of us wish they hadn't. Maybe their scenario went a little something like Lucas's scenario here in scenario 10. So look at that, folks, if you would, on page 211. Lucas Jones wants to become a tax advisor, right? So we get the impression here that he's little green, maybe wants to become a tax advisor. His banker said the best way to start is to buy an existing practice rather than try to build this thing from the ground up. So he checks out an online ad from Fred Couples, not the gentlemanly golfer that we all know and love. This is like Fred Couples, the criminal, okay? And you'll see why, because notice how this goes, right? Been in practice for 25 years, wants to kind of stay on after the transition. Lucas says, can I take a look at the work product? What kind of returns you're preparing and that kind of stuff. So Fred shows it to him, hopefully after he has him sign like an NDA or something, right? I believe that'd be the acronym, right? Non-disclosure agreement. But he takes a look at these tax returns. He noticed Fred's not the paid preparer. They all say self-prepared at the bottom of them. So he asks Fred about that. And Fred says, yeah, there was this little misunderstanding a few years ago between me and the IRS. And let's just say that I'm not exactly allowed to prepare tax returns. I look at the service of that I offer as more like, helping people kind of complete their own tax return. That's how I choose to look at it. So, okay, that's red flag number 1, right? Then he tells him that he wants to stay on for a few more years, but because of this little issue, I don't want you to compensate me for what I'm doing on the tax returns. Instead, you'll give me kind of like a variable rent check based on how much work I'm doing, okay? And then you can continue to use the office suite. So the question is this a match made in heaven, or is this a match made somewhere else? But more importantly, what are the issues here? What do you see?
Okay, so first of all, I know that we are currently preaching to the choir, right? The fact that all of you are here at tax school and answering your poll questions, but the fact that you're all here at tax school is an indication that you are actually holding yourself to a higher standard than potentially many other tax preparers out there. I can tell you for myself, in my text, as I was preparing this, I wrote 3 little letters. RUN, right? So I would be running really fast away from this. But assuming for a moment that Lucas decides that he's going to pursue this a little bit, there's so many things to ask myself. I mean, one of the first things I was like, okay, so if I'm Lucas, even if I decide not to pursue this, what about turning Fred in, right? I'm like, do I want to have somebody in my neighborhood who really can't prepare tax returns be doing this? To me, it leaves a bad taste in my mouth, or it, throws a shroud over the viability of people who are preparing tax returns. I want people in my profession to be upstanding citizens, and this just doesn't sound like that. So what do you think, Keith? Does he have a responsibility to turn Fred in?
Yeah, that's an excellent question. We don't get told in the scenario whether either one of them are licensed practitioners, right? So certainly Circular 230, governs the actions of us as enrolled agents and of CPAs, attorneys. We're all kind of bound to this, right? Whereas like maybe Lucas and Fred feeling like they're a little more renegade, because they're unlicensed, unenrolled. But the situation that I find interesting about that is there are 230 violations here, clearly, right? Disreputable conduct, gross incompetence, those are the umbrellas under which these activities fall. And I think in terms of what the responsibilities are, I think back to 2 years ago, I went to an IRS stakeholder liaison meeting, and that's where you get all the department heads that are there, and they kind of give an update on what's happened and what is happening inside the IRS. And the lady that was there representing OPR, she said she wanted to know about every single tax return we run across that has self-prepared at the bottom of it that was done by a paid preparer. And I just thought that was interesting because she didn't say, I want to know if CPAs, EAs, and attorneys are doing this. She said, we want to know about every one of them because oftentimes they build their cases, their criminal cases that end up in the news. They get built, like a beaver's dam here, one stick at a time, right? So we're giving them all of that information when we do turn it in. I think my advice here for Lucas would be to run and to mention this anonymously, probably to OPR.
I was trying to remember if we have any more questions, because otherwise I was going to move on to scenario 11.
Yeah, I think we're good to do that. Yeah,
Okay.
I mean, that's
so in circular 11, despite all of our best advice, Lucas decides to push forward with this. And he's having a discussion with Fred, and he realizes, and Fred tells him that he files a lot of trusts and tax exempt organization returns. So he's doing a lot of 1041s and 990s. And Lucas is going, I don't know anything about 990s or 1041s. And Fred says, Lucas, no big deal. Don't worry about it. I get great fees on these, and the software does all the work. There is nothing to it. Plus, guess what, Lucas? These returns are never audited. So what do you think now? What provisions of Circular 230 are we talking about here, Keith?
That's a good question. Again, I mean, I think we could just, where do we begin, right? I wrote down 3. Diligence as to accuracy, 10.22. Certainly, if you're letting the software do the work, how do you know that it's being done accurately? Like, our job is to use the head that's on our shoulders to take a look at how our software, our tool is producing the work product to make sure that it's accurate, right? We're the check, we're the diligence as to accuracy. 1035 competence comes into play. In order to accept an engagement like preparing a tax return, we have to be competent, right? Which means not necessarily that like I know everything about the subject right now, but I have to then be willing to say, hey, because I don't know about this, I'm going to go out and get the knowledge that I need to be competent. I know years ago I did that. I had a client that had tons of like stock options and RSUs and stuff. And I said, I don't really know enough about this. I realized at the time that I had already accepted the engagement. So then I looked out there, what kind of webinars can I take? And, I found something like the U of I webinars that we offer. And I felt competent then to be able to handle the engagement once I knew enough. The other thing we can do is we can purchase competence, so we can reach out to someone that does know it, and we can strike up a deal with them to sort of to leech off of their competence and help us in exchange for, I don't know, let's say dinner after tax school, Catherine.
Who would do that?
your beloved teaching partner here, who just loves and admires everything that is in your head, because you do have so much value to offer. So thanks for all the help, and I know that the dinners don't even begin to cover it. Okay.
See, isn't he great? You guys all think I'm taking advantage of him, don't you?
Mm-mm.
So here's the thing, and that's what, Keith, I love everything that you had to say. And I think that sometimes we think when we see Circular 230 and it says competence, it doesn't mean that you can never do it. It just means that you need to learn something. And I would say for me, I've been doing this for a long time, right? And if somebody comes to me or calls me and says, I'm interested in having this done, I'll tell them, you know what? I don't do those. I couldn't charge you enough to spend the time to learn how to do it, and I will send them someplace else, right? So I try and get that out of the way before I ever even engage. Because, what happens if you spend lots of time and you only have one client? Are you going to recover? Now, I know Keith loves learning, and so he'll just do it because he loves to learn. I'm too old for that. I don't have enough time for that, right? So if I don't know it, I'm not doing it. So anyway, all right.
I think in the heat of the battle, though, Catherine, I'm right there with you. I mean, their subject came up last year at international tax, a U.S. citizen working abroad. I've just never had it before, and I've never taught it before. So it's like I just didn't know enough about it, and this was March. So I didn't do it. So I reached out to one of my colleagues here at tax school who does a lot of work in that space. And I said, hey, would you like a referral? I'll go ahead and send it along. So certainly there's, some of it's circumstantial, right? If it comes to me in July and it's a rainy day, I can't be on the golf course, maybe I'm more apt to take a look deeper into it than if it was March.
And when I think about this too, so if Lucas had already purchased this practice and I was advising him, I would ask him whether or not it would be worth packaging, right? So kind of repackaging those clients that are 990s and 1041s. And perhaps he could even recover a little bit of money by selling that client list to somebody else, right? Just a thought.
But wait, Catherine, there's more. There is a little bit more to this scenario. We look at scenario number 12. And I'll go ahead and just cover that one if that's okay with you, Catherine. So they're walking out of the office, and Lucas notices a large rural mailbox. And when we were proofing this chapter back in the summertime, I said, "What's a large rural mailbox?" And Sam Phillips said, "You know how big your mailbox is? It's just like that, except it's way bigger, right?" So there's one of those big, huge mailboxes outside that you can fit packages in, and what Fred really puts in there is a lot of disclosures he shouldn't be putting in there. He tells Lucas that this has been a good two-way system for getting information from his clients to him and from him to his clients, an unlocked mailbox. He says, we do a lot of payroll, and we put the checks in there and the payroll returns in there, and then the clients come and pick them up when it's convenient for them. To that, I say, whoa, Catherine, what issues is this going to create for Lucas if he keeps that mailbox in place?
Well, so first of all, of course, anyone listening, when Keith says he doesn't know what a rural mailbox is, okay, so compared to where I live, Keith is rural, okay? So I was a little surprised he didn't know what a rural mailbox was. But in any event, times are changing, right? And I think sometimes it's so hard to begin to think about new practices. But, clearly there are disclosure issues for Lucas relative to this mailbox, because if anyone can get in, then, and there's disclosure in terms of Lucas disclosing clients' information. I think about the paychecks that he's talking about. And so for those employers that are his clients, what kind of HR problems could they run up against, given the fact that there is potential information of their employees that's getting disclosed? So I just think that there are so many issues that Lucas is going to have to find a different way to communicate that information with his clients. No, I think I must have been too loud. So Thanks, Gina. Sorry for those of you who are listening. I'm not usually that loud. Okay. So, what would you do in a similar circumstance, Keith? How would you handle the situation?
Yeah, you know what's funny is like for a lot of you who've heard me teach before, I said that like my practice really began like 30 years ago because my mom had a little 1040 practice at our kitchen table, and she did this very thing. She had a mailbox outside for the drop off and the pickup. So when I started, I had the little mailbox for the drop off and pickup, but I realized right away, wait a minute, this isn't a good idea, you know? So what we switched to is we switched to a system that I still use today. As I mentioned earlier, working primarily out of a home office, we have a secure drop box. So it's a lock box that clients can put information into, but then no one can get that information out. Now, I know what you're saying. People can hook a chain up to an ATM and drive off with it. Nobody is going to rip down the wall of my house to get something that's in my box, okay? I don't think so anyway, unless someone puts gold in there or something. I don't know. But yeah, so that's the situation we use. Certainly that would be maybe a viable suggestion here. You just got to be able to go digital too. I mean, that's the way that the practice is going. You know, it's like I just look at this and I think this is something that just is so unnecessary in 2021. And I know for a lot of you out there, you're thinking there's still a lot of paperwork and payroll. Again, maybe that's my ignorance from just not doing a lot of payroll work. But yeah, situation here says, Lucas, if you haven't bought, run. If you did buy, get rid of Fred. So, is it okay with you, Catherine, if we skip scenario 13? I think everybody realizes at this point that Fred's kind of a crook, you know? I'd like to spend our last 5 minutes on that last scenario, if that's okay.
Totally fine with me. And make sure you answer the poll question that's being pushed out to you.
Yes, thank you very much. So if you would, folks, go with me to 214. This is our last scenario for this year's ethics. Stu Williams purchases a well-established tax practice in a large metropolitan area. You did that, didn't you, Catherine? Some years ago. That's exactly what you told us. The first thing Stu did is he raised preparation fees by 40% across the board. Okay, 40% across the board, and then he didn't tell his clients about it. Because he said, hey, you know what? Betty at the front desk is such a sweetheart. She knows all these people. They're not going to complain to Betty. I'm going to stay in my office and just collect the fees, right? That's all I'm going to do. And that's kind of how it works. Puts Betty in a real stressful position. After the filing season, a client calls and he's got an IRS letter. And Stu says, okay, you want me to look at that? It's going to cost you $500, like as a retainer, you know, prepaid fees, let's call it, right? Yeah. Prepaid fees, $500, even for me to look at it, right? He doesn't use engagement letters, and this is kind of the icing on the cake. He's sitting in a bar at the end of the scenario with his friend, and he says, you know, this is just how I do business, and if my clients don't like it, they can go elsewhere. So, you know, the question here is, you know, what is, oops, I should have advanced those slides. Sorry, folks, if you were looking at the slides. There's Stu, kind of doing his thing. Any 230 violations that you can see here, Catherine, for Stu?
Well, I'm sure for many of you, the first one that might jump out at you would be unconscionable fees, right? There is a requirement in Circular 230. We're not allowed to charge unconscionable fees. Of course, they don't tell us what would be considered an unconscionable fee. And in Stu's case, raising his fees by 40%, we don't know what they were before, right? So we can't necessarily say that that's unconscionable. I also wouldn't necessarily say it's unconscionable to give a client a fee quote with respect to handling an IRS notice. But that being said, you know, I don't think that this is necessarily the best way to run a business. And I think that discussing your business in public at a bar could be a little bit of a problem, right? But I mean, I really do think that these are matters of practice management. And, you know, just like I said before, I think that communication with your clients is really what's key. And if you're going to do business in a particular way, make sure that the clients that you have know that's how you intend to do business and give them the opportunity to find somebody else if that's what they want to do. So what do you think, Keith?
Yeah, I'm right there with you, Catherine. And I mean, to just kind of address that last question, what are some alternative office procedures that he could consider? This, sad to say, I'm a lot like Stu, in the sense that I don't really, I don't like talking on the phone. I prefer email. I don't like face to face. I prefer email, chat, Zoom, even, because I just find that for me in my practice, that just slows me down too much, if I do those things. So my thing is more about speed, efficiency, volume. But again, that's kind of what I would tell Stu is maybe you should consider trying to go more virtual rather than having all these clients come in, asking for you to step out of your office, asking for you to do this, that, or the other thing, So certainly, though, what I would tell Stu is you got to just communicate with the clients ahead of time. You let them know what to expect, and then you make sure that you exceed their expectations. And if you do that, that's just good, sound business. So same advice I'd have for everybody. Thank you, folks, for being with us here for ethics.